It's not too loud. It's not too loud. Gold is looking bullish here. Gold is looking bullish here. Got a inverted head and shoulders, and you got a larger inverted head and so shoulder. Head and shoulders. You got a larger inverted head, so shoulder.
The 9000 series is the most reliable computer ever made.
Of what was happening in the market. My question to you is, in just fight for market share, is going to be willing to lose over time to play against.
Well, I think with DoorDash in particular, a lot of investors were impressed by the fact that the company has been able to show profitability, which is something that its peers have not been able to accomplish. They've also been able to quickly scale up to that #1 market share position. So investors are looking at this and saying, okay, well, what's the next step for DoorDash? Is it something where they expand internationally in a very big way? Right now, they're currently in Canada. Are they expanding to grocery? Are they expanding to pharmacy? If they've been able to accomplish what they've been able to accomplish in food delivery, what is that next leg in this company's growth? That's something that I'm told investors were really focused on during the roadshow, Andrew.
Okay. Leslie Pickard, Deirdre Bosa, appreciate it. Reminder, don't miss an exclusive interview with the CEO of DoorDash. Tony Xu is going to be on with the guys on Squawk on the Street. That's at 9:30 Eastern Time this morning. We'll be right back.
Welcome back, everybody. Let's check in with Jim Cramer. He's standing by at CNBC headquarters. Jim, Leslie was just saying about this IPO today for DoorDash that she's told the most common question that's been asked on the roadshow is what happens after COVID? What do you think the answer is?
Well, I think that there is a interesting duopoly developing between DoorDash and Uber Eats. So I think that when things come back, we will find that there's still a lot of people who like to have food that comes to them, and there'll be many more restaurants open. So I think that there's a great hope that these companies are going to do even better than people realize. Pricing could be good. The only thing that I think is difficult is because maybe you can pit one against the other if you're a restaurant chain, but I don't know how well that will go. It's here to stay. It's additive to your earnings if you own a restaurant, so you're going to play. And I don't think that these companies have a decline in earnings. I just want to know whether the enthusiasm can be maintained and whether the insiders don't cash out. That's what I care about.
What about what Leslie mentioned about not having a green shoe? You think that's a problem or no problem at all?
Kind of surprised me. I mean, green shoes work for a long time. And I think that it is not really understood by the shareholders, by most of the people in the public. But it's something good to have in your arsenal. I like stabilization. I like the ability to be offer more stock. I'm afraid that what's going to happen is the stock's going up too huge, and people are going to get hurt. I don't want that happening.
Yeah. Jim, we're looking forward to that interview. I know it's coming up just a little bit later on your
Thank
show,
you.
and we're going to see you in just a few minutes.
Thank you very much.
Thank you.
Yep.
Okay. Meantime, I want to talk some stocks on a big day for the markets. Jim Paulson, Chief Investment Strategist for the Leuthold Group, is with us. Before we even just get into it, what's your take on this sort of, we'll call it, it's an IPO week between DoorDash today and we're expecting Airbnb later?
Well, I think it's companies taking advantage, Andrew, of an opportunity, and it comes about when you've got a market that's roaring. It comes about when you've got sentiment where it's at, really aggressive and optimistic, which is where we're at right now. And that's when it's probably the best time to raise capital at cheap cost. And I think we're seeing that in spades right now.
We are. If you're an investor, though, do you want to go along for that ride, or is this a sign of something that's toppy?
Well, I think it's another sign. Sentiment's really extended. There's no doubt about that. It's very optimistic. The market just goes up every day. It doesn't give any sense of risk. So I think we're going to get a pullback at some time, here. And I think if you're going to buy these IPOs, what you got to think about is not necessarily where they might be 3 months from now, but where they're going to be in a couple years, and make that case, I think. IPOs often come out when markets are up. So you always kind of have to have this risk. They don't generally come out when markets are down. So I don't think it's anything new. I still think the market's going to head higher over the next few years. So I just think right now, though, you got to be prepared for some pullback because sentiment's probably a little ahead of itself.
Are you of the view that there's going to be a great rotation, though? I mean, that ultimately the cyclicals, the banks, the others that have seemingly been unloved, though actually I should say the banks have had a nice little pop recently, that they will have success, and that success will be to the detriment of the stay-at-home stocks that have had such success? Or do you think they can both rise at the same time?
I think the stay-at-home stocks, tech in general, I think it's going to underperform in the coming year, Andrew, but I don't think it's going to collapse. I think it'll participate in another up year in the market. I think 2021, we're en route to the fastest year-on-year growth rate in real GDP in 35 years. I think we're going to do 6% growth next year. That'll be the fastest growth since 1984. If we do that, then something like that, I think we're moving from extreme pessimism this year to massive optimism in the coming year. We will get to a point where this sentiment we see today looks tame, I think, when we finally blow the horns and declare victory against COVID. And in that world of strong growth, it benefits broader market plays. I think it benefits most small caps, cyclical, international markets far more than it benefits unit growth companies and stay-at-home stocks. So I think they're going to perform, but I would still own some because they do diversify your portfolio against the shocks you're going to have if you just have an all cyclical stock portfolio.
I know we should always suggest that people are long-term investors, but you also mentioned you thought there might be a pullback. People obviously try to find opportunity, and they do try to time these things to the extent they can. Are you suggesting, I mean, if you're playing this out, you're saying 12 months from now, you're thinking that there's going to be even more optimism in the market, in which case, do you wait for this pullback that you're talking about, or do you buy right now?
If you're not in, I wouldn't wait for this pullback. I think it's going to be sentiment pullbacks are tough to call. If it's more fundamental, if the Fed's working against it, rates are going up, inflation's going up, those are easier. Sentiment ones are tough. I think it'll be brief, even if it happens, Andrew, because we're too close to vaccines. We're too close to reopening. We're going to have lagged impact of stimulus boosting growth. Earnings are going up. So I think we might get one here over the interim term, but I wouldn't put a lot of weight on that. I would think more, where do I want to be a year or two from now?
Jim, we got 20 seconds. we've got 20 seconds. Does it matter if the vaccine comes out in May or if it somehow gets pushed into the September, October meeting in terms of really people being able to have access to it? How much does that matter, or are people just going to look past whatever it is?
I think we're close enough where the market's going to look through that a little bit. I think the economy is in a lot better shape than people give it credit for. And I think whether the vaccine comes out is not as important.
Okay. Jim, always good to see you and get a little bit of optimism. So I appreciate that very, very much.
Thanks, Andrew.
Going to take a quick final check on markets. Markets are optimistic today. We got the Dow looking like it opened up about 103 points higher. We got the S&P up about 7 points. NASDAQ down about 6 points. We will see what happens with DoorDash, and I'm sure we'll talk a lot more about that tomorrow. In the meantime, make sure you join us tomorrow. Squawk on the Street begins right now.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber. Futures are mostly steady, coming off those record closes for the S&P, the NASDAQ, the Russell, the Dow Transports. Busy setup as this historic month for IPOs kicks in with the debut of DoorDash pricing at 102. Our roadmap begins with the IPO banner year. DoorDash is set to debut today, pricing above the range, valuing the company at $39 billion. The CEO will join us exclusively this hour.
Plus, those records for the market roll on. Futures pointing to a higher open. The S&P topping 3,700. And as COVID cases continue to surge with vaccine hopes on the horizon, Delta Airlines CEO is going to join us. It's a first on CNBC. Of course, we'll discuss his outlook for his troubled industry. Carl.
All right, Jim, let's start with DoorDash. You were just talking about it with Andrew and Becky and Joe. Your point yesterday was great story, but be careful.
Well, look, I think that there are a couple of things that are going in favor of it. There are people who know the brand. When people know the brand, the younger investors just say, you know what, get me some. I don't want them to lose what discipline they have, because then we're starting to get into a 1998, 1999 period where they put market orders in, and whatever price you get may end up being the top price for the day. What I do think is important is people recognize that they're going to have easy comparisons for a little bit. But then, you know, when people can start going out again, they will choose to go out as much as they will use DoorDash. I don't think DoorDash goes away. I think that it's more of a duopoly than it's been before because of Uber Eats. Good business, great business. I don't know. It is still a delivery system. It's still they've had to make a suburban. They've made a suburban footprint, which is really brilliant. But David, in the end, we know that the moat is only as good as the fact that they have low prices and they've got good technology.
Right. Now, they've had very strong revenue growth. But to your point, Jim, this may be a unique opportunity that they've seen over this last, let's call it 9 months, in terms of growth. And the comparisons will get tougher. They've got to. A year from now, when hopefully we're all back to sort of normal behavior and people are not staying home quite as often and ordering in quite as much, you'd expect that will reduce. It's going to trade at a multiple to revenues that is going to be double digits.
I'm worried about that.
And I wonder how you view it from a valuation perspective. Obviously, great growth, huge market share, 50%, which you do also have to wonder how much bigger can you get than that?
Well, look, the one thing is certain, Carl, is that this newer brand of investors I've been profiling on Mad Money have a lot of capital. Now, a lot of people say, well, where did it come from? I don't want to even ask that. I just say they like things. And when they like things and they use things, actually the old Peter Lynch model from Magellan Fund for a long time at Fidelity, they're willing to keep buying. Look at Snowflake. I mean, when I speak to Frank Slootman, he's not sure exactly who his investors are, but he knows a lot of them are retail investors. DoorDash is used by a lot of younger people, both in the suburbs and in the cities. So I think that you're going to see incredible enthusiasm. I wish that people would use limit orders, but that is a parlance, Carl, that they don't understand. They don't get that.
Yeah. It does sort of remind me, Jim, of another call out this morning, and that's from J.P. Morgan. They cut CrowdStrike, they cut DocuSign, they cut Okta, they cut Zoom, not because the business is going to take a turn for the worse, but they say post-vaccine, you could see some of these high multiple names at least underperform the software industry average?
Well, when I read the piece,
is that all part of a piece?
Yeah, look, I did a piece last night about how Okta's one of the favorites of this new cohort, and it's up a great deal. I use that as I often talk about it on the show, as being that's the one that you watch to see if there's a turn. They keep hitting the numbers, and the numbers are amazing, and the stock goes up every time. If they keep hitting the numbers, at what point do some of the people who work at Okta or some of the insiders at Okta say, David, we've made a lot of money. It's been a great run. Let's issue some stock, because you haven't made a profit until you take it.
That's true. That's true. Wait, but you said the insiders would sell, and then you're also talking about the company issuing stock, two separate things?
Oh, no. I'm saying one of the insiders. I'm thinking about the year 2000.
Yeah.
Where the insiders said, you know what, there's pretty good prices here. But they haven't sold. I mean, it's one of
the insiders haven't sold.
The insiders.
Okay, I thought you were bringing up the idea of the company selling.
Todd McKinnon is the CEO, and he loves the company. And this new breed of investors, the new breed of insiders, David, they just don't sell much. And it is rather incredible.
They don't, and they don't ring a bell. And I can even look back now. I don't know what you would point to as the factor that turned things completely in 2000. Why we hit our high when on March 10th, 2000, and then went down more or less enormously from there. I mean, what was it at that point?
Well, I thought it was
we talked about valuation for years.
Well, we had offerings.
I mean, man, Greenspan's comment was 96, wasn't it?
I know, but we had rational exuberance. We did have offering after offering after offering from insiders, and then the numbers came out, and the numbers were bad. The difference here, for instance, I had Chewy on last night. Now, this is a stock that's just been red hot. I know it didn't go up huge after the quarter, but take a look at what it's done, for heaven's sake. And the insiders, they seem to love it. There's no cash out. They have such a level of belief. At the same time, we get Snowflake. Who are some of the largest shareholders of Snowflake? Berkshire Hathaway, no, not Warren Buffett, another fund manager. You've got you have Mark Benioff in there. You've got some institutional names, and then you've got this weird thing that's happening where you get these stocks to a certain point that even the Tesla, for instance, gets added to the S&P. Rather amazing, and it's a capstone. Carl, back to you.
We're going to talk about Tesla later on this morning, guys. But first, Delta is focusing on holiday travel, obviously, amid the pandemic, and as well as how soon vaccines can get to the public. Let's get to Delta CEO with our Phil LeBeau today. Hey, Phil.
Hey, Carl. Let's bring in Ed Bastian from Delta's headquarters down in Atlanta. Ed, thank you very much for joining us. I know you're just announcing that you're going to be permanently waiving change fees for international flights. We'll talk about that in a little bit, but right out of the gate, I got to ask you about the latest numbers from the TSA. Just 500,000 people screened yesterday. There is a concern, a serious concern within the industry that we're starting to see the slowdown, and people are just saying, that's it. I'm just not going to fly right now. Give me your take on business right now.
Well, first of all, thanks for having me, Phil. Good to be with you. The virus is our top concern, not just for our industry, but for our nation. And while our people are doing a great job of providing a safe travel experience for our customers, including blocking all middle seats through the end of March, enforcing masks, making certain that every experience is clean before we take off, the virus is having an impact. Customers are heeding the warnings of government authorities. The CDC warnings have been important in that regard. Quarantine, stay-at-home restrictions you continue to see are out there. So I would expect that the travel we're going to be seeing for the upcoming Christmas period is going to be similar to what we've experienced over the last few weeks. We're currently at about 1/3 of normal traffic trends, and I don't see that changing here for the next couple of months. So that's the challenge. The good news is that with the vaccine on the horizon, spring, we know there's enormous pent-up demand. People are waiting to get back out again. And there's a promise that by March, April, May, in that timeframe, tens of millions of Americans will have been vaccinated and ready to get on with their lives. And that's what we're looking forward to.
Ed, the passenger levels are right now somewhere between, let's say, 63 and 70%, somewhere in that range, depending on the day of the week. Is that where you expect it to stay leading up to the Christmas holidays, end of the year holidays, and then in the first quarter when we know that it's always the slowest for the airlines? or does it get even weaker? Do you see it drop down where we see passenger levels down 70, 75%?
Well, we're in a period, the month of December it's really two parts of the month. The first half of December traditionally is a very slow travel period, even in normal times, and we're seeing that with the current month as well. Once we get through the middle part of the month, we do expect to see traffic increase, though again, I'm not sure it's going to increase more than maybe a third of what it was a year ago. And then January should probably be another slow travel month. We've raised the cash at Delta. We have over $17 billion in the bank. We'll get through these next few months, and I'm quite optimistic that by the time we get to the spring, we're going to be looking at a real resurgence of demand. People are ready to get back with their lives.
Now, Jim Cramer, it's great to see you. You always come on no matter whether it's good or bad, and that's terrific. Really interesting. You're talking
Good to
about
be with you, Jim.
adding a voluntary contact tracing program for inbound international customers, which will provide essential tracing information directly to the CDC. How do you think that will fly? Because I think that that's precisely what we need in this country to make sure that we all feel more secure.
Well, one of the things that's really important, Jim, is that we figure out how we reopen international travel. Domestic travel is moving. The trends aren't good, but it's open. International is the biggest challenge that we have. We need to create quarantine-free lanes of traffic. And the good news at Delta is that we have done that. Starting next week, we'll be launching flights from Atlanta to Rome, as well as from Atlanta to Amsterdam that will be quarantine-free, meaning that customers will be tested before they get on board the planes. Those planes will be COVID-free as a result of that. And when they land in both Rome as well as in Amsterdam, they won't be subject to local quarantine restrictions. So we've been working closely with the authorities both in Europe as well as in the U.S., the state of Georgia. Tracing, which is a part of this, is voluntary for inbound traffic, but the CDC is seeking information, and we support it, to be able to identify customers coming back into the U.S., whether it's a U.S. customer or an international customer, that in the event of a health emergency, that they be able to notify customers. The important thing, Jim, in all that, though, is the Mayo Clinic, which has been our great partner throughout this entire pandemic journey, has told us with the testing protocols we've put in place on these tests, the odds of someone being subject to a COVID transmission are literally 1 in a million.
Wow.
So the odds of anything happening on these flights are incredibly low. And that's what we're going to need to do to start reopening the world.
Ed, it's David Faber. You know, when we talk about reopening, we talk about a return to normalization. Many people focused on your industry also, though, wonder, what does the business traveler look like when we get to that point? Given the ease with which they have been able to communicate via all sorts of different technologies that perhaps were not really available or useful that long ago. How do you view it? Do you see business travel ever coming back to the levels it may have had in 2019?
I think it's going to take some time, David, but over the next several years, I do see it coming back. Listen, video technology is here. It's going to continue to be used, no question about it, but it's not a substitute for relationships or doing business. It's a complement, and I think it'll be used in a complementary form. But business has to be done in person. I'm a firm believer that I think it's going to take a while before businesses are open again and customers are starting to see and take in visits from sales folks. But people need to get back out and to see their own customers. And remember, business travel is not only the big corporates. There's so many business travelers, many more business travelers. There are small business owners, people that are out on the road. Those are the true road warriors every single day. They need to get back out and be with their customers. So today, our big customers are only back about 15%. I don't see next year it being any more than maybe 40 to 50%. But it's going to take some time. Business travel has always rebounded. It takes a while to come back, but I think it's going to come back before we know it.
Ed, I looked into the Rome flight. We have a business in Italy, and it seems like an extraordinary opportunity, even though Italy is a little dangerous. But can you describe to people this testing process? Because I think if they knew about it, they would be much more inclined to go to places.
Yeah, it's actually a relatively simple process, Jim. Customers will be required to have a PCR tests 72 hours in advance. We work with Quest, and we're giving customers the information where they can get those PCR tests. When they arrive at the airport in Atlanta, we will be supplying at no cost to customers a rapid antigen test. It's a 10-minute test. It's the Abbott test. It will be supplied by the Georgia Public Health Authorities. Assuming they pass and they're clear from those two tests, they'll get on the plane. And when they land in Rome, the Italians have the same Abbott antigen test that they'll apply on a rapid basis. So while you're waiting for your luggage or waiting to depart the airport, you'll be given the opportunity to take that test. And assuming you're clear in all three tests, and you should, you'll be free to travel in Italy as well as in Europe, quarantine-free.
Hey, Ed, if the rollout of the vaccine is smooth and happens quicker than many people are even forecasting right now, and you do see a surge in demand for the summer, how quickly can you bring the aircraft that you have parked back into service, get the crews in place, get the maintenance facilities ready to handle that resurgence in demand that you're expecting?
Well, we're already ready to go, Phil. We're flying with load factors today that are probably about 40%, 40 to 45%. We're blocking middle seats, as you know, through the end of March. When it's safe, when the vaccines are out in large numbers, that certainly will be returning those middle seats back to the market. So we'll have a lot of flying seats that we'll actually start to put customers back into in the spring and the summer. So I don't expect at Delta there's going to be a huge increase in the number of aircraft or departures that are ready. We're ready to go. We've got the seats in the sky today.
And one last question for you, Ed. As you look at the next 3 months or so, you have announced that you're going to be permanently waiving international change fees. There are skeptics out there who say, you know what, we've heard from the airlines who are saying we're getting rid of change fees, and it'll come back in a couple of years when business comes back. You're pledging that you're going to keep these waive these international change fees for good, correct?
Correct. They're gone for good. We were on this path before the pandemic about eliminating friction points between us and customers, and change fees being one of those. So when the pandemic hit, it was the perfect time to waive them, because we don't want just another reason for why customers are nervous about booking and making advanced travel plans. So any ticket that you purchase going forward from Delta, from any North American destination, there will be no change fee required if you decide to change your plans, whether it's domestic or international.
Ed Bastian, CEO of Delta Airlines, joining us from the Flight Museum down there. It's been a while since I've been down there, but hopefully, maybe in the first quarter, second quarter.
We need to
we'll
get you. We need to get you and Bob back down here, Phil.
We will. Bob's right here. He's ready to go. We'll see you hopefully in the next few months if things slow down in terms of the COVID-19. Carl, what's interesting when you listen to Ed Bastian, and I've heard this from a number of the CEOs, they believe that they have the liquidity in place to weather what's going to be a brutal couple of months in terms of travel demand.
That's been key all year long, Phil. Great interview, and it's going to be a good day when we get you back to Atlanta as well. Phil LeBeau, thanks so much. Lot to get to this morning. We'll talk some FireEye, some JP Morgan, Bank of America, Disney, Apple, and Dwayne Johnson, the Hollywood superstar. We'll talk about the success he's having in the spirits industry, breaking some records with his tequila brand. That and a lot more straight ahead.
making travel plans.
Why not?
After listening to Ed Bastian, I'm saying, okay, let's go to Europe.
Where can we go?
I mean, you know,
Where can we go?
once you get there, you kind of just hunker down.
We're going to go away together and hug. All right, but let's get to a mad dash this morning. Lowe's is what you want to talk about.
One of the things that's happened, David, is that people keep saying, when is this market going to go down? Well, when the bad news comes. But right now, we got good news. Yes, Marvin Ellison announcing a total home strategy, says the numbers are good, could even be better. Comp store sales in the 20s. But then throws in a $15 billion common stock repurchase. And it's got a real strategy. We know that Marvin Ellison is so competitive. They've got robust levels of free cash flow. So, David, you come in and you say this stock is peaked, and we saw the Toll Brothers go down, and people started talking about housing peaking. Well, go ahead. Why don't you go against the stock that's up 33%, is buying $15 billion with an incredibly good CEO. This is the tale of the tape, David.
You like this one and you like Home Depot.
Oh, yeah. They're both very good companies. It's very unusual to have both really well-run companies at both places. You've got them. And Costco's well-run.
And the trend here in terms of, I mean, even if home buying were to slow, home repair and rehab and making sure everything's, that seems to be not going anywhere.
People have discretionary income because they're not going out there and carousing. Or going to sporting events.
Or traveling.
Or traveling, right? There's just so much discretionary income because we're a service economy, and the service economy is like, let's go to the Grand Canyon or let's go to Four Seasons, whatever. No, let's go to Lowe's. Let's make our place look better.
Right.
And, David, it's a pretty good investment to get your house going up.
Seems like it. Seems like it. All right, we got a lot more coming up for you right here. Of course, that exclusive with the CEO of DoorDash on that company's initial public offering. Keep it here.
Coming up in our next hour, Hollywood superstar Dwayne Johnson on his big push into spirits, future projects, the environment for media and content in 2021. That's coming up on Squawk on the Street this morning. Don't go away. Take a look at the post where DoorDash will make its debut today at the New York Stock Exchange. Jim, you know, we normally talk about this when the IPO market heats up. To what degree does this take oxygen out of the room? But I wonder if you think that's a dynamic this time.
Look, not yet. I think that Airbnb, and then we have Robinhood, and then I think at that point, if people go on vacation and they do another deal, look out, there won't be enough money around. But right now, there's plenty of money. And there's rapid money. I think there's money that basically says, we don't really care what that opening price is going to be. David, they have 102, 110, 130. And you know, David, there's not going to be a lot of discipline in these market buyers. I mean, they're not going to put a price or limit on it.
No, there is expected to be a significant pop at the open at this point. We'll see. Sometimes we get surprised. We give you all of the data on how many times oversubscribed so many of these offerings are. But occasionally, remember Smile Direct?
Well, could this be Uber? How about Uber?
Or, oh, my God, of course, Uber. Remember sitting there as their smiles started to sort of have to be more and more forced as we watched that thing trade below opening. But in this case, that's not expected. I mean, early on, a half hour ago when I was checking, people were saying 130 to 140.
Oh, come on, really? 130, 140?
Yeah. Now, you got a lot of the people who are in the pre-IPO rounds who are investors who actually are getting access to the IPO. Why? Because it's sort of it's a tip. Hey, thanks for helping us out early. Here's an opportunity to flip some stock. So, you know, you got a little bit of that going on, people fighting for allocations as they always do. But we'll see where we open.
It's exciting, Carl, and that's a word that a lot of people fear. Excitement. I've been hearing it over and over again. I talk to people say, you know what, how do I get in? This is so exciting. Now, initially, excitement's okay, but remember what Lee Cooperman says, which is that the euphoria stage is always dangerous. We're not there yet. We still have lots of people who want in $5 trillion in the sidelines.
That's true, Jim. And there's some enthusiasm on the sell side on other names as well, which we'll talk about after the opening bell. Speaking of which, let's go to the NYSE. DoorDash, of course, celebrating its IPO today. And as we said, CEO Tony Xu will join us in a couple of minutes. At the NASDAQ, it's PubMatic, digital advertising technology company celebrating its own IPO. I thought of you this morning, Jim, because I know Goldman's sell on Apple is annoying to you.
Yes.
But I also know that you don't like the term super cycle, and that's what Wedbush does when they take it to 160 today.
This fellow Ives, I mean, he's doing the coal super cycle. Oh, but the fracking sand super cycle. Don't put the jinx on a good situation by talking super cycle. That gets people too excited, David. It brings in a lot of people who just say, how can it go wrong? You know that's not good. You know that kind of talk, David, has historically not been helpful for investors.
No, it hasn't been. You're right. But doesn't mean they're not going to use it.
5G super cycle.
You know, but what you know, when you hear other things from analysts, I mean, for example, I will reference Tesla today, right? And we've got this report out this morning from JP Morgan talking about the addition of the stock to the S&P 500, which will take place on September 21st. Do people want to listen? December 21st. Did I say September? Thank you, Chip. I'm trying to do 7 different things here.
Right.
But here's the language they use, and I was just trying to get this up while I was talking there and sort of trying to. They say, listen, we recommend investors not weight Tesla shares in their portfolios in equal proportion to the S&P because Tesla shares, in our view, and by virtually every conventional metric, not only overvalued, but dramatically so. For instance, Tesla trades at 1,325 times the last 12 months PE, and 291 times 2020's estimated, and 175 times the next 12 months. That's not stopping anybody, is it?
No, they're not bound. These younger investors, of which, by the way, Robin is going to get a big valuation, they're not thinking like that, David. They don't care about earnings per share. They don't care about the whisper number. They don't care about what the relationship is for sales. They just believe, all right? And how has their belief rewarded them so far?
Really well.
Well, I rest my case.
Really, really well. Right. In fact, since December 8th, 2018, Tesla is up 808%.
It's created a lot of millionaires, Carl, and people want to be millionaires. It's shocking. They want to be. I mean, I was dealing with someone who's an 18-year-old last night, And the 18-year-old wants to have a very big allocation in Tesla. And I said, why? And the answer was, because it goes higher, stupid. You know, what am I going to do? How do you deal with that? How do you say, well, it can't grow to the sky, and they come back and say, I bought it at 200. What the hell do you know? Why are you keeping me in my chains?
Yeah.
Why are you making it so I can't make money too? That's what I hear.
Yeah, Jim. Of course, Musk yesterday talking to the Wall Street Journal in that live event, talking about the move to Texas and basically reiterating what he said to employees in that memo earlier in the week or last week, and that is cost discipline is going to be the name of the game going forward as we get heightened competition from other players and new models really coming out from others beginning next year.
But you watch NFL football. Do you ever see a Tesla?
I haven't seen one, no.
Sell themselves. 500,000 cars. Maybe if they could make $1 million, maybe they could sell them.
And to your point, the enthusiasm, Jim, is not just confined to Tesla. Take a look at QuantumScape today.
Oh, I'm working on QuantumScape. I'm working on it.
There was potentially, they said, there was some news out, but it's not clear that it was new news. It has to do with the capacity of their batteries and the ability to, during 15 minutes, to charge to 80% capacity. Now, yesterday, there was a press release out from QuantumScape that said their newly released results based on testing of single-layer battery cells shows that solid-state separators are capable of working at very high rates of power, enabling a 15-minute charge to 80% capacity faster than either conventional battery or alternative solid-state approaches. Remember, we had the CEO on when they closed their deal. That was November 12th. They said the same. They said the same thing.
Right. It's a short
almost
squeeze.
identical, Jim, in terms of what they told us in the presentation that accompanied the moment that they actually closed their deal with the SPAC. I'm not clear to me what was new and what was released yesterday.
Well, no. I mean, once again, they used the magic words, though, David. Next generation solid-state batteries. And then you look, it's got a huge, unbelievably good investors. I mean, look at these Volkswagen people they've got. And they've got Stanford University. Anyone from Stanford not become a billionaire? I mean, you go to Stanford, you make a billionaire. It's my backup school. I rejected it. What an idiot. I could have been a billionaire. But you look at these guys, and they're all really fab and thin. The CEO, he worked at Siena. I mean, he's MS Computer Science, David, in Stanford. I want to create a SPAC of SPACs, Carl. Everyone who was computer science at Stanford. I want to give them money, and then I want to go home.
SPAC of SPACs. That wouldn't be a bad idea, actually.
A SPAC of SPACs.
There's going to be an ETF of SPAC of SPACs.
Well, there will be.
Oh,
but
yeah.
Look at these people.
There is
Volkswagen roots, Tesla roots. Carl, I mean, they have everything that you want. And the issue is...
Yeah, but they're repeating press releases,
Well,
basically.
the issue is
they're telling us stuff
news.
and it's saying it's new, and it's not really new.
No, but
it's enough to get QuantumScape stock up 25% at 4 a.m.
It's like cereal. It's new and improved. I mean, but the guys have like $1.5 billion in committed capital, 10 years of R&D investment, 200+ patents, extensive trade secrets. David, these are the buzzwords that matter to the younger investors. And yesterday there was such a short squeeze, Carl, that I know anyone who's now listening to me is going to say, you killed the short squeeze. And then David, they're going to say, David crushed QuantumScape.
Oh, yeah, crushed
Why? Because he mentioned that there's nothing new.
Yeah, we looked at the language they used, and it was unclear. Guys, if we have just 30 seconds, I want to hit an M&A situation. It was reported by Bloomberg. And no, Omnicell? I don't know if you saw that.
Baxter.
Oh, sorry, you did say Baxter.
I was trying to be a little more specific.
Yeah, Baxter. It was reported by both Bloomberg and Reuters late in the day yesterday that Baxter had made an approach to Omnicell. Omnicell, by the way, is a company that provides a range of services that help pharmacies, hospitals, other healthcare providers manage and dispense medication and engage patients to improve their adherence to that. There is definitely some overlap in their business, given, of course, Baxter has drug infusion systems, medication management, dispensing solutions. So you can imagine why. What I can tell you right now is there certainly was conversation between the two CEOs. They did talk, and in fact, there was a hope on the Baxter side that they would lead somewhere. At this point, it doesn't appear to. They got to know. They got to know. Now, they're willing to pay at least $125. People familiar with the situation told me perhaps it would be even a bit more than that. But one thing they're not willing to do at Baxter, Jim, is to go hostile or pursue an unsolicited in the sense of trying to challenge for the board, the window for which, by the way, nominations open up the later part of January. It's a classified board, so it's staggered, but you do have the CEO up during that. But they're not going to do it. They're not going to go that route, I'm told. They're hoping that they can re-engage in dialogue, but they did get a no initially. That may be all it is, simply a no. But again, we can tell you that they were willing to at least go to 125, if not a bit above that. given what they see as a real opportunity here. The company's sales have been hurt this year as a result of the pandemic,
Right.
but are seen going up fairly substantially next year.
So there you go. You got Baxter up because people think Baxter needs it, I guess, and has been maybe not enough hospital work, and you had Omnicell up. I mean, David, what kills a stock?
What bad news sometimes does still.
Does it?
Yeah, sometimes.
Really?
Yeah, really missing earnings in a big way.
Like who?
I don't know. Like when you have a growth rate that's incredible and a multiple that's unbelievable, and you just totally screw a quarter up. But I don't know.
I mean,
Not
it's
much.
just-
Is that your
there's-
point?
well, it's
Not
just-
much. You can't do much.
Well, you
to
know
go
what? The
wrong
people
right
didn't
now.
like the Slack deal.
No, they didn't.
That hurt Salesforce.
What do you think of that $50 billion revenue number he's using for fiscal 26?
Morgan
though?
Stanley's what said it
That's
doesn't move the
Salesforce.
needle, or the guy like slams it. I mean, hey, look at this, Campbell's soup. It's down. I thought it had a good quarter.
You did?
Yeah.
All right. Well, there you go. You see?
There you
There's still
go.
some curiosity.
I thought it was a good quarter. Carl, stocks can go down. Stop trading. What can I say? Now it's going up. Oh, Lord help us, Carl.
I'm trying, guys. We'll take a break. As we said earlier, Tony Xu, DoorDash, going to join us, and then Dwayne Johnson later on today. Got some record highs on the Dow, the S&P, Disney all-time high, 156. Don't go away.
DoorDash pricing at $102 a share last time. It's interesting. Everyone knows what DoorDash is. Valuing the company at $39 billion. Set to begin trading at the NYSE this morning. Here's a treat. Joining us now exclusively, DoorDash co-founder and CEO Tony Xu. Tony, first, congratulations. I know this is a huge deal. And it's not like you were born running big restaurants, but you were in the restaurant business when you started.
Absolutely. It's great to be with you, Jim. You're right. I wasn't born in a big restaurant. I was born really as a son to immigrants who came to this country to make a better life for me. And it's, people like my mom who we started this company for. My mom came to this country, worked 3 jobs a day for 12 years, one of which was at a local Chinese restaurant. And I got to see that a bit washing dishes on the side with her. And so it certainly is a big day for all of us at DoorDash, and it's a huge day for all of the businesses we serve as well.
Tony, I think a lot of people interpret your company as being a delivery company. The woman comes to your door, gives you the package, contactless these days. But actually, you are a DoorDash platform that makes a lot of people money, not just DoorDash.
Absolutely. I mean, DoorDash is a platform whose goal is to grow and to empower local economies. We've been fortunate to have generated tens of billions of dollars of sales for brick and mortar businesses and billions of dollars of incremental earnings opportunities for millions of Dashers. Really, if you think about what we're doing, we're bringing online for the first time many of your favorite local businesses that have never been able to compete in the convenience economy before. And so there's a huge economic transformation underneath all of us, and we're there, right there with them, bring them to the forefront.
Now, I know it's a big day for you. I know that you really own the suburbs and small cities, but you did something I think was really special. I want to mention it because I think these are the things that we in the media have to mention. You introduced a new initiative to support Black-owned businesses on DoorDash. Tell us about that.
Well, DoorDash really is a reflection of all of the local communities that sustain us. And if you think about all of the turbulence that we've seen, certainly not just in this year, but frankly, in the past decade, there's been a lot of change. And I think a lot of issues and topics are now getting the attention that they deserve. I think one of them has always been making sure that there's an equal playing ground for everyone. I've always believed that talent is evenly distributed, but access to opportunities isn't. And whether it's highlighting Black-owned businesses or our Kitchens Without Borders initiative that highlights immigrant restaurateurs for the first time and giving them their shot just like everyone else deserves, that's really what DoorDash is about.
Tony, it's David Faber. A couple of quick questions about just the current environment specific to the pandemic, which obviously has benefited your business. But we've seen a number of your key markets pass what they say are temporary laws to cap your commissions or your marketing fees at 15 or 20% combined. How is that affecting your business right now? Is there a concern, perhaps, that will actually be extended when the pandemic is over? Or are you able to sort of deal with it by passing it along to the consumer?
Well, let me start by saying that just like everyone else, I wish that the pandemic is over or will be over soon. I mean, I truly wish that we would be having this conversation right now inside Jim's restaurant or inside one of the many fantastic local restaurants in this country. So that's really my first priority, making sure with others to bring forth that solution. I think when it comes to merchants, certainly in the 3 decades that I've been observing the restaurant industry, this is one of the most difficult, if not the most difficult obstacle that I've seen restaurants to have to overcome. I mean, it's why, for example, we were the platform that cut 50% of our commissions at the onset of this pandemic, why we built products like Daily Pay so merchants can get their payments every single day because liquidity is king in surviving a crisis. It's also why we built many products so that there wouldn't even be commissions on them, whether it's DoorDash Drive or DoorDash Storefront, so that merchants can create more channels to be able to survive this pandemic. I'm super proud of a lot of the initiatives that we've built in order to allow merchants to have 6 times the odds of surviving the pandemic versus the average restaurant. And for me, it's really about figuring out, how we're going to do that. And how we're going to drive incremental sales. And that's why at DoorDash, we've always been more about making sure that we can help merchants grow out of this pandemic instead of, seeing local officials and elected officials try to suppress the demand that go into these stores.
Yeah. Do you ever see, though, pricing coming down for the restaurants? I mention it because there are a number in my area in New York City that encourage people to come and pick up their food themselves and get a bonus as a result of doing that so they can avoid services like yours because they're so costly for them.
Well, one of the things that we do at DoorDash is we both have a marketplace in which we're bringing in new customers for these restaurants for the first time, generating tens of billions of dollars of activity for them over the past several years that we've been in business. And the other part of what we do is we have a platform where we create products like DoorDash Storefront that gives small businesses an online ordering solution that they can have that direct relationship with their customers. We build products like DoorDash Drive so that they can actually offer same day and on-demand commerce to their own customers, just like we do to ours. I mean, to me, this is about an ecosystem and about an initiative in which we're trying to bring online these businesses. I mean, only 10% of takeout sales in the industry actually happen through a digital connection. 90% of the time, we're still placing phone calls to get takeout orders. We're still driving, to do pickups. Through drive-throughs and the like. And so if you think about what's happening, we're creating a big transformation to help these businesses come online. And there's a cost to doing that. I mean, we invest hundreds of millions of dollars in marketing to generate business for these businesses. We pay billions of dollars to Dashers so that they can receive the incremental work opportunities that they desperately need, especially in times like the one we're in right now. And we also have to pay for payment processing, customer service, and really take care of the end-to-end experience in order to serve these businesses.
Look, when my restaurants are mothballed right now, but as a customer, candidly, of DoorDash, the incremental gains are terrific and needed. One thing is certain, I mean, you're growing, and part of that because at 200%, which is remarkable. It's even faster than Snowflake. But isn't it true, Tony? Some people are going to say, well, they'll never make money. And yet at the same time, if I were in your shoes, I would like to spend as much as I can so that I have the big moat and no one can beat me.
DoorDash has always cared about growth and profitability. I mean, in fact, it's why we revealed in our S1 the cohort economics, I think, that have demonstrated really what the business looks like under the hood. And you're absolutely right, Jim, that we're in the investment phase right now because we're so early into the opportunity. I mean, if you compare this industry with others, 10% of restaurant sales are being delivered today. If you look at e-commerce, they're closer to 20% of total retail sales. And if you look at travel, over 50% of travel sales are now online. So we're playing in one of the biggest yet still most underpenetrated categories in the world. So right now, the time is really to invest.
Tony, a year from now, it seems possible, if not likely, that your sales growth rate is going to slow dramatically given the incredible gains you've had this year because so many people are home using your service. If and when that happens, where are you going to be focusing people on to show that the business is still actually growing significantly? What metrics are you going to rely on to tell the positive story that I would assume you'll be trying to tell, let's call it 6-8 months from now?
Well, I think we have to think about where secular trends tend to go and what tends to happen once habits are formed. Certainly there will always be fluctuations in activity, and obviously with tailwinds, there will be changes to the business. At the same while, if you think about how we behave as consumers, once we get used to a habit, whether it's buying things over the internet, whether it's buying travel tickets now through a mobile app instead of through a phone call, we tend to stick to those habits. And when I think about this business over the long run, that's what we're investing towards. We're investing to add new use cases so that we can keep helping these businesses compete in the convenience economy. We're serving other categories like grocery and convenience so that consumers can get everything inside their city delivered to them in minutes, not hours or days. We're building more products so that merchants can build their own end-to-end tech stack and effectively not have to rely on us, because that's how they're going to make it in the long run. And it's also how we're going to have a great business partnership for the long run. And we're investing in new geographies. So there's a lot of surface area that DoorDash has as a business today. And I think it really reflects a lot of the strong demand that we saw during our IPO process.
Hey, Tony, a little more broadly, big story in New York this morning is this proposal to add a $3 tax on deliveries to help fund the MTA. I know it's packages, but I wonder if you fear that municipalities are going to say this is a big structural shift, it's a cash cow, it's a way for us to save our tax base, and it's going to test consumer price elasticity over time.
Well, I think that governments have a very tough job to do. And I think that, this is why at DoorDash, we care so much about working in concert with them and making sure that we can provide the best solutions for everyone, especially during a pandemic. And to me, when I think about something like commerce, the way that commerce helps grow GDP inside of a city or inside of a country is we have to maximize commerce. That's how we maximize the number of opportunities for everyone. And when we can grow the economy, that's actually how we get past something as difficult as the pandemic.
Tony, I want to thank you so much for coming on Squawk on the Street. Congratulations on your very big day and all you've accomplished at a very young age. Tony Hsu, founder, CEO of DoorDash. Great to see you, sir. Carl.
Good to see you, too.
All right, Jim, we'll await that opening trade. In the meantime, later on next hour, we'll check in with Dwayne Johnson, talk about his new push into the spirits business, talk about competitive, along with, of course, the media landscape for the year to come. That's coming up in the 10 a.m. hour. Don't go away. Jim, we haven't mentioned the Treasury Secretary's $916 billion proposal from last night.
Yes, I spoke to him this morning, and I think it's got something interesting that people should listen to. $600 per child, $600 per adult, $2,400 checks right to you per family for four. And I think that this is something you're going to hear about, and people are going to say, wait a second, how can we not do this? How can we not give the country a holiday present when we are so beaten down and so many people are out of work? Is it the right unemployment figures for the Democrats? No. But keep in mind, a check from the government is something that a lot of people may like, and I think there could be a little bit more of a groundswell over this proposal than others. And I think that's very, very significant and should not be ignored. $600 per child, per adult. People want it. They want it badly,
Yeah, Jim,
Carl.
it does seem like we're zeroing in on direct payments as opposed to state and local or liability insurance. Is that a fair trade?
Yes, that's very true. But I think people should know is that this could be money in their pockets. And I know that there are a lot of issues. I know that the great, though, is the enemy of the good. I think most people in America say it's good to get a paycheck from an additional check from the government to augment their paycheck, or if they've lost their paycheck for no reason whatsoever because of this darn pandemic. What can I say? Secretary Mnuchin this morning.
We're going to watch that. That's one of the sub-themes today. Along with DoorDash, you're going to have a lot to work with tonight.
Well, plus, I mean, talk about something that is hot button. We have Chevron. Mike Wirth. What's a guy going to do during a period when we have a president that is so deeply committed to cutting carbon? Then Kevin Sayer, boy, there is a war over the glucose monitor. Abbott's got a real competitor now with Libre. We got to find out what Kevin Sayer's saying. One of the great performers of this year. I can't wait for tonight. I can't.
That's good. It's going to be excited.
Yeah,
I mean,
Jim.
Look, and then we got Airbnb. I mean, come on, we all use
Airbnb's
DoorDash.
coming.
These are common names. We didn't do AI.
By the way, we didn't do AI. Tom Siebels, I know.
I love Tom.
But the symbol alone should get them a huge pop. How could AI not have been taken?
I don't know, but how about when Frank Slootman told me, because a lot of the younger people like Snowflake. They like the name Snowflake.
I mean, AI, like that should have been go-to for.
Shouldn't have been?
Yeah, so many of these.
Well, what can I say,
So right
David?
there, I mean, they're going to.
Well, back me.
But yeah, we're going to keep an eye on AI too, Carl, this morning. Don't forget about that.
And the Apple
DoorDash,
Supercycle.
Airbnb, and yes, the Apple. And all the Tesla bulls hate us on Twitter, by the way, Jim.
Oh, everybody hates
for
us,
citing
David.
a JP Morgan report that talked about simple valuation, saying we don't.
But
know
Mark
anything.
Benioff loves you.
Mwah.
It's a big love fest, guys. Jim, we'll see you tonight.
Thank you,
Mad
guys.
Money, of course, 6 p.m. Eastern Time. I got some record highs here for the Dow, S&P, NASDAQ, Russell, and the transports. Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan and David Faber. It is all about DoorDash, at least in the opening hours of trade here as we await the open of that fresh issue on the busiest month for IPOs in the country's history. Right now, though, wholesale inventories and jolts. Let's get to Rick Santelli.
Yes, on wholesale inventories, we are expecting up 0.9. We ended up with up 1.1, up 1.1. That is definitely solid on inventories, and it replaces the mid-month read of up 0.9, and it is the best read going all the way back to January of 19 when it was up 1.2. Now, on the sales side, of course, this is the only read for the month of October, and it's up 1.8. 1.8. That is a very healthy number. It's a bit better than expected. In the rear view mirror, the up 0.1 now turns into up 0.4. That's the September final. And finally, for the Moneyball number, job opening and labor turnover, affectionately known as JOLTS, well, it comes in at 6,652,000. So this is the 5th number in a row, 5th month. We're over 6 million. And why is this important? Because this series of data points started in December of 2000, and it took 15 years to reach the 6 million mark. So getting there this quickly is good. 5 in a row, we can do better, but it is a start. Morgan, back to you, and welcome back.
Thank you, Rick Santelli. It's good to see you. Well, let's get to DoorDash, making its public debut on the NYSE, pricing at $102 a share last night. We caught up with CEO Tony Xu in the last hour on the company's big day and the impact of the pandemic to his business.
This is one of the most difficult, if not the most difficult obstacle that I've seen restaurants to have to overcome. I mean, it's why, for example, we were the platform that cut 50% of our commissions at the onset of this pandemic, why we built products like Daily Pay so merchants can get their payments every single day because liquidity is king in surviving a crisis. It's also why we built many products so that there wouldn't even be commissions on them, whether it's DoorDash Drive or DoorDash Storefront, so that merchants can create more channels to be able to survive this pandemic.
Well, let's bring in Bob Pisani and Leslie Picker for more on both this company going public today and also, Bob, I'll start with you, what we're seeing more broadly in the IPO market and just in terms of companies that are going public, whether it's through SPACs or direct listings as well this year. I mean, it's been a gangbusters year, and it certainly is a big crunch in terms of all the companies. DoorDash obviously being the big focus today and Airbnb tomorrow, but all of these companies that are going public before the Christmas holiday comes to us in the next 2 weeks.
If you would have said to me in April, we're going to have the best year for IPOs since 2014, and 2014, remember, was Alibaba, which is why 2014 was so big, I would have laughed at you. But we are, and we are ending on a bang. We've had 202 companies go public this year, raising $73 billion. The record year is 84 when Alibaba came, and that was $85 billion. And I'm not including what's happened at Airbnb. We're going to get close to the record year of $85 billion. So it's really quite remarkable. Today's IPO is the biggest IPO of the year. 3.3 billion raised is the largest amount. Snowflake was very close, but it's the largest amount, and it's number 2 in terms of total market cap. So we're raising 38 billion at DoorDash. We have raised, I think, 42 billion for Snowflake. So this would be number 2 in terms of market cap. This is really a remarkable way to end the year. And as you mentioned, almost the same amount of money has been raised with SPACs as well. So if you put it all together, we've got close north of $130 billion that's been raised between SPACs and between IPOs. That's an enormous amount of money raised in the capital markets. And believe me, the IPO people and the SPAC people, they are just delighted given the potential headwinds that they were facing.
Yeah, and Leslie, I think about the strong year for companies going public for these mature startups in 2019 and the fact that there was money believed to be left on the table by some of these companies in terms of the more traditional IPO pricing models. And it really spurred this debate in Silicon Valley. And that seems to be playing out this week as well, whether it is DoorDash, whether it's Airbnb tomorrow, this idea of hybrid auctions and how that is basically framing the pricing we're seeing for these companies as they come public over the next 24 hours. How does that change things for Wall Street and for this more traditional underwriting process?
It's a great point, Morgan. And I think there was kind of a reflection after 2019, and you saw a bunch of down rounds for companies that raised money privately at a higher valuation, went public at a lower valuation from where they previously financed at. And that caused a lot of people to say, how can we improve this process? How can we improve the pricing process? And then you've also seen deals recently where they've doubled on the first day of trading. They've kind of re-invited this whole debate about pricing too low, leaving money on the table, not maximizing their potential through the IPO fundraise. And so now you're seeing companies really try and improve upon this process. And that's what we saw with DoorDash. And we're seeing something similar with Airbnb this week as well. DoorDash, as you mentioned, is doing a hybrid auction system to figure out their price, to come up with that 102. Now, I was talking to people familiar with the process, and the auction kind of spits out a bunch of information about the demand curve, and then the bankers and the company can kind of come together, and that's where they decided on the 102. It wasn't a pure auction in the sense that they went exactly with what the auction indicated for them to go with, but then also they're doing something unique in the sense that they're not including a green shoe. So Bob mentioned this is the largest IPO of the year. Snowflake is actually bigger when you include its green shoe because it obviously popped on its first day of trading. They were able to sell 15% more stock. DoorDash doesn't have that option. They decided not to go that route. So they don't have that extra 15% that they can sell, which would push them into that #1 spot. But they decided they didn't need it. And as you can tell, these companies, as they're kind of reinventing the IPO process, are doing things in a way that they don't need as much banker attention. If you do an auction, a hybrid auction, you have more of an algorithm tell you different mechanisms about the price as opposed to sales teams within the banks. If you do a green shoe, you don't need, or if you don't have a green shoe, you don't need the banks to basically sell the stock short or sell more of the offering than the actual IPO. And so you're kind of cutting out a bit of their process.
Hey, Bob, you mentioned SPACs, of course. You, Leslie, myself, we've all been covering it so closely because the numbers raised there, as you pointed out, have almost been equal to what's been raised through traditional IPOs. You know, for quite some time, Bob, we were lamenting the fact that many of these companies were going public later in their growth cycle because of the ability in the private markets to raise enough money to sort of continue to grow substantially, only getting to the public markets when a lot of their biggest growth was behind them. But it occurs to me the SPAC model now, particularly some of these early stage companies that we've seen going public, kind of reverses that a bit. Investors are getting an opportunity now in some companies that are even pre-revenue to make their decisions, aren't they?
Yeah. So here's the interesting question. As you know, David, SPACs had a very bad reputation up until a couple of years ago, and that's because Burger King accepted. I think Burger King was a long time ago, but Burger King accepted most SPACs that had floated have been really small cap affairs, and the aftermarket performance has not been good, even compared to IPOs. In the last couple of years, as the profile has lifted, as Chamath Palihapitiya and others have come in, and there's been bigger success with larger ones, the profile has lifted. And I think that the aftermarket performance has improved, but only if you include it in about the last 2 years. So now, as you point out, younger companies might be coming in. So this is good news. We want more companies to go public. We don't want more companies to become middle-aged people before they ever go public. So here is a good question. What will be the aftermarket performance of these SPACs as we have younger and younger companies? Some of the IPO people are very happy. Let them have the younger ones that tend to have underperformance. Maybe that'll improve IPO performance. So good question, David, and we're going to have to watch the aftermarket performance of these names. There's 200 SPACs out there that are looking to buy companies right now. 200.
It's going to keep us busy, especially you, Bob. Thanks for joining us, Bob and Leslie. I'm sure we're going to be hearing from you more throughout the day as DoorDash finally opens for trade. We're keeping our eye on that. In the meantime, Carl, toss it over to you.
Yeah, let's bring in DA Davidson's Tom White, who last week initiated Dash with a buy rating and a target of 93. Tom, it's good to have you. Good morning.
Good morning.
You put the 93 number on when the range was still 75 to 85. What do you do now?
Yeah, so look, they upped the range. We're now priced last night at 102. We're going to have to obviously reassess that. I think the things that would cause us to potentially increase our numbers and potentially our price target is we want to see how the fourth quarter numbers play out. We're about 2/3 of the way through the quarter, a little over that. That's an important factor. Another factor not really contemplated too much in our model is we don't really give the company that much credit just yet for online grocery, online pharmacy, online essentials delivery. Clearly very big market, early for DoorDash. We think that's an area where investors are probably looking to as kind of optionality, if you will, kind of a call option, and probably is helping push the valuation of the stock higher here.
The work you've done in advance kind of pivots around Dash's diversity of customers, right? The mix, large chain versus small chain. Can you talk about that and how it relates to their competitors?
Yeah, so look, I think that the main things I'd point to in the initiation we wrote were, one, focus on their sort of the supply side of their marketplace, their nice breadth and diversity of different merchants. So, there's a lot of focus in this space on large chains and kind of the exposure of the different food delivery platforms to the large chains. The large chains, national franchises, they bring a lot of consumer traffic to the platform, but they tend to carry lower unit economics because those large players are able to negotiate down their commission rates with the food delivery platforms. But you need to have a balance. You need to have a certain kind of percentage or breadth of that type of inventory in your merchant mix, but you don't want to have too much. And our analysis showed that DoorDash is kind of in that sweet spot, it looks like, at least relative to their other two big competitors in the U.S. The other thing I'd point to in the note is we really dig into that cohort data that the customer that DoorDash provided in their S1, and Tony touched on in an earlier segment. A lot of IPO filings that we see from tech companies and internet companies have cohort data, but oftentimes you see that kind of cohorts of customers don't really sort of improve in terms of, the more recent cohorts don't necessarily show the same strength that the earliest original cohorts and the earliest original markets that the company went after show. In DoorDash's case, the more recent cohorts are actually outperforming the earliest initial cohorts, which we think is a really good sign.
Yeah, I mean, it's a key point, especially given the fact that there is so much loyalty lacking, you could say, in the space more broadly, given the fact that it is a fierce competition, which I think kind of begs the question, Tom, can Dash actually achieve sustained profitability?
Yep. So, we've had 2 quarters here of EBITDA profitability, 1 quarter of GAAP net income profitability. Clearly, the pandemic was a tailwind there. When we get a widely deployed vaccine, we do expect competitive intensity to tick up here. I'd point to a couple things, though, that we think point to these guys being able to gradually improve profitability and probably get to 20% plus EBITDA margins here in a reasonable time frame. One, the cohort data that I just referred to really sort of underpins, we think, that roadmap. And a lot of that cohort data, we were seeing the trends even pre-pandemic. So the pandemic sort of supercharged things for DoorDash, but a lot of those trends were established pre-pandemic. Secondly, we've seen a lot of a fair bit of consolidating M&A in this space recently. So Postmates was scooped up by Uber. You've had a merging of Just Eat and Grubhub.
Yeah.
And thirdly, we think actually just the act of DoorDash going public is going to be an important catalyst as well. You're going to have all three of the major online food delivery platforms being public companies operating under the glare of public company investors. You know, last year in the spring, we had a similar kind of analogous situation when Uber and Lyft went public. And, you know, within a couple months there, you just sort of coincidentally had both companies on their earnings calls talking about all of a sudden a moderating kind of competitive intensity in the marketplace. So, you know, we think the DoorDash listing itself is an important catalyst.
That's a great point. Wholesale industries going from the shadows to the spotlight really in the course of a couple of years. Tom, thanks. We'll see what happens today. Tom White.
We got a huge show, and I mean huge, still ahead, including former Allergan CEO Brent Saunders. He, of course, hey, everybody's got a SPAC, don't they? He's got a deal, too, and he'll discuss it, a new billion-dollar deal alongside the CEO of HydraFacial, that's the company. Later, don't miss Dwayne Johnson. Yeah, The Rock, he's going to talk about his tequila brand, Terramana, state of Hollywood, and a lot more. Stay with us. Former Allergan CEO Brent Saunders launched his SPAC Vesper Healthcare back in the fall, and this morning announced it's made a deal to take HydraFacial public. It values that facial treatment company at about $1.1 billion. Joining us now is Brent Saunders, chairman of Vesper Healthcare, and Clint Carnell. He's the CEO of HydraFacial. Thanks to you both, gentlemen. Brent, let me just start with you. You moved very fast here. Give me the confidence that you did the due diligence that was necessary to make sure your SPAC is getting the best deal possible, because you only priced your SPAC a couple of months ago.
That's true, David. But look, you know, I've done a lot of deals over my time. We prioritized about a dozen different options. We signed several NDAs. We did diligence on 5 or 6 of the companies. But I will tell you, from the get-go, HydraFacial was our first choice. And frankly, the day that we cleared the IPO of the SPAC and the lawyers freed us to start engaging with targets, this was my first call. And so I'm so thrilled to be here. I'm so thrilled that we got the deal done. And I'm so excited for the future with HydraFacial.
All right, so why was it your first call?
Well, this is really a category-creating skin health company. And skin is such a huge market. This is a beauty play. And it sits at an intersection of aesthetics and beauty where I think there's just explosive growth. And the brand that Clint and the team at HydraFacial created is a global brand. It's the best-in-class brand, but it's got so much more room for growth. So this is a growth story that can be a platform for future acquisitions and really drive a tremendous amount of value for our shareholders.
I want to come back to that acquisition opportunity, but Clint, let me get to you. The company did about $165 million in revenues in 2019. This has been an off year as a result of the pandemic. What kind of growth rate are you looking for as we normalize, for example, in 2021?
Thanks, David. Yeah, it's been a heck of a year. The company's really been battle tested. And we were affected in April like everyone else. The company's bounced back in Q3, very strong Q4. And we're actually planning for some choppy waters first half of the year, but expecting $180 million next year in revenue with a really nice profitability profile. So we see our market bouncing back very strong. Leads are up. ASPs are strong, and the consumer and our providers are really, really anxious to get back to normal. And we're pleased with the way we've weathered the business.
You know, I wonder, Clint, I know one of your units, I think, is around $27,000 from what I understand. A treatment itself, about $200. What about competition from people who want to have in-home, who just want to do it themselves? You know, I can go online and see things called Trophy Skin and various things that are available, at least, that cost about the same as one treatment from your system. Why isn't that preferable, or at least something that would be a serious competitive threat to you?
Yeah, that's a great question. You know, certainly if we'd had a home device, we would have been excited during this pandemic, but you'll see that coming from us in the future. We work really hard to work with our estheticians in the professional setting so that consumers understand in 3 steps, 30 minutes, they get the best skin of their life from a trained professional. So that's not going away. We work in conjunction with a lot of these home care devices, a lot of skincare devices at home. And so it's really not an or, it's a both or an and. And so we don't see that being a real competitor. We just see it as opportunistic for HydraFacial as we grow the brand.
Yeah, Brent, it's Morgan here. Just to piggyback off of that a little bit more, this idea that this is a market with growth opportunity to it. I mean, how big is this market more broadly, and where do you see, as this deal is being inked right now, where do you see this ultimately expanding? What other types of venues above and beyond facials, which I would imagine is very targeted towards women right now?
Yeah, so Morgan, I'm sorry. So Morgan, this is a huge market. Clint said this once to me, and I'll say it. If you have skin, you're a potential customer. This device and this treatment and experience can live in a doctor's office. It can live in a spa. It lives at retail. We have a partnership with Sephora. And it can actually, as Clint mentioned, it will come to home in the next year or so. And so we can be omni-channel. We can be everywhere. And we frankly have tremendous growth opportunities outside the United States. So there's so much opportunity for growth. It's about being selective and making sure we get the right return on investment as we invest for growth. Right, Clint?
Correct. I mean, a lot of international opportunities. We're still nascent internationally, even though we're in 87 countries. We have delivery system and serum innovation. We also have business innovation. We have a pop-up shop in London right now in partnership with Birchbox. So this has a great professional endorsement and the ability to market directly to the consumer. And that collective group of people we call the HydraFacial Nation. It's a really passionate community of skin enthusiasts, and it's been remarkable and has fueled our growth. And we're in early innings. I'm not sure which inning, but early innings and lots of expansion opportunities.
Well, Brent, you're going to be executive chairman of this company. And again, just for people who may be unfamiliar with the terms here, I mean, you're buying it from private equity. They're rolling, though. They're going to own about 25%, but I would assume they'll sell over time as private equities want to do. You raised a $350 million pipe, some very strong investors there, I might add. But what about you, Brent? Are you going to be a serial SPAC guy, or are you going to be focused on HydraFacial?
No, I'm committed to working with Clint and making HydraFacial the premier beauty health company in the world. And so this is going to be my focus for the next several years. Clint and I are a great team. And we're actually, as you know, David, we're putting $100 million out of the pipe right onto the balance sheet so that we can not only invest in the growth of Hydrofacial, but look for other products to add to the family. So we're really committed to it. We're very serious about it. And this is going to be my focus.
Well, you know your way around M&A, both the joy and the agony of defeat as well. We can go back. We had some interesting conversations.
But I never got to open for The Rock.
No,
so, you know.
That's true. But I wonder, you mentioned it, what is the growth opportunity here via acquisition for this company?
Yeah, this is a highly fragmented market when you look at beauty health. I think Hydrofacial is the preeminent brand in the space. And so as we think about our providers, estheticians, nurses, some physicians, we want to create a bundle of services that are provided by this particular group of folks that could be done in the omni-channel setting, whether it be at retail or med spas or doctor's offices, to service them better than any other company in the world. And Hydrofacial is already doing that. They have the greatest training program for estheticians. They train the most estheticians in the world. And we want to continue that and grow that and really build that loyalty with our provider base.
Well, guys, appreciate it. And good luck to you both. Brent Saunders, Clint as well. Thank you both.
Thanks, guys.
Thank you.
Guys, starting to get some indications on DoorDash, now indicated 125 to 130. Of course, pricing at 102 and the range not long ago, Morgan, 75 to 85. So at least in the early going here, we're seeing some movement.
Yeah, it's pretty incredible to see how much this has climbed in the last couple of days. And what's really an exciting show, I mean, not only for this, but for The Rock, but also just to hear David talking about his research on facials. Really, the cherry on top.
I want to do the research, Morgan. I actually have never had one done, but I'm thinking about it now.
Oh, well, now you have to.
Apparently a lot of dirt comes out of it. Yeah.
We'll leave it there.
All
Now
right.
it's time for our ETF Spotlight. We're taking a look at the ARK Next Generation Internet ETF, ticker ARKW. That's continuing its climb higher, up around 150% this year. One of the main reasons for that surge, Roku. The ETF's second biggest holding, getting a price target increase over at Citi to a street high of $375. That stock is up today, but get this, it's up around 750% over just the last 2 years. And you thought Tesla was the only name that makes moves like that. All right, we're watching the market with record highs, and we're taking a quick break. We'll be right back.
The headlines on stimulus are flying once again as we get some comments from Leader McConnell. Let's get to Elon Moy. Hey, Elon.
Hi, Carl. Well, Senate Majority Leader Mitch McConnell was just speaking on the floor, slamming Democrats for rejecting two offers now from Republicans. One, his own bare bones proposal, as well as that $916 billion offer from the White House. He said that Democrats' response was bizarre and schizophrenic, and he said that Republicans are negotiating while Democrats are only interested in delay and deflection. Now, this all comes as we also have gotten a copy of the detailed summary of that $908 billion bipartisan framework, and it pretty much tracks what we thought was going to be in it. There are no stimulus checks in that, but there is a $300 a week boost in unemployment benefits. It also includes $300 billion for PPP. That's a little bit higher than the initial version of the plan, but it punts on the tough questions of how to disperse the money for state and local governments, as well as a language on liability protections. So, Morgan, given the comments from McConnell that we just heard on the Senate floor, it does not look like we are any closer to compromise at this moment. Back over to you.
Perhaps that's why we're seeing all the major indexes now basically flatline. Elon Moy, thanks for bringing us the latest on that. It's time now for a news update, and for that we go to Sue Herrera. Hey, Sue.
Morning, Morgan. Great to see you. Here's what's happening at this hour, everyone. With the daily count of confirmed U.S. COVID cases now averaging more than 200,000, America's hospitals are filling up. A New York Times data analysis shows a third of the country's population now live in areas where more than 85% of hospital ICU beds are already occupied. And as hospitals fill up, airports are emptying out. The TSA screened just 500,000 passengers yesterday, the lowest number since July 4th, and a 74% drop from the same day last year. In the UK, regulators are now warning that anyone with a significant history of serious allergic reactions should not get the Pfizer-BioNTech vaccine, as they look at two recipients who had adverse reactions yesterday after those mass inoculations began. Both are recovering. And the first shipment of that vaccine arrived in Israel today, with Prime Minister Benjamin Netanyahu on hand for what he is calling a big day of celebration. He plans to get the first shot to show it is safe. You are up to date. I will see you again in an hour. Morgan, I'll send it back to you.
Thank you, Sue. Well, Robert Earl may best be known for founding Planet Hollywood and serving as the chief executive of Hard Rock Cafe, but his latest venture, Virtual Dining Concepts, aims to use existing restaurant kitchens to cook and package food for delivery-only brands. Robert Earl joins us now. Thanks for being with us, certainly on this big day as we see DoorDash get ready to start trading as a public company. I think that's really the place I want to start right now with you. There seems to be this debate in the market about whether DoorDash is sort of seeing the best growth and the greatest opportunity right now that it's going to see, given the fact that it's been a major benefactor of COVID-19, or if this is really just a sign, a shift of a bigger, broader, more secular shift.
I would say the latter. DoorDash and the other companies in that sector are essential for restaurant survival. They've been more critical now as our industry is decimated, but as the future evolves after vaccine and confidence to go back to dining out, they are so important to us because people now are used to having a delivery. They play a very, very important role that can only grow.
So hearing you say that, I mean, Virtual Dining Concepts, your company uses a number of delivery providers, DoorDash, but also Grubhub, Uber Eats, Postmates, Seamless. Who do you like working with the best? And is there room for all of these different players, or do you foresee more consolidation?
They're all fantastic. They all see the marketplace. And the important thing here is that there's been a lot of criticism, wrongly, of the third-party platforms and their exorbitant fees. It's not true. We, as restaurateurs, have to work our business in a way that we utilize our existing labor, and doing that without having extra labor to then use the platforms works economically and still throws off a healthy bottom line. So they are here to stay. I love them all. Today, I love DoorDash. I'm going to try and buy some stock.
At $102 a share right now, are you going to buy at that price, or are you hoping it comes down? Like, what do you think of the valuation?
I'm not in that business.
Fair enough.
I was. But just to talk about what we're doing.
Yep.
All restaurants need more PPP. All restaurants need more landlord forbearance. Generally, landlords have been very supportive, but we're all in trouble with the exclusion of drive-through restaurants and some QSR brands that are delivery. But the greater industry is in big trouble. What do? We have to maximize sales, subdivide sales between more people to dine in when they can, more delivery of our core bricks and mortar brand, and then the new phenomena of virtual brands. Very quickly, a virtual brand is an online delivery brand only. It is the largest, fastest growing sector and will be an enormous component of DoorDash's future as well as their competitors. A virtual brand is where we come in. There are several ways that virtual brands are currently being delivered. There's cloud kitchens, like you've talked about Travis and a company called Kitchen United. There are car park operators like Reef, who are doing excellent jobs, but we have 2 points of difference. First and foremost, we're going to the restaurant industry and saying, here is a ready-made formula for you to become our market partner with your 3-mile exclusive territory. And here's some brands that our company, Virtual Dining Concepts, have created for you. And we give them every single move. They have to just be the distributor, the last mile, and buy the food and packaging. And it will throw off to their bottom line in excess of 30% while still giving all the money necessary for the platforms. And then our other point of difference, I've spent my life in celebrity branding, from Planet Hollywood to Hard Rock to Earl of Sandwich to my partnership with Guy Fieri, all celebrity branding. And I'm applying that thinking now. For example, last week we got 5 billion impressions when we announced Mariah Carey's cookies. 8 great cookie brands, a wonderful frozen cookie dough.
Yeah.
And you, as a local restaurant, can become our partner.
Mariah, okay. Well, I'm not sure why Mariah Carey's cookies appeals to me, Robert, but let me ask you a different question. You mentioned Travis Kalanick, as we were referring to, of course. Last time we saw him actually was Uber's IPO, but he sold largely, if not all of his stake there and put a lot of it into ghost kitchens. What do you think of that as a business model at this point?
I think it's an excellent model. In truth, it is a competitor to restaurants. Some restaurant chains that pre-COVID had a surplus of business were renting those, and other people starting up. It's an inexpensive way to go. I like my model because it's helping the restaurant industry, the existing industry, but there is room for all of them.
Yeah, Robert, and of course you have your hands in so many different aspects of the restaurant industry. We look forward to digging into some of those other pieces of it with you as well at a future date. So please come back and join us again.
I look forward to it. And I'm going to send to the studio so that he can eat his words, the beautiful Mariah's cookies.
Okay, great.
I'll eat them.
CC me on
No
that
doubt I'll eat
packaging
them.
slip, please.
I love cookies. That's all I do is eat cookies. But I'll let you know how they are, Robert. Okay, I promise.
Thanks a lot for having me.
Thank
You're
you,
welcome.
Robert Earl.
Speaking of guests, I mean, we got Dwayne Johnson coming up. Mariah Carey. I don't know if he makes cookies, but he does a lot of stuff, including having his own tequila brand. Of course, we'll talk to him about movies as well. Stay with us.
The future looking rosier with a vaccine close to reality here in the United States. But one top economist says things will get worse before they get better. On tradingnation.cnbc.com. More Squawk on the Street coming up.
If you are watching IPOs today, buckle up. 130 to 135 now, indication on Dash. And at the same time, Morgan, Dow Jones with a headline that probably won't surprise too many. Airbnb expected to price above the $56 to $60 a share range. So it's going to get interesting.
It sure is, and it really speaks to this hybrid auction model that is playing out this week in the market, too, and what that'll mean in terms of the amount of money these companies ultimately raise. Meantime, though, D.C. continues to negotiate a national stimulus package. Some states are taking matters into their own hands, though, and our Rahel Solomon explains that for us. Rahel.
And so for those still out of work due to the pandemic, money is drying up. Nearly every program created to help those who have lost their jobs has either ended months ago or will soon end. So local governments are trying to do what they can. The mayor of D.C. announced this week it's issuing a $1,200 payment to D.C. residents who are on pandemic unemployment assistance. That's coming from its CARES Act funding. Connecticut's governor announced an executive order to help nearly 40,000 residents qualify for lost wages assistance. New Jersey, by the way, also expanded its LWA program. And Pennsylvania is now speeding up the process of backdating claims to make up for those long delays when people initially filed. But the question is, are these measures all just a Band-Aid fix? Well, Elizabeth Pancotti is a policy advisor at Employ America. That's a left-leaning think tank. And she tells us that these are more like stitches, absolutely necessary and very helpful, but it doesn't get at the root problem of the initial giant gash. She tells me that while the effort from states is applaudable, it's really the federal government that has to step up and has to extend and fund these programs. And she says quickly. Carl.
Rahel, thank you very much. When we come back, what else do you need to say? The Rock, Dwayne Johnson, in a moment. The spirits business going through some changes this year as a result of the pandemic, but with some new opportunities. That's where we find our next guest. Hollywood superstar, entrepreneur Dwayne Johnson launched his own tequila brand, Teremana, back in March, and he joins us now. DJ, what a pleasure to have you on CNBC. Thanks for the time. Good to see you.
Carl, thank you, my friend. I appreciate it. It's good to be on. Good morning.
Hey, congratulations for one thing, just on this launch. It's pretty amazing, and I'm kind of digging the friendly battle you've got going with some of your fellow leading men who have launched brands of their own. Just talk about some of the numbers. How much product are you moving? Because it's getting kind of serious here.
Well, we thank you, Carl, for saying that. We did. We launched back in March, and the timing of a launch March was what it was. And as we shut down, we all had to shut down around the world. Obviously, it affected our businesses, large and small. And from that time in March to approximately 9 months later, we wound up moving 300,000 9-liter cases and preparing at the 12-month mark to ship 400,000 cases. So, I mean, honestly, Carl, these numbers are serious, as you said, to say the least. But we've been enjoying the success. Always find that it's nice and important and prudent to pause and enjoy the success a little bit. But the math certainly means that we have to go back to work.
Yeah, it's been called the biggest launch in the history of spirits, which is amazing if in fact that's true. DJ, talk to me about how this came about. Was this a dream that you sort of chased down, or did others come to you? What was the genesis of this?
Well, the genesis of this venture was, I would say, tequila has been in my family for a very long time. I've always been a tequila drinker, an enjoyer, if you will, and, for the good times and the not so good times and everything in between, as I like to say. So it was about 10 years ago that I thought, I think it'd be a good idea for us to go into the spirits business. But again, when you talk about prudency and just pausing a little bit, I wanted to make sure that the timing felt right. I'm a big proponent of listening to your gut and your instinct. And I just wanted to take my time, do it right, surround myself with the best partners, the best distribution partners, for example, Southern Glazer, Mass Jägermeister. And we wound up partnering up with, I had 3 other co-founders, Danny Garcia, Ken Austin, and Jenna Fagnan. And about 3 to 4 years ago, we decided to put our best foot forward and start to put all the pieces together. Now, since then, Carl, I got to tell you, when we talk about these numbers, and we kind of breeze by it, but I do want to take a moment to acknowledge the numbers and what those numbers mean. And as I am learning on the go, baptism by fire, and I like to say that, as I'm learning, we're rolling down the road and paving the road at the same time. But, these numbers are pretty spectacular. And when you look at the numbers contextually, when you look at these numbers, for example, a buddy of mine who we all know, George Clooney, there was a big splashy acquisition when Diageo came in and purchased Casamigos, I think for $1 billion+. They were running approximately 175,000 9-liter cases. In less than a year, we're at 300,000. So the math is pretty bonkers and what that means. So, maybe there'll be a nice high-dollar event down the road, but as of now, we'll just continue to roll even more and continue to go to work. So, and again, to get back to the genesis of it, we decided to launch in March, and then here we are. And it has been a real learning experience for me, but also one that's really extremely gratifying because this is a legacy play. I am a celebrity, of course, so you can't get away from it. It's a celebrity brand at first as we come out of the gates. But ideally, I'd like to, not only is this a generational play for me, legacy brand, a legacy build is, ideally, I'd like to get it to the point where the brand can live on its own without me. And again, we can't get away from me being a celebrity, but eventually I'd like to get to a point where the brand can live on its own. I always like to say I could come in and give something to jet fuel, and then I could eventually, hopefully, back off. And then if I am able to back off and the brand live on its own, then we've done our job.
Right. Help our viewers understand, Dwayne, what it is about spirits that draws entrepreneurs, celebrities like yourself, because production is not easy, as you obviously well know. Distribution is completely cutthroat. I mean, you could do apparel, you could do restaurants, travel, you could go into banking. I mean, VC. What's the draw here? It seems like it looks like fun, but it looks hard.
Carl, it's an extremely hard business to not only break through and get into, but also it's extremely hard to make it. It is a cutthroat business. I came from a cutthroat business in the world of professional wrestling, so I'm certainly used to it. But there's also the upside, and I think that upside, aside from the dollars, if you're lucky enough and fortunate enough to surround yourself with a good team and find a little bit of success, there's also an upside to it. And I think when you approach a venture like this, truthfully, as I do all the things that I do and all the initiatives, with audience first and consumer first, and doing everything you can to improve their day in some little way. So what I have found is, with spirits, always what spirits represented to me, and again, like I said at the top of the interview, was you look for moments where you can find the silver lining in some tough times. There was a time where, I wasn't always dressed in somewhat of a nice shirt. Times were pretty tough. So during those times, I would find a moment with my family and with my friends and loved ones to give a toast to the silver linings and what that meant. So for me, there was an emotion. I can't speak for the other entrepreneurs and businessmen that get into the industry, but there was an emotional connection for me, because I thought if I could create and produce something that gave me the same feeling, that gave the consumers the same feeling that it gave me, and again, toasting to the good, the not so good, and everything in between, then I think we got a shot.
Yeah, well, I think everybody knows what you mean about improving your day, especially in the wake of this year. I mean, Friday nights, there's no question, man. There's nothing like pouring a glass. I do want to ask you, when you launched in March, you had no way of knowing how spirit sales would take off through the rest of the year. And next year, I imagine the comps are going to be kind of tough, or maybe not. I don't know. Maybe this is part of a secular change, and we're just going to build on this as an industry year after year after year.
Well, as you and I talk now, the overall spirits industry is up nicely. I think at about 17%. The tequila category, I think, is indexing really nicely at about 50%. So it's doing very well. So the category of tequila is doing very well in spirits. Overall, spirits is seeing a nice plus. But I also think, when we did launch back in March, Carl, not only was there no way of knowing what our sales were going to look like, I was anticipating that we were going to take a real kick in the gut. And quite frankly, we did as we started to open, because we opened during March when COVID hit our shores. So I felt at that time the best thing for myself and our partners to do was just to remain steadfast. And also, I think what can attribute to our success was not moving forward in any way at that time. And as we got through the summer, trying to put together a traditional marketing and publicity campaign that felt polished, that felt produced. We put all that to the side, and I thought, well, and I've always felt over the years, whether it be movies or television shows or certainly this or anything else that I do, I never want to feel like I'm marketing to the consumer, but rather having a relationship. And I really leaned into that, Carl, back in March. And what I mean by that is we had no traditional marketing or publicity. And I just utilized a social media platform that I had. And I thought, once a week, here's what we're going to do. We have no idea what the sales are going to look like. In all likelihood, we're going to take a real hit here, because what we found is while the off-premise business was doing very well, obviously the on-premise business really took a hit. I can't wait for the restaurants and bars to come back and us to help them in a really strong way. But the off-premise business, you would think, oh, well, we're going to do great. As long as you're in a liquor store, you're going to be fantastic. But the truth is, the consumers at that time, and it makes sense, it's human nature. When they went into the liquor stores, they only wanted what they were familiar with and what made them feel good, what they've been drinking for a very, very long time. For us to go in and try and pierce that behavior was tough. Now, what I did every week was I had Terramana Tuesday. While we were locked down in quarantine, I broke out the bottle of Terramana, and I'm fortunate I have a pretty decent following on social media, and I was able to pop out the bottle. It's pretty decent. I pop open the bottle and I say, let's do this together. Here's what we're looking at as a family. Here's how we're getting through it. And by the way, my entire family had COVID, so we understand the real effects and impact of that. My wife had it, my little children had it. So from that and having this relationship with the audience from March until now, I mean, what we found is an explosion of a personal connection and audiences and consumers rather going out and saying, I got to try this Teremana. And I always say I could get the consumers to the dance one time, but once we get into the dance, the music is right, the feeling, the tone, the temperament, and then here we are.
So Dwayne, before I can't let you go without one question on Hollywood, which is going through its own changes, and you've got so much dropping next year. Jungle Cruise is on deck, Young Rock. How are you managing the balance between producing and starring, TV versus film, that kind of thing?
I'm managing it by always surrounding myself with the right team and the right people. That's always the key. You know, while I may be forward-facing publicly and while my face may get the headlines and name get the headlines, the truth is behind me there is just such an incredible team of partners that I have who make the whole ship go. I always like to say that my business partner is Danny Garcia, and the team that she puts around me, they're the ones responsible for building a spaceship, and I just get in and fly that sucker. And, you know, in terms of Hollywood right now, there's some, as we know, there's some fragility right now and some uncertainty in Hollywood with our theatrical partners, which we have to protect, and that relationship and that experience, but also making sure that we have our finger on the pulse of the consumer, because they are our number one boss, my number one boss, besides my wife and my little girls. And we want to make sure that we are taking care of them too, and making sure that we're really paying attention to where they want to consume the content and where they feel confident and not confident going. So you did mention Jungle Cruise. Well, let me back up really quickly. I know we have to wrap this up. We have Young Rock coming out for NBC, which I'm excited about. You know, I grew up in a Forrest Gumpian kind of lifestyle, wild world of professional wrestling, and this is a look back on my really wild life. So it's just, it's true. When you look back, it's truly, Carl, amazing that I'm actually sitting here with you today. It doesn't get lost on me, so I'm so grateful about that. I do want to bring up Jungle Cruise. It's a big movie based on the iconic ride at Disney. We've worked on this for over 5 years now. Very excited about it. It comes out this summer. And I'm also excited to share with our viewers that when you were 20 years old, you're going to hate me for this. I'm going to get a text from you, but when you were 20, you worked on the Jungle Cruise ride at Magic Kingdom. Is that right?
It is true. It was a long time ago, man. But something tells me from seeing the footage that your ride was a lot different than mine.
It was, but that's okay because here we are today.
DJ, I hope you'll come back. We got so much to get to that we didn't have time for today. We'll talk about financial literacy. I know you're a big advocate with Acorns, which CNBC is as well. And and congrats on Teremana again.
Well, thank you so much. We'll come back and talk Acorns, come back and talk business and all the other cool stuff and cool fun stuff we have. I look forward to it. Thank you. Thank your viewers. And on behalf of Teremana, thank you for that support. Thank you.
Dwayne Johnson, thanks so much. Good morning, everybody. It's time for Squawk Alley. It's 10 a.m., 11 a.m. at DoorDash headquarters. It's 11 a.m. on Wall Street, and Squawk Alley is live.
It certainly is a big day for all of us at DoorDash, and it's a huge day for all of the businesses we serve as well.
Good Wednesday morning. Welcome to Squawk Alley. I am John Fort with Carl Quintanilla and Deirdre Bosa. We are awaiting the opening trade for DoorDash as we kick off a big week for public debuts here on Squawk Alley. Latest indications on DoorDash, by the way, 145 to 150. Wow. We're also expecting C3 AI today, the latest company from billionaire and Siebel Systems co-founder Tom Siebel. We'll talk to him a little bit later. Airbnb expected tomorrow. But Deirdre, where DoorDash is indicating we're getting toward the $50 billion market cap range, which I've got to admit, I've been hard on SoftBank lately and the SoftBank thesis, but they bet pretty big on this name, and that combined with a reversal in Uber's fortunes means SoftBank is looking okay for 2020 right about now.
Yeah, pretty big win for the Vision Fund, which we know has had a number of flops, John. It's interesting because at SoftBank, the biggest investor in DoorDash only invested in 2018, so a late-stage growth round set to reap billions. But, you know, I spoke to Tony Xu earlier today also, and he said that you can't give all the credit to SoftBank. They were growing before, and, you know, there's this question that we have, especially when it comes to these gig economy companies. Can capital be used as a weapon? I think what we're learning with DoorDash, especially after seeing its S1, is that in the right hands, perhaps not a weapon, but a really important tool. I know that, John, we were talking earlier about this. We were looking through the S1 again and its cash position. The company has raised about $3 billion in total in its history as a private company. And as of September 30th, it still had I believe about $1.6 billion in cash, so it hadn't even burned through half of that, and that makes it so different from some of the other players in this space. I'm pointing to Uber Eats in particular, which burned through more than $5 billion total, Uber as a whole this year, and that's perhaps why we are seeing this indicated range of 145 to 150, a nearly $50 billion market cap when it was last valued, Carl, at $16 billion in the private market just a few months ago.
Indeed, and that $3.5 billion raise is going to be the highest of the year, Dee. And as John, as we look at some of these headlines on Airbnb, also looking to price above the range, according to the tape this morning, I mean, it just puts into perspective the money raised this year, $70+ billion. You got to go back, 2014 to see a number anywhere close to it.
That's right. And Carl, let's get to our next guest on this because he is an early investor in both DoorDash and Airbnb, and he holds a seat on the board for each company as well. Sequoia partner Alfred Lin joins us live. Alfred, good morning, and thanks for being with us today.
Good morning, Deirdre. Thanks for having me on the show.
And I should say this week, it is a very big week for you to see DoorDash go public today and Airbnb tomorrow. We're going to get to Airbnb in a second. But first, you know, you were approached to invest in DoorDash's seed round. You passed. When they came around again for the Series A, you said, okay, now's the time. So what changed, I wonder? What did you see in Tony Xu and the company in that second time that you didn't necessarily see when they were raising their seed round?
Well, I got to know Tony over a long period of time between the seed and the Series A. We met almost every 3 months or so, and I just learned his maniacal focus on serving the merchants. He was very, very focused from the start that he's building a merchant-first business. He's going to focus on the restaurant, providing services for them. And he believed that where everybody else was focused on the cities, he's going to go after the suburbs and focusing on the suburbs where there was high demand, but not a lot of supply. And he was maniacal about focusing on unit economics and customer retention. And those were those set him apart from the other competitors that we actually all sort of saw their pitches earlier on. And it's really a testament to Tony and the team that they came from behind. We had seen Grubhub, we had seen Postmates, we had seen Caviar come through our offices, and we waited until we found the right founder with both a very strategic mind to think differently than others and execute at a very maniacal pace. And now you see the sort of results today.
Right, we were talking a little bit about this earlier, but back in 2018 when they got that big injection from SoftBank, they were actually far behind Grubhub and Uber in terms of market share. And I'm told by one source that they were actually a few months away of running out of money. So how much of a difference did that investment make? Was that really an inflection point in 2018 when SoftBank stepped in with a huge check?
Well, we've partnered with SoftBank in a variety of companies, and we have good working relationships with them at DoorDash, at our gardens, at Cookie City, and I think the sort of it's an and capital is fuel for businesses, and you need fuel. You need sufficient fuel. You want enough fuel to fight a ground war if you have one. You need to be aware of the competitive environment. But at the end of the day, the real weapon is your business model and having superior business economics, having a differentiated strategy. And that's what DoorDash had from the start. And I'm proud to have been an early shareholder, an early investor, but an early partner with Tony and the rest of the DoorDash team on helping shape that strategy and helping shape the sort of focus on the inputs rather than focus on the outputs. Tony loves talking about the line from Bill Walsh that the score will take care of itself. And he was always maniacally focused on the inputs.
And Alfred, good morning. It's John Fort. I want you to maybe give us some insight into how DoorDash is different. I actually met Tony back in 2018 around the time of that round and was struck by his focus on data, his discipline, and it just looks like the reputation there is that they're better for merchants than Uber Eats, but also they're burning through so much less cash, and they've caught up and surpassed a public company. None of that should be possible. So how has he done it?
Well, at Sequoia, we have a line that says anything is possible. We wouldn't be in the venture capital business if we thought that dominant players will always be dominant. And so we always look for daring founders that are and love partnering with them from the start. In certain cases, a few people and an idea in their proverbial garage, and very, very focused on being both better and different than what already exists. And I think DoorDash has always said that they're going to be different from a variety of dimensions. Back to, we're going to be merchant first. We're going to provide services for merchants that they couldn't get elsewhere. And in a variety of situations, they're bringing them online faster than ever before, providing services that they didn't have and access to customers that they didn't have before. They're focused on the customer from the standpoint of providing them more selection than anyone else. And they had a differentiated strategy of focusing on the suburbs, where everybody was focused on the cities.
Yeah, so Alfred, for investors who might not see this beyond the consumer perspective of, well, there's an Uber Eats app and there's a Grubhub app and there's a DoorDash app, they don't see the differentiation. Explain where you see the growth potential, whether it's in what DoorDash is doing with Walgreens and with drugstores and delivery beyond just basic restaurant food, whether it's in international possibilities. How do you expect DoorDash to approach that, and how does that affect growth and profitability?
Sure. In terms of like where growth will come from in the future, Act One is still food delivery. They might be the dominant market share leader, 50% market share. That's all great, but the amount that they sort of have sort of consolidated into food delivery is a small fraction of how much is spent in restaurants. So there's still more room to grow just in food delivery. And then if you read the S1 and Tony's founder letter, it's very, very clear that he has aspirations of powering local economies, not just restaurants. And so you see these moves into DoorDash Drive, into convenience, into other categories, because as he said in the founder's letter, if we build a delivery network that can deliver ice cream before it melts or pizza before it gets cold, we should be able to deliver almost anything within a period of time that is good for the customer.
Indication now 150, 155, Alfred, as we continue to see that number go higher. I'm not sure how constructive it is, but I wonder, had the pandemic not happened at all, how would our conversation regarding Dash be any different today? Would we be talking about going public today?
Well, I think I don't want to speculate on what could or could not have happened in sort of, we don't live in alternate realities. We live in our reality, and we're in this reality. I would say that great companies always have the ability to go public. DoorDash, Airbnb, Snowflake, Sumo Logic, Unity, all of these companies had plans to go public in 2020. And so the public markets are always open for great companies. They might have slowed things down during March or April, where they had to be hyper vigilant and hyper focused on how the world has changed and what they're going to do to navigate through that. But if you're maniacally focused on that and get out of that situation and you have a great business, what we're seeing today and what we're seeing in the past and what I believe we'll see in the future is that capital accrues to great companies and to the winners.
Yeah, that's one of the beauties of our system. So you see this as much more, and I don't mean to belabor the pandemic point, but you see it as more than a pull forward, which does explain a lot of shifts in consumer activity this year. But you think the picture is larger than that?
I do think so. I think the pandemic has obviously pulled certain things forward. In terms of, we love the line that at Sequoia that the pandemic has actually pulled forward the future that Silicon Valley is trying to build. And we spent a lot of time online. I don't think we're going to go back to the way we were before. We're not going to stay as much as we love Zoom. I love the efficiency of doing business and having these interviews over Zoom. I like to go see my family. I like to hug my friends. I think we'll go back to a more hybrid world, and this kind of behavior is sticky. People are finding new restaurants they love on DoorDash. Restaurants are finding that this element of being online is powerful for their business model. And I don't think we're going to go back to the way everything was before. I think the world will change and will change permanently.
Alfred, before we let you go, we have to ask you about Airbnb as well. And we're seeing headlines that it's expected to price above its range, giving it an initial market cap of more than $40 billion. But it's been affected by the pandemic in a very different way. Gross bookings declined, though they have proved very resilient. It's been in a very different mode this year, not investment, but cost cutting. Brian Chesky and his team cut about a quarter of their staff. How does that position themselves going forward when the economy does recover and perhaps people do want to go back to hotels and travel by planes?
Well, I think with Airbnb, if you are a travel company that can survive the pandemic and show that your business is both resilient and can turn on a dime, I think the future of travel can be very, very different than what we imagined in the past. I think we now know that we can work from anywhere, we can study from anywhere. I think Airbnb is more relevant today than ever before. Its use case is more relevant than ever before. So I'll just leave it at that.
Okay, and last question on Airbnb relates to its China business. As a public company, it's going to be under more scrutiny, particularly from ESG investors. And they've already been under some heat, at least reportedly internally, over its China strategy. How does the company navigate that as a public one?
I think they'll have, just like in every situation, they have to focus on both working with regulators and understanding what their customers want. And they've always been done right by all of their stakeholders. They have stakeholders among the guests, their hosts, their employees, their communities, as well as their shareholders. And they've been very, very good at balancing all of those.
Alfred, thank you for being with us today. We appreciate it. Alfred Lin.
Thank you for your time.
Carl, over to you.
Bye.
All right. As we said, the latest indications that we're getting, take a look at the post where we would normally, in a normal world, be right next to 155 to 160, awaiting the opening trade. Don't go anywhere.
You are looking at indications here for DoorDash, priced at 102 a share. Indications to open between 155 and 160. Wow, talk about delivery. We'll be right back. Got some big stock debuts happening today, including at the New York Stock Exchange. C3 AI, which has nearly doubled on its own indications. That company, backed by the likes of Microsoft and Koch Industries, run by Tom Siebel, who is no stranger to viewers of Squawk Alley and followers of technology. Tom, good morning. Indications now, I believe, are between 78 and $81 a share, priced at 42. I see the stocks certificates, I believe, on the wall behind you. You've been at Oracle. You sold Siebel Systems to Oracle 15 years ago for just shy of $6 billion. If C3 AI opens at these levels, its market cap will be around $8 billion. Talk about the significance of all this.
Well, you know, the markets will do what the market will do. I think this is a financing event for C3 to enable us to meet the needs of rapidly expanding demand for what we do. It's good that the markets are open again, and we're very pleased to be able to participate. I think this is a great testament to the work that the employees of C3 have done in the last decade. And now we're ready to expand this business at global scale.
Tom, we were talking on Squawk Alley toward the beginning of this pandemic about the challenge that it presented to Silicon Valley, to innovation. Did you think at that time that there was any way that you would be doing an IPO this year? And what have you seen from your peers and investors in Silicon Valley that allows this to come to pass?
Yeah, John, I remember the conversation very well, and no way, no how. If we look back at February, March, April, I thought capital markets would be closed for a long time, like the recessions that we saw in 1980, 1990, 2008. I thought this is something that would last for some years, but nobody could have anticipated the extent of fiscal and monetary stimulus that turned this around, and the PPP program, that turned this around. And so we get into June, July, August, and everything is just blowing and going, and markets are open, particularly as it relates to technology stocks related to distance work, digital transformation, artificial intelligence, and that just happens to be our neighborhood.
As long as we're comparing eras or epochs, and this has been talked about for a while now. How is this different from late 90s, early 2000s? Are there any warning flags or signals that you at least are thinking about?
Well, I think there's no similarity, really. I mean, if you think about Oracle went public in 1986 off of trailing revenues of $12 million. Siebel Systems went public in 1996 off of trailing revenues of, I think, $8 million. Today, we see companies going off, where trailing revenues are an order of magnitude larger than that. So it's an entirely different game. And these companies are generating cash. These are companies like C3.ai that I believe is a structurally profitable, structurally cash positive business. And, we didn't have the we didn't have the activity of, monetary policy like we do today that clearly changes everything.
Hey, Tom, it's Deirdre. Also, I just want to note that the indicated range now is $81 to $84 per share. As you talk about the differences, something else that we spent a lot of time talking about this year that's been different is sort of the role of the younger retail so-called Robinhood investor that are very interested in next generation technologies like artificial intelligence. How do you see them playing into the value proposition, sort of the share price going forward?
It's a phenomenon. It's a great question, Deirdre. It's a phenomenon that I don't understand, this new kind of COVID retail market. I hope these people are being careful, and I hope they're being cautious, and I hope they don't get hurt. But I say it's not something that I understand. I'm just not an expert at it.
Tom, finally, differentiation. Lots of people are talking about AI. You've got it in your name. I visited you at your office. We've talked through the technology. I know that you guys are serious about AI and delivering real differentiation. You've got military level contracts as well. What should investors know about the difference between talking about AI and having fundamental technology that matters?
There are many successful companies in this space that play in AI. Companies like Databricks and DataStax and Snowflake and DataRobot and H2O and what have you. If you take the union of the capability that is offered by all of these companies, Palantir would be one. This is what we've done in 1,000-person years of software engineering in the C3 AI suite. So the union of that functionality in one cohesive software suite that is an end-to-end solution that enables companies to rapidly design, deliver, provision, and deploy exceptionally high-value enterprise AI applications to substantial social and economic benefit. So it is the only pure play enterprise AI play in the market today. That's C3 AI.
All right. Tom Siebel, we are awaiting the first trade in C3. A lot of people probably don't know this, but at your desk, behind your desk, there's a picture of an elephant. Some years back, you were trampled by an elephant, almost killed. I'll tell people he's turning his camera off. He was. So Tom Siebel knows a comeback. Oh, you're still there. And you're still here.
I just pointed the camera at the elephant.
You showed us the elephant. Yes, you were trampled within literally an inch of your life, told you would never walk again. You are walking. You're running a company that's about to go public, worth billions of dollars on the stock exchange. Don't count Tom Siebel out. Tom, thank you.
John, that's an incredible story. Some very good character stories behind today's IPO. Speaking of another one of them, latest indications on Dash 160 to 165 after pricing at $102. That opening trade now 165 to 170, excuse me. Opening trade is just moments away, so do stay with us.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC News update at this hour. YouTube announcing it will now take down all content that alleges widespread fraud changed the outcome of the presidential election. YouTube says it made the decision following a key election deadline and a sufficient number of states certifying their results. In West Virginia, an explosion at a chemical plant injured 4 people and rattled homes for miles. Authorities briefly imposed a shelter-in-place order before giving the all-clear signal this morning. In Singapore, a cruise to nowhere was cut short after a passenger tested positive for COVID-19. Roughly 28 passengers and crew were on board that ship. And in Kenya, floodwaters trapped 8 giraffes on an island in the middle of a lake, putting them in danger of drowning. But rescuers used a custom barge to move them to safety about 4 miles away to an animal sanctuary. A very big rescue effort there. That's the news update this hour. Carl, I'll send it back to you.
No, there's nothing better than an animal rescue. Thank you, Sue. Sue Herrera. We continue to watch for the latest indications on DoorDash. There's a look at the Post. Now 165 to 170. Joining us with more on the debut and ahead of Airbnb going public tomorrow is Kindred Ventures co-founder Kanye Macabella. Kanye, welcome back. Good to see you.
Good to see you again, Carl.
You know, there's an old cliche that people in the cities, the big cities, end up saying about a business model, well, how's it going to play in Peoria? And your general point about Dash, at least, is that they actually kind of started in Peoria, not literally, but figuratively.
They actually literally started in Palo Alto at Oren's hummus shop. And one of the pieces of genius about this strategy was everybody thought you need high density locations to be able to build a marketplace of their type. And they said, well, what if a high density location is actually a suburb, but nobody's been thinking of it as such? And they've since been able to do that in the Bay Area, in New York, in Los Angeles, and obviously all over the United States. It's been amazing to watch.
So we just talked about that element with Sequoia a few moments ago, but in general, you think investors are still not understanding the model as it's being put forth today?
Yeah, absolutely. So the thing about marketplaces, especially a three-sided marketplace, which is what DoorDash is because it has merchants and drivers and customers, is that you need to generate liquidity, first of all. And what that means is supply has to drive demand, which has to drive supply, and you always need to be tweaking those. And what DoorDash did brilliantly was if you look at the very earliest cohorts, started by subsidizing that marketplace to get to liquidity. But as those cohorts aged, all of a sudden they started to become profitable. And so when you look at a marketplace like DoorDash, it's really, really important to understand the cohorts and to age the base. Because as you age the base, then you start to see that it's actually a contribution profitable business on the oldest cohorts. And so if you look forward into time, that's actually really bullish for the company.
Kanye, I love that you started this interview mentioning Oren's Hummus. That is a One Market Bureau favorite, by the way, in San Francisco. Let me ask you about the business model. The three-sided platform has come under a lot of scrutiny, especially in public markets. Some investors think that it simply doesn't work. It leads to a race to the bottom. So how do you think that DoorDash going public at this market cap, the indicative range 165 to 170, it just keeps climbing this morning, how might that change their minds or might not?
Well, there's a couple of features that are important to understand about three-sided markets, but particularly about food delivery. People forget, but Domino's has seen 50x growth over the last 10 years. It's one of the best growth stocks in the business, and delivery is one of the cornerstones of that business. Grubhub Seamless was able to prove, even before the Just Eat acquisition, that it could actually be a profitable company producing net income. And so to suggest that a food delivery business isn't a good business model actually just belies the history of it. And so what I think a lot of people are thinking, and to Carl's opening comments, is, well, in a city, if you think about a courier, you have to imagine that there's so little margin there, it's really hard to build a business on top of that. But there is net income, but you have to be really operationally disciplined, which is what Tony and the team at DoorDash have eminently proved over the last couple of years.
Kanye, if my math is right, this priced at around 102. It's now indicated between 165 and 170, talking about DoorDash here, which we're still awaiting an open on. That puts its market cap potentially at around $65 billion. Other techs that are around that level, Spotify, VMware, Autodesk, Uber is at 95. Is that justified? And if so, does the Uber investor, does Uber the company need to worry because the level of discipline that DoorDash has shown in its operations and the scale of its local ambition would seem to be running right into Uber?
Well, you'll note that Uber this year had one of the first sort of important moments where Uber Eats actually eclipsed Uber Rides. And so if you just think about the $95 billion market cap for Uber and then realize the fact that Eats has been competing with Rides, if not bigger, and that DoorDash is actually now the market leader, the math actually doesn't stretch the imagination that far. First of all. Second of all, it's really important to look at the growth of the food delivery business over the last 4 years, and especially outside of the non-tier one cities, where the growth has been, again, 100% on an order year over year, including and especially in 2020. And so there's an amazing amount of growth in this sector. There's an amazing amount of learning that's happening from all the players. And there's a fair amount of consolidation that started with Caviar and DoorDash, Grubhub and Just Eat, Uber and Postmates, which were in the prior Kindred portfolio, and that's going to continue to happen. And so I think that what we're starting to see is a maturation of the space as this next generation of companies get into market.
Okay, so I want to mention the indication has just gone up again while you were talking, 170 to 175 now. For investors who want to maintain some kind of discipline. Jim Cramer said, don't buy this thing over $100. Who knows if anybody's ever going to buy it if they listen to that. Maybe they shouldn't, I don't know. But if you're an investor who's looking at what needs to happen for this valuation to be justified, do you prioritize seeing them do international expansion? Do you prioritize engagements like they have with Walgreens, where they're delivering more than just things from restaurants? Are you looking at cash flow? What?
Well, as Alfred actually mentioned earlier in the segment, and as the S1 itself says, Act 1 is food, and there are multiple acts. And the truth is, and Uber actually was able to prove this, once you build a logistic delivery network, you can start to apply it to different types of transactable freight. And so I actually personally tend to believe that these delivery networks that are logistic powered by these couriers are actually going to start to deliver more and more valuable goods on demand in real time with more convenience to the end consumer. And if you think about it that way, then the food delivery market, which is still on the order of 400 billion, suddenly is actually just the first act of the market that we're looking into. And so there is actually a bullish case on the broader market itself, if you just think about the technology and what it is going to enable for consumer behavior.
Kanye, DoorDash and Airbnb have had very different pandemic stories, but it feels like similar measures of hype and anticipation for their listings, seeing headlines that Airbnb reportedly raised its price range for its listing tomorrow. When you're talking about next acts, what do you see as Airbnb's next act? Is that experiences? Is it real estate? What's going to get investors excited tomorrow?
You know, my favorite thing about Airbnb is that a lot of people think of it as a vacation rental business, which is a $90 billion market. And I actually think it's actually not. I actually think that Airbnb is actually a cultural marker for what's happening in our economy more broadly. And COVID actually is pulling that forward. And where it's pulling it forward is on three major factors. First is the rise of the rental of a home. More and more people are renting than buying. There's all sorts of inputs as to why, but the asset-light mode of engaging with homes is on the rise. Two, remote work, a global and absolutely massive trend, and the genie's not going back in the bottle on remote work. It's just not. And then the third is it probably has the largest and most valuable supply pool of any marketplace in the history of the internet, which is the world's homes. That's a $9 trillion market. And so when I'm thinking about whether or not, when I'm thinking about whether or not there's a case to be bullish for those three factors playing into a market leader like Airbnb, which, by the way, and this is really important to note, Airbnb is an organic company in terms of its acquisition for the most part. People don't, Airbnb is not something that you click through via Instagram. You say, I want to book an Airbnb, and you go find one. And that's been, again, 80% plus of their demand gen in this first act. And so I think this first act, frankly, has so much more leg on it.
Yeah, I love both of those takes. That's fascinating, Kanye. Finally, you started out talking about Orange Hummus. Axios today did say that DoorDash originally wanted to ring the bell from their first restaurant partner, but had to scrap it due to the pandemic. It does sort of remind you that all of these things are being done in the midst of this pandemic, and that says something in and of itself.
Yeah, somebody said in the venture capital business that 2020 might be looked back on as the first year of the 21st century. And I can't help but feel that some of the digitization that we've all been watching and that we've all been walking into in sort of fretting, fits and starts is actually now just coming full bore. And so while we're going to go back to seeing our families, we're going to go back to restaurants and bars, we're going to go back to an in-person life, what we're certainly not going to do is leave behind the incredible digitization that's happened. And that even includes IPOs and where you're going to be listed. So.
Kanye Macabella, thank you. Great to see you.
Always a pleasure. Thank you.
As we head to break, check out the latest indications on Dash 170 to 175. That opening trade is just moments away, so stay with us. We're back in 2.
I grew up, fairly poor, and so my family didn't necessarily have the means to get me a tutor to learn English. But I learned English by doing two things. I played a lot of basketball, and that was one way I learned English. And the other way was actually just by watching TV, and that's how I came up with my name. So, I watched a lot of Tony Danza, Who's the Boss, growing up. And when I found out that nobody could pronounce my name, which is Xu Xing in Chinese, fairly difficult for a lot of my classmates to pronounce at the time, I went with my dad to the immigration office to change my name to Tony.
Well, that's DoorDash co-founder and CEO Tony Xu with me on Fort Knox back in March 2018. Who's the boss of the IPO market today? Well, it looks like it's going to be DoorDash. Indications now between 170 and 175 a share, Carl. It priced at 102. And that was a fun conversation. I learned a bit about him, his mom's work in the restaurant business as she built up resources to go back to doing the traditional medicine that she was trained in, and just the stick-to-itiveness that it took to bring this business from PaloAltoDelivery.com, which he and some friends at Stanford set up on a Saturday in 45 minutes, to DoorDash today, which is getting ready to go public with a market cap that looks like it could be well north of $60 billion, 175 to 180 now. So we're getting into that $70 billion range, I believe, Carl.
It's amazing, John. And one of the great things about any IPO day is being able to take stock of the origins of the business. His story is incredible, and sort of celebrate whether the stock's going to go up or down, celebrate the capital being raised based on something that really just began as a notion or an idea. There's a look at the indications, 175 to 180. The opening trade is moments away. Stay with us.
And
It has been quite a run for our next guest's company. Shares of MongoDB having more than doubled since the beginning of the year, up nearly 800% since its IPO back in late 2017, up more than 5% this morning MongoDB CEO David Acharya joins us now on those results. Dave, good morning. Multi-cloud is playing a big role in what's fueling your growth here, right?
Yes. What we've heard from senior level IT decision makers is that multi-cloud is a strategic imperative. In fact, today, there's a report that came out that said about 85% of enterprises are using different services from different cloud providers, and they expect that number to go to 98% in 3 years. What we offer, what we announced a few weeks ago, has been groundbreaking. Typically, people run one app on one cloud and you can run another app on another cloud. What we announced is that you can run the same application across different cloud providers. Now, why is that important? One is resiliency. You know, you may have seen and noticed that there were some pretty high-profile cloud outages right before Thanksgiving. When you run the app across different cloud providers, you have better resiliency. You can also leverage different services from different cloud providers as they compete with each other. And last but not least, you get true platform independence. Data is one of the hardest things to move between clouds. And with MongoDB, we make that really easy. So customers have the choice of where they want to run their app, and they can move from one provider to another provider very easily, so they never feel like they're locked in. Those are compelling reasons to use MongoDB.
So Dave, tell me what this means for the competitive landscape for you. Because when I think of MongoDB, I think of also companies like Snowflake that work across clouds, but also have to compete with some of the same mega scale platforms that they operate on, like Amazon. Amazon's got some database offerings that compete with you as well. How does that multi-cloud shift affect both your individual fortunes and your fortunes relative to somebody like an Amazon that's also competing with you?
Well, one of the things that was interesting is Amazon at reInvent actually, for the first time, actually talked about a multi-cloud world, which is the first time they actually acknowledged that people do have other choice. So multi-cloud is here to stay. What I will say is when we went public in 2017, there were some real questions about our ability to offer a viable cloud service competing with Amazon and Microsoft and even Google. Well, 3 years later, you know, our Atlas business is our fastest growing business, growing north of 60% year over year. It's grown very quickly and close to a $300 million revenue run rate. We've been able to prove that a best-of-breed solution can compete and be successful against the large cloud providers. And I think the similarities to Snowflake are that we're both going after large markets encumbered with legacy technology, and you offer a differentiated and compelling solution, you can win. And so we feel really good about our positioning. And given the fact that customers increasingly care about multi-cloud and being able to use different cloud providers and run apps across different clouds, I think that positions us well for the future.
Well, what do you have to do to continue to scale your growth, your customer acquisition? Talk to me about the sales motion that's necessary to continue to go up against these mega scale providers in the likes of Amazon, Microsoft, Google in some cases, that have these huge organizations already stacked with salespeople.
Sure. I mean, clearly we're competing with very large organizations, but we've been doing so since day one of the company's journey. And so obviously our name, our brand has only gotten better and stronger over the last few years. What I will tell you is that MongoDB's vision is to be the platform of choice for modern applications. We believe we have all the ingredients in place. We have the best database with the best technology that makes developers the most productive. We believe that we have a huge developer mindshare. We are, by every objective measure, the most popular modern database in the world. And third, we offer platform independence, which, as we just talked about, resonates with every enterprise. And so given those ingredients, we feel like we're really well positioned. And with regards to cloud providers, we partner and we compete. You know, we have great and healthy relationship with AWS, same with Microsoft and same with Google. And we are working very closely with them. In fact, we just made a joint announcement with Amazon yesterday where our CTO was noted in their press release. So it's a very healthy relationship, but there are times when we partner and there are times when we compete.
Interpret for me what's happening in the cloud market. Last week we saw that Salesforce intends to purchase Slack for north of $26 billion. Are we entering into a period of maturity and consolidation? And if so, does that mean that you've got to think more about M&A?
Well, what I will tell you is this. Every customer I talk to knows very clearly that their future is tied to their ability to innovate and innovate using software and data, which is why we're increasingly having more and more senior level conversations with customers, because if they don't know how to innovate, frankly, their future is going to be in question. So this has become a very profound agenda point for senior level executives. Moving to the cloud is not if or when, but how. And MongoDB is viewed as a platform that offers a very seamless migration path from on-premise to the cloud. It allows people to be very productive and innovate very, very quickly. We serve some of the most demanding customers around the world, and they use us for almost every conceivable use case. And we feel really good about our future, given all the agreements we have and how we've executed to date.
But are you looking to buy stuff and bulk up?
We obviously are always looking for acquisitions. Our acquisition history has typically been more surgical, where we look to acquire small companies who have some compelling technology or allows us to expand our footprint more quickly. I don't think you're going to see us make any mega acquisitions anytime soon.
David Acciaria, on the heels of earnings that the street is taking a liking to, that stock up about 5%. Thanks for being with us.
Thanks, John. Nice to be here.
And John, let's get the latest indications on Dash. It keeps rising this morning, 185 to 190 now. The opening trade is just moments away. And before we go, take a look at shares of Uber and Grub. The enthusiasm around DoorDash certainly helping them. Uber shares up more than 5.5%. Grub shares up nearly 9% this morning. We are right back. Stay with us.
Well, we were just talking to co-founder Tom Siebel. C3 AI has opened. It is up more than 130% at this point. I expect a tweet any moment from venture capitalist Bill Gurley about the money left on the table here. But any way you look at it, this is a successful debut based on where this was expected to go. And speaking of success, Deirdre, the indications on DoorDash keep on moving higher. This is a big order. It's taken a long time to deliver, but it's looking like it's going to be hot when it opens.
Yeah, latest indicated range 190 to 195. Remember, Carl, that it priced at $102. So if Bill Gurley is going to tweet about money being left on the table, he's got two targets today. Going into this IPO, one of the biggest questions, Carl, was this question of sustainability. Can this growth rate continue into next year when people start to go back to restaurants and perhaps don't deliver as much? But that seems to be in the rearview mirror. Markets are just bidding this thing up, and we could see it go public at a market cap not too far behind Uber, which is pretty remarkable because Uber has more businesses and it's in far more markets than DoorDash.
Yeah, Cramer's been pretty clear. He was this morning and has been on Twitter all day, guys, about not chasing, but clearly the chase is on. You got to remember the range on this pricing was as low as 75 just about a week ago. So it is a remarkable process of price discovery. And to John's point, there may be a discussion of how inefficient that discovery may have been, given the way the pricing has changed. Meantime, guys, Disney, really quick, all-time high once again today. Morgan Stanley went to 175. Wells upgraded to overweight 182. Got the investor day tomorrow. The leap into streaming hyperspace, as Wells said today. Let's get to the judge.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the big call of some of this market's biggest winners and how it impacts your money. The details, the debate, they're straight ahead with our investment committee. And joining me for the hour today, Joe Terranova, Jim Lebenthal, Pete Najarian, Liz Young, BNY Mellon's Director of Market Strategy. I'll take you to the wall. I'll show you where stocks are trading right now. We did hit intraday highs earlier today. Fell back a bit. Dow's down about 36. S&P, NASDAQ now in the red. Russell still hanging on to the green. Want to show you the DoorDash weight as well. Yes, we are paying attention to that IPO today, too, as the gang in front of us is. 102, the price, well, indicated now 190 to 195. We'll show you the first trade the moment that it happens. We'll talk all about it. A market cap that is right now, and people on Twitter are talking a lot about it, more than Chipotle and Domino's combined right now. And it's going to be even growing from there. So we'll talk a lot about that, what it means for overall valuation in the market, which was our lead anyway. Why? Because J.P. Morgan today downgraded several high-flying tech stocks. Pete, this is where I want to begin with you because this is an interesting downgrade. The timing very interesting to coincide with this DoorDash IPO, which we're talking about with a lofty valuation in its own right. So they go downgrade on CrowdStrike, on Okta, on DocuSign, on Zoom, on Cloudflare. They're looking back to 2010. They're talking about the relationship between the highest multiple stocks then related to software valuations and how they underperformed the software stocks at that particular time. And talk about maybe it's starting to replicate itself now. What do we think? Is this trying to pop the bubble before it gets too big?
I would say yes. I would agree, by the way, with the J.P. Morgan analyst and the idea that we have some, they don't just have high, lofty valuations, Scott. In many cases, these companies, we don't know when they're going to make money, but they're exciting and they've been great. And the pandemic has certainly added to a lot of what we are seeing happening in a lot of those specific names that you're talking about here. But yeah, when you're looking at PEs that are anywhere from 140 up to the thousands, that says a lot. And I would have to agree that I think we've learned over time a little bit. We still overshoot to the downside, the upside, and all the rest of it. And I think we have overshot to the upside here. I think there is room for a pullback. And we've seen a little bit of this because we've seen a bit of a rotation, not necessarily just to value, Scott, but to names that make some sense, that maybe are a little bit inflated themselves, but you can much more tolerable to be in some of those names, some of those Dow names, some of these S&P names that we talk about each and every day as we move to the financials and we move over to the material space and the energy space, where many of these particular areas that are still impressive, but they're nothing valuation-wise like what we're seeing in some of the names that you mentioned, DocuSign and some of the rest.
So, Joe, let's come to you because, you know, Pete ends on DocuSign. You do own DocuSign. So what do you do with this J.P. Morgan call today? And more broadly, what do you do and what do you say our viewers should do if they're in that stock or others just like it?
Well, first of all, I want to be wherever Pete is right now because it looks spectacular. But I am in DocuSign. You and I have discussed that. I've got to stop in place because I agree with the J.P. Morgan call. And I agree with the narrative which you've been communicating over the last couple of weeks, which is urging viewers to really look at these emerging growth stocks and understand the sky-high valuations that they're trading at. But Scott, that does not mean to me that the market is going to go down if we see these emerging growth stocks begin to correct. I still think there is enough support. I think there's enough dispersion. I'll use Alphabet as a prime example. Alphabet has come to life. We're not even talking about Alphabet.
Hey,
Alphabet is now...
Let's say two different conversations. Let's say these are two different conversations. All right? I agree with you. There's nothing to say that if these stocks have an upset that the overall market is going to fall over on its head. However, there are a lot of people who got into these stocks, Joe, who need to know whether JP Morgan is ringing the alarm bell loudly enough that they need to take some profits or put stops in the way that you have, and a stop alone doesn't erase the issue itself of something being overvalued.
Well, if you have ownership of these stocks, the stop does exactly that. It's a risk management strategy, and that's what you should be doing. So I said I agree with JP Morgan. I also said you've been very accurate in communicating this over the last couple of weeks. So to the viewers who have ownership of all the names that are on the list, Okta, CrowdStrike, all of them collectively, you have to understand what is your risk management process. You have to define it. You have to measure that risk, and you have to implement some form of discipline that's going to protect whatever your current position is. The only position I have right now is DocuSign. That's exactly what I'm doing, and I'm encouraging the viewers to do the same because absolutely, these are astronomically high valuations, and you must pay attention to that.
Okay, so Liz Young, the problem with all of this, and even part of this conversation in and of itself, these companies keep delivering. Their earnings come out, they keep delivering. They keep justifying why they've made these moves. And just because what is astronomical today can still be astronomical a long way tomorrow. As we learned in 99 and 2000 with Greenspan's irrational exuberance, which went on for 4 years before the dot-com bubble popped.
Right. So I want to go back to something that you asked at the top of the show. Is this the bubble that needs to pop before we move forward? The definition of a bubble popping makes it sound very dramatic and that everything's going to fall out of bed and we're going to have this huge pullback. I don't think that's the case. But we are seeing a transition in the market from these high growth stocks into the ones that should be stickier in an early sort of recovery story that we expect to take shape in the end of the first quarter, early second quarter of 2021. Now, that being said, valuations matter. I would never say that valuations don't matter, but they matter less until long-term rates go up, especially on these growth stocks. And at that point, valuations will look a lot more frothy than they are today. But until then, they're not necessarily a reason that the market needs to have this huge pullback or huge correction.
But if you're, Jim Lebenthal, you look at these stocks which seem, kind of sky high to you, I'm sure. But even you, to a lesser degree in terms of a stock name, a Salesforce, for example, which a Jim Lebenthal I know, the farmer, never would have touched before, but you've even waded into the water because it feels pretty good when these stocks go up a lot, Jim.
I'm in the kiddie pool, though, because here's why. I mean, Salesforce currently 60 times forward earnings, and it'll probably, based on earnings results last week, that's probably going to look more like 50 times earnings as analyst estimates get refined. I think you have to draw a distinction between the super high flyer software stocks, which since Fastly came out with their pre-announcement, that was the canary in the coal mine. It's off 40%. Zoom is off about a third since then, and that is a bubble starting to deflate, if not pop. Now, the key example right now is Snowflake, and let's use numbers. Its market cap is $110 billion. Its addressable market is $84 billion. So we're basically saying that nobody's going to compete with Snowflake at that valuation. Nobody. Not Twilio, not Microsoft, not Google, and that they're going to have no cost of goods sold. That's what you're saying if you're buying it here. Let me draw a distinction between Snowflake and a name that Joe mentioned, which is Alphabet, which does have a bid to it. Alphabet is profitable. It has good cash flows. It has cash, and it trades at 30 times forward earnings. Not dissimilar to Salesforce. You have to draw a distinction between where the bubble is, those high-flying Zooms and Snowflakes of the world,
and where it isn't, which is the leaders of large cap tech.
Yeah.
There's no bubble there.
But Joe, if Josh was on today and CrowdStrike is one of his favorite names, and he adds to it, even as it has big valuation with it, and says these are the kinds of companies that are the growth. This is where the action is. It's justified where it is because it's going much higher, because its business is going to grow much greater. I mean, how do you counter what very well could be the truth?
I'm guilty of the same thing. I own DocuSign, so Josh owns Crowd. I'm sure he's got a stop in place for that stock. That's exactly what you should be doing right now. I'm not saying owning all of these, but there are particular stocks that you could identify, as I have said in the past, as it relates to DocuSign, that it is not, as you said, just show up and sign. There is something transformative about DocuSign that I fundamentally believe in. However, given the valuation, given where the volatility is surrounding these stocks, I'm asking to implement a risk management strategy. There are other stocks, Scott, that we're not even talking about on this list, like a Peloton, which I think the valuation there is absolutely ridiculous. I don't even understand why someone would own a bike company trading at 200 times and near $120.
A bike
to
company.
To me, that's more.
Bike company? Come on, Joe. They're like the digital forefront. They're an apparel company.
Okay,
They're a
right.
lifestyle company. They'll sell microwaves if you want one. I mean, they say they sell everything under the roof.
Yeah, well, you know what, Scott? You and I are about the same age, and we remember riding our Schwinn bikes back in the early 80s and getting the same type of workout. So come on.
What about Pete, this idea that your better bang for your buck, if you will, at this point, is going to be in software stocks, be it Microsoft or Adobe or even, Jim's Salesforce or, Snowflake, Oracle, or any of those other names? Pete, what about that argument that that's where you're going to see outperformance, especially if JP Morgan's right and some of these high flyers start to falter a bit, money goes into the other place?
Right. I think they would shift away, and the money would go to other places. And I think you're exactly right, whether that means it's Microsoft or, I'm going to say it, IBM. I don't know if Jim is still an IBMer or not, but I own the stock, Bill Scott. It's actually had a little bit of a move back up to the upside from where it was. So, it's interesting because there's a lot of different names in the software area that I think you can look at them. You could say they do have some growth. They don't have as much growth, obviously, as these high flyers that we're talking about. But at the same time, you can feel a little bit more comfortable to go and sleep at night and not expect to see your stock potentially be down. Like you guys were talking about some of these names that are down 30 and 40% off of their highs. You can go to sleep at night knowing that that's probably not the case in many of these others, whether that's an Oracle or, you could go through the whole list. But the reality is, I think that there's a lot of different names out there that have great potential right now to continue to maybe get from some of those names as they start to get away from some of those names that are the high flyers. They're going to come over in names like an IBM, in my opinion, and some of the old school tech and some of the software, whether that's Microsoft, whatever it might be. And actually, I think that's a rotation that we will see. So it's still within tech, it's still within software, but just coming from some of those high flyers.
So, Liz, if I told you, though, that DoorDash is going to open $200, they've priced it $102, and there's the indication right now as we wait for the first trade, 195 to 200, as we still have this big wait, and that the market cap is going to be more than Chipotle and Domino's combined, and maybe well beyond those. What say you to that?
So I'm gonna generalize a little bit about this crisis and what I think has happened in the crisis, and DoorDash would fall into this category. There are a lot of consumers that got familiar with using types of corporations to stay at home. And some of them would have never gotten familiar with that before. They're certainly going to use it more after the crisis, more than they did pre-crisis, but the demand will still fall. And once we get back to normal, I would put home gyms in this category too. Once we get back to normal, the demand for those new consumers just won't be there. It's going to have to be maintenance for the ones that exist, in which case competition picks up, price competition especially picks up, and I think some of these are going to have a little bit of a cooling off period. Now, that doesn't mean that DoorDash is a bad investment, but I do think that there's something to be said for waiting through the price discovery phase.
I mean, full disclosure, I used DoorDash just last night. And I've used it a lot during the pandemic, as Liz just said. And I know all of you have probably as well. But, Joe, you raise a really interesting point about Peloton. And, you know, do you put DoorDash into that same category? Once we try and get back to normal, am I going to use DoorDash on Tuesday night? I don't know. Maybe I'll go out.
Maybe. There's a duopoly, and let's keep in mind what Uber is currently doing right now as Dash is moving higher. Uber is also rallying with it, and that seems to be breaking out. The price is just too rich here. Listen, I think that Dash, I expected, and you can see it in the notes, I expected to get the type of performance that you got from Snowflake. And obviously, you're getting that right now, but I'm not going to buy it here where it's basically half of McDonald's or you know, you've got Starbucks, which I own, which has a market cap of 120 billion. So it's just too rich for me. I'm more interested in Airbnb, which is coming. I'm now concerned that that's going to get away from me as well. But just in terms of your question, I do think Dash will continue to be embedded in consumer behaviors as we move forward, because there's going to be those evenings where you're going to want to sit home on the couch and watch a Capitals game or a Redskins game, Scott, and you're going to want the food delivered to you. And Dash is good at doing it. Or you could use Uber Eats.
That would be the Washington football team to you, Joe. Big victory this week. Thank you very little. So, Pete,
yes.
you wanted a piece.
For that.
You wanted a piece of Dash, right? You're allocated. You didn't get it.
Yeah.
You didn't get it. What about in the open market?
Nope. Absolutely not. I'm with Joe. I love what it's doing. It's why you wanted to get it on the IPO pricing, because it felt like this was going to be like a Snowflake or one of the many names over the last year or two that have absolutely skyrocketed from where the price was to where they actually open. But to chase it, Scott, just makes absolutely no sense to me. And to Joe's point, I think we will be in, and I brought this up many times, this hybrid society. So the DoorDashes of the world, they're going to be around, and obviously they are much more of a focal point now than they ever were before. And when we come out of this pandemic, when the vaccines are out there, we're going to see a lot of adjustments, whether that's Peloton, whether that's DoorDash, whether it is all of these various names, Zoom included. They will still exist. They'll still be just fine. But there's no doubt in my mind that demand will absolutely wane. And so because of that, I wouldn't want to be chasing it right now. As a matter of fact, I think that there's the possibility that we could have this big bump. And I wouldn't even be shocked, not saying it's going to happen, but I wouldn't be shocked if we actually saw the stock actually sell off. So it'll be interesting to see how the reaction goes in the first hour of trade or so.
Well, Jim, I just wonder if say, Snowflake was like the pulling down of the fire alarm, if DoorDash is the 6-alarm blaze. That we look back on and say, you know what, this market is just on fire and it's getting a little bit out of control. We need to call in the reinforcements.
I think you're on point. All right, I agree with where you're going with that. But here's the key element: is when does the fire actually burn everything down? I don't think it's anytime soon. When you seasonally have this sort of risk-on sentiment, as evidenced not just by the IPO market, but also equity fund flows, incredibly low put-to-call ratios, this all speaks to a risk-on environment that this late in the year usually goes through the end of the year and into the middle of January. Now, I'm really hoping these IPOs continue to do well because I'm very much invested in the markets and everything I own is doing well. I want it to continue to do well through the end of the year. Let's worry about putting out the fire in mid-January. Does that sound irresponsible? It does to me, but it also is realistic. It's just realistic.
Wow, that sounds like the old, you know, I'm going to dance as long as the music's playing, Jim. That's basically what you said.
You know what? Listen, Scott, you're right. You're right. But you know what? Think about the penalties of not dancing while the music is going on. And look, all of us on this show are experienced. We have a better chance than most of figuring out when to dial back risk. I don't think it's now. I really don't think it's now. You look at the IPO market, you look at fund flows, it's telling you stay invested.
Is that how you see it as well, Liz? I mean, you got, you know, so much money on the sideline, as Jim is saying, where fund flows, you know, may go. This idea of having an end-of-year rally, the Santa Claus rally, and then into the beginning part of next year as we get even more optimistic about the vaccine?
I agree with Jim that it's not the time to take risk off the table. I'm a little skeptical of a year-end rally because I still do think that we have some headwinds in the near term that the market is going to have to get through. Now, to be clear, I think the market gets through them just fine, but we might have a couple bumps before, say, the end of January or before we get another fiscal package. But first and foremost, what the market needs is continuing good news on the vaccine. That is the biggest risk out there. If we get news on a vaccine that it's going to be delayed or that it's not going to be as effective as we originally thought, and right now it seems like the market is pricing in almost herd immunity by early summer. If that timeline moves out, then that's going to be a pullback in the market. But if all things stay equal right now and we continue on this path, this is the time to have risk on. And I say this to clients every single week, you must be present to win. You don't want to miss out on that.
Got to be in it to win it. Joe, you bought Best Buy. How does that play into your overall view of the market here?
Well, I had owned Best Buy previously, got out of it back in August. I've been keeping my eye on it as it continues to pull back from its early November highs. It obviously screens very high within my quality momentum index. In particular, for quality, it's got an ROE above 40%. It's got the last quarter sales growth coming in above 20%, when over the last 3 years, it's only running about 3.5%. So I'm taking advantage of this pullback. I'm utilizing the 200-day moving average, which sits around $93 as a reference point. It has not gotten below that 200-day moving average since early in the spring. So this was a good time to step in and buy it. That's
Pete,
exactly what I did.
Pardon me for interrupting you there. Pete, you bought some Best Buy calls too?
I did. I didn't buy the stock. I bought the calls. I'm not quite as confident as Joe is, I think, right now on this pullback. So I loved seeing we had some unusual the other day on there, Scott, and it prompted me to jump in there. I like Best Buy. I think their numbers are phenomenal. Stock has pulled back. And at some point, the problem is I just don't know if that continues or not. And so for that reason, that's why I chose to be in the options instead. It gives me that limited risk because what I pay is what I can lose. So that's why I chose to go that route. But I do think great company. Their numbers are absolutely incredible, it seems like, every single quarter. And the way they're able to compete in this market, and because of, obviously, a pandemic, it was also one of those stocks that did very, very well throughout that with all the sales of all the laptops, everything else. I think that it's a great company that is really well run, and I think the options were the bit way that I wanted to attack it rather than being in the stock.
Watching the stock move up here as we're having this conversation. You're active, Pete. Again, you bought shares of U.S. Steel, letter X. Why?
Yeah. Yeah, you know, I've been talking about this material space for a while now, Scott. In the month of November, it's absolutely exploded to the upside. Energy, materials, you've got some great industrials, and then also some of the financials that have started to move very, very nicely over the last 4, 5, 6 weeks to the upside. But the material space is exciting for me. I know I hear a lot of the folks that are on the halftime report and the rest of CNBC talking about all these various cyclicals and all the rest of the industrials. And I think the materials really play a big part in that. So the second I see any unusual there, I jump on it. So I've been in Vale, I've been in Freeport-McMoRan. When I saw U.S. Steel, that was a company that I was confident enough in that rather than the options in that case, I actually bought the stock. So really pleased with how it's done. A nice run up towards 20 today. I think it hit 20. A little bit of a pullback off of that, unless it's changed a little bit since then. But I like this name, Scott, and I think Nucor and U.S. Steel. I think steel, really pleased with how it's done. A nice run up towards 20 today. I think it hit 20. A little bit of a pullback off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think steel, really pleased with how it's done. A nice run up towards 20 today. I think it hit 20. A little bit of a pullback off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think steel, really pleased with how it's done. A nice run up towards 20 today. I think it hit 20. A little bit of
Disney today. Shares are jumping off that. We've got Morgan Stanley's Chris Toomey waiting in the wings to tell you where this market is going. A lot ahead. We'll debate all of it next.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC News update at this hour. Canada has approved the COVID-19 vaccine from Pfizer and BioNTech. It's set to get about 250,000 doses this month and 4 million doses by March. On Michigan's Upper Peninsula, authorities are still searching for the pilot of an F-16 fighter jet that crashed overnight. The plane was part of the Wisconsin Air National Guard based in Madison. In the southern Atlantic, this is one of the largest icebergs ever recorded. It is 91 miles long. It covers 1,600 square miles. And unfortunately, it's on the move. It could slam into an island off the tip of South America, and scientists say that iceberg could devastate wildlife there, including penguins and seals. Back here at home, take a look at that. That is a humpback whale in the Hudson River, right between New York and New Jersey. Locals are delighted with the chance for a whale sighting, but experts are worried the whale could be injured by a passing boat. And Scott, they're thinking of reducing the speed limit, I guess is the word, in the Hudson River to try and protect the whales. So,
Yeah, probably a good idea. Amazing sight. Sue, thanks.
You got it.
All right, Sue Herrera. Let's check you up on DoorDash as we continue to wait for the first trade in its IPO today. I said we're getting a little bit closer because the range is getting a little bit tighter. That's a tell that they are getting close to the finish line, at least for the very first trade. Priced at 102, you're looking at 185 to 188, where the stock looks to go out. We'll keep you up on that, and I promise you we'll bring you the first trade as soon as it happens there. Let's bring in our featured guest today. Christopher Toomey is with Morgan Stanley Private Wealth. He's back with us. Good to see you again, Chris.
Hi, Scott. Thanks for having me again.
I'd like to play off the DoorDash news if we could. Just simply, you're talking about a big-time valuation on a day where we're looking at downgrades to some of the most high-flying of growth tech stocks. Are we overheated? Are we looking at a big, giant bubble in one part of this market?
Well, look, I think if you look at equities in general, particularly on the S&P 500, about 90% of the index right now is trading at above its 200-day moving average. So it's probably a little bit overbought. But I think what's important is to understand why we're at this place. And I think it's really based upon two important factors. The first one being we're in a situation where we've got a very accommodative global monetary policy that's going to go out until 2023. So we think that's going to provide continued liquidity into the market and keep rates still at very low levels. And in addition to that, we've also got tremendous global fiscal stimulus coming into the economy. There's news with regards to Mnuchin and Pelosi coming together on a CARES 2.0 stimulus plan that we think is going to provide continued stimulus to the economy. And I think if you think about it, we're right now in a situation where we believe we're still in a V-shaped growth economy, and this is going to be synchronous across all major and emerging market economies. This is 12 out of the last 40 times we've seen this. It's been a very good outcome for markets. And we think that that type of conviction is going to continue to prop risk assets higher in these markets. So I think, yeah, we probably wouldn't be surprised if we see a pause right now. But I think our general view over the short and intermediate term is for continued outperformance.
So you agree then with your pal over at Morgan Stanley, Mike Wilson, who says almost identically, recoveries create rotations, right? We've seen this rotation into value stocks. But with those rotations now fully in gear, it may be time for a near-term pause. He says it's critical to be more selective rather than chasing, and he, like you, is certainly positive over the longer picture.
Yeah, absolutely. I mean, I think if you remember when I was back in September, we talked about the opportunity of value versus growth, and in particular in small caps. October, we saw markets pull back, I think with concern about a second wave of COVID, as well as concern about the outcome of the presidential election. And then we had a huge rally in November, and small caps now are up about 20% over that time period. And we saw value start to catch up to growth. And so that disparity between growth and value in large cap and small cap has now come to a more reasonable area. And now we probably want to be a lot more selective with regards to where we're putting capital in those cyclicals, in those value areas, because they have run a little bit.
It sounds, though, like you're all in on the this V recovery and this economic resurgence once we can all get the vaccine and get back to whatever normal is going to look like on the other side? You're overweight cyclicals, industrials, energy, materials, financials, small caps, pretty much the whole gamut.
Yeah, I mean, I think the one place that we're not overweight is probably fixed income. I think if you look at where rates are right now, almost 80% of the global fixed income market yields less than 1%. The move in November has put credit spreads at all-time heights, all-time tights, whether you're looking at investment grade or high yield. So there isn't a tremendous amount of value in those areas of the market. And so we do see some real opportunity still in equities. And I think part of that conviction comes from, just looking at general companies right now, and generally speaking, they're in very good shape. PMIs continue to be very positive. And then if you look at the consumer, which makes up a large deal of the economy, even though unemployment's at 6.7%, we're still seeing personal income rising. We've got a savings rate above 13%. And I think a lot of this is being boosted because we've got a strong housing market. We just saw that mortgage rates are now at all-time lows, and the stock market's doing exceptionally well. So you throw that with the stimulus that we're seeing both from global monetary authorities as well as fiscal authorities, I think that's going to continue to push risk assets higher.
What's the only risk? I mean, interest rates, is that rates a risk? 10 years, 95-ish basis points right now. Delay in vaccine rollout or problems, setbacks related to that. Where does the risk lie?
Well, I think, if you look at the employment number last week and the market's response to that, I think we're in this almost kind of Goldilocks, bad news is good news situation where I think if we do continue to see the rapid increase in COVID cases and we continue to see it affecting employment, you'll see more pressure on Washington and other governments to continue to provide stimulus to help us get through that period. So I don't necessarily see COVID as big a risk, especially given all of the progress that we're making on the vaccine and therapeutic side. I think the bigger risk is probably on the inflation side and the rate side. The Fed has basically come out and said they're not going to do anything until 2023. If we're right and the global economy continues to move at this pace, we could start seeing inflation moving higher and higher. I know that last night it was reported Jeff Gundlach is talking about inflation seeping into the global economy. And that could be a major risk, particularly for fixed income assets.
How big do you think next year is going to be for stocks? I'll leave it with that question to you.
I think generally speaking, Morgan Stanley's estimate is about an 8 to 10% return on equities. I think it really is going to be a question of where you're allocating capital within that market. I think it's really going to be based upon individual names and individual stories as opposed to just broadly across the general market. I think one area in particular where I think investors are probably underweight and that doesn't necessarily meet this hyper valuation concern that you're talking about is China. I know we talked about it last time, but China, about 20% of the global GDP, 20% of the population, but only about 4% of most market indices. It's growing at about a 2.2% rate, even though it was the first into COVID. It's also proven to be the place that we're seeing handling the virus in the best possible way. Our expectations for China next year is to be growing at over 9%. It has much less debt than most developed countries and trades at a valuation discount. And I think what's important is when you're looking at China, you're talking about two different types of investments. You're talking about traditional China, which is the traditional exporter manufacturer. As we know, the Trump administration was trying to control that trade deficit, and they didn't do a very good job because it's continued to get larger. If you look at commodity prices, which I think are a very good indication with regards to what's going on in the global economy, they continue to rise, which we think is a good sign with regards to the fact that China continues to manufacture and continues to grow. And the second part is probably that growth in the middle class, China turning inward. As I mentioned before, it used to be less than about 18% of China's economy. If you look at the indexes now, it's almost 2/3 of their economy. So one of the areas where I think if you're concerned about valuation, but you do want to continue to play this V-shaped recovery is looking at places that are going to benefit from Chinese growth.
I appreciate the time today. Happy holidays to you and your family. We'll see you sometime in the new year.
Thank you, Scott. Take care.
All right, that's Chris Toomey, Morgan Stanley Private Wealth Management, joining us there. Bullish calls, I mentioned them before on Disney. A couple of them today. Let's go through it, guys, because you've got initiated overweight at KeyBank. 177 is the price target there. Upgraded to overweight at Wells. You got a street high 182. Farmer Jim, you own Disney.
Yeah. And I think there's a very simple analysis here. It's sum of the parts. These analysts, most analysts, are looking at Disney catching up with the subscriber count of Netflix in the next year or two. That's pretty big, pretty big gains. But assuming it happens, Netflix market cap is about $225 billion right now. Disney's is $280 billion. That means basically you've got a Netflix in Disney and you've got every other business valued at $55 billion. Well, those other businesses, studios, theme parks, et cetera, earned $17 billion in 2019. So you're talking a 3 times multiple on those businesses. Yes, I get we're in a pandemic, but we're going to come out of it. It's a question of when. And 3 times the rest of those businesses is way too cheap. So some of the parts completely supports being long Disney right now.
Yeah, new 52-week high today. The high today, 157 and 46. Pete, you got out a while back. What would get you back in?
I've seen some options that intrigued me, Scott, recently. They were going out to June. This is very recently. Going out to June, the 165 strike. But that stock's made an unbelievable move. I think at the time of that buy, the stock was 146. Here you said 157 today. It's about 155 now. I love this company. I love just about everything about them. The one aspect of it, and I know Jim looks at this stuff closer than I do every single day, but it feels like it's a little bit lofty to me. And the reason I say that is look at where the PE is now, forward PEs for Disney. And we see this in a lot of these great names. And we all know that as we get the vaccines, as we come out of this, the rest of the portfolio of Disney will start to kick in and add to the streaming and the DTC, all the rest of it. So I understand it. I guess I'm just waiting on any kind of a pullback, Scott. I love the move. I was in the stock, then I eventually got into just the options themselves. Now I'm not in there, and I'm kicking myself a little bit because I've missed at least the last 10 points or so on this run.
Is that a real backdrop, Pete? They don't have palm trees on Lake Minnetonka. I know that. You don't have to tell us where you're at.
You know where? I'll tell you where I'm at. I'm down in your neck of the woods and my neck of the woods, man. Tampa, Florida. I'm actually in St. Pete right now. It's an absolutely beautiful place. My wife and I have been on this great road trip, and city by city by city, we're looking around, and here we are down in St. Pete. It's beautiful here. Absolutely gorgeous day.
Good for you. I know people are talking about it on Twitter, so I wanted to figure out where you were. It's a beautiful shot. All right.
Awesome.
For more on the biggest analyst calls of the day, you can check out the write-up on CNBC Pro. Go to cnbc.com/pro. Still waiting for DoorDash. Let's take you back to the screen, show you where we're looking now. I said we're getting closer. 179 to 182 is the range right now. 102 is where the price was. We will see where this opens, and when it does, we will be right there. Up next, we'll tell you about the top ETFs to watch as well. All right, welcome back. I want to show you the indications for DoorDash. As we're told, the first trade in that stock is imminent now. 179 to 182 is the current indicated range. 102 is where it was priced. Leslie Picker's been following the money throughout this entire process. She's with us now as we walk you up to that first trade. Les, it's taken a while. Sometimes they do. This one seems like a little longer than the others.
It sure does. I mean, look, we're already almost to 1 o'clock and we're still waiting. But as you mentioned, we saw those indications come in as high as $200. And it looks like now it has officially opened for trading. Wow, 181 right now at about 181. This company is seeing a pop of about, I think that says 80%.
80%. I know. You have to do a double take when you're like, wait, what?
I need my glasses to see that. But 82%, a tremendous pop on the first day of trading. Values this company at about $70 billion on a fully diluted basis at that opening level, which is tremendous, Scott, because this company tried to add an auction, a hybrid auction-like system to really avoid this first day pop. It's kind of a new twist on the IPO process where they take orders in through an auction system somewhere between, a Dutch auction like we saw with Google and a direct listing, which is much more of a pure auction-based system, and a traditional IPO process. And they use that information to set that 102 price. And as you can see, there was just a tremendous amount of investor demand for this company. That stock now trading up 77% in its first day for a company that was already coming in, when you look at a relative valuation compared to its peers and compared to other platform companies, well above a lot of those companies. And now it's just tremendous seeing the first day of performance here.
Les, they'll be talking about, leaving money on the table. We always hear about that sort of thing when you have instances like this, priced 102, and then it opens up 80%. Can you give our viewers a little bit of an idea about how a company like this sort of estimates what demand is going to be for an IPO, and how you can get such a how you can be so off in terms of the pricing and what the actual first trade is going to be?
It's a great question. So the way that it traditionally works is that big institutional investors and hedge funds will all submit their indications of interest to the company and its bankers and say, I want to buy X amount of shares at X price. And from there, they're able to assess a demand curve. And sometimes you do a little give and take. If you want certain investors in your book, people that you think will be with you for the long term, won't flip right out of the gate, then you may say, okay, we're willing to come down a little bit on price to give those specific investors allocation into this deal. The challenge is those indications of interest are non-binding. So people will say, I want to buy in at this price, but they're not beholden to actually ordering at that price. So it is a little bit of an art as opposed to a science. And then one of the unique twists of this year is that, and we've talked about it on this show so many times, is that you've got this new kind of variable in the retail investor. So with a stock like DoorDash, that is such a name brand company, a lot of people use it, a lot of people work with them if they're a merchant or if they're a Dasher themselves. That is a little bit harder to assess demand because it's such a disparate group when you think of the retail investors as opposed to going to a Fidelity and a T. Rowe and a BlackRock. That's easy. You can have big orders from those investors, but you don't know what the demand looks like from a retail investor as you're trying to build out your book.
That's a really good point. The Robin Hooders.
The Robin Hooders.
If you will. So what does this mean in terms of what we're going to see tomorrow as we expect from Airbnb, if anything? What are we learning about the pricing there?
It's interesting. These two have been kind of neck and neck throughout the process. They both came out with a range. They both boosted their range. And at the high end of the range that they boosted, they were looking to raise pretty much the same amount of stock, $3.1 billion. Now, DoorDash priced about 7% above its boosted range to raise $3.4 billion. Airbnb is looking to price at the high end of its boosted range or above that range, which would put it pretty close to where DoorDash is in terms of an offering size, but probably won't surpass it. That said, interestingly, DoorDash doesn't have a green shoe. So the $3.4 billion is what they are going to raise, as opposed to a Snowflake, which raised about 3.4 in its IPO, then triggered the green shoe, which allowed it to raise 15% more stock, putting it at $3.8 billion. Airbnb, it'll be interesting to see kind of how that dynamic plays out. I do think that after watching what's going on with DoorDash, Airbnb may be a little bit more aggressive in terms of its pricing. They're also using that same hybrid auction method in order to assess the price dynamic, but they may say, okay, we have this input from the hybrid auction technology, but we're hearing from investors that, they really liked what happened with DoorDash. They're sitting pretty, up 83% on their money or whatever it is that they bought in at. They may be more willing to go a little bit higher in terms of price just to get on that Airbnb deal as well. If there is a nice tie-in, which I think there is, they both have a similar story with regard to benefiting from the pandemic, showing pockets of profitability. Airbnb, I will say on the top line, did take a leg lower compared to last year, whereas DoorDash saw its sales quadruple year over year. But still, it's got that same kind of story stock feel to it, Scott.
Yeah, I'm looking at the market cap of Dash as we speak. It's, greater than $50 billion, Les. You're talking about a Chipotle and a Domino's combined, which is just astounding when you think about those types of stocks and an IPO in just what is a red-hot environment right now for stocks like this, as you say. Thanks so much. We'll, I'm sure, talk to you tomorrow with Airbnb.
Thanks, Scott.
Joe, give me a quick comment on this, if for no other reason than I think you're interested in getting in on Airbnb.
I am interested in getting in Airbnb. I'll tell you, there's a very interesting market internal that's occurring right now. So as money is obviously going into DoorDash, you could pull up these 5 stocks: Peloton, CrowdStrike, Cloudflare, DocuSign, and Zoom Video. Money's clearly coming out of those momentum type names right now as we speak. I don't know if it's going directly into Dash, but that's fascinating to me that such a successful IPO for an emerging growth company, and on the other side of that, you're witnessing what was clearly the stellar emerging growth companies declining precipitously as that's opening.
That's interesting. Wash, rinse, repeat, right? You see these go up, rinse yourself with some profits here, and then repeat it by trying to get another big bang, and that in either DoorDash or maybe looking ahead to Airbnb. Pete, how do you feel about Airbnb as we look ahead to that one?
Yeah, I'm excited for it, Scott. There's no doubt about it. But again, it would be great to be involved, but I think you almost have to be involved on the actual IPO. Otherwise, I think you do feel like you're going to be chasing. Now, it's interesting to watch as we see some of the pricing, and it's moved around. It's shifted around pretty dramatically, really, Scott, from what we were just talking about at the very beginning of the show in terms of DoorDash. So it's going to be interesting, I think. I love these names. I know Joe loves these names, but I agree with Kramer. I think it's very difficult to chase if we get the openings that we're seeing in front of us right now.
Yeah. Let me bring in Bob Pisani as well. He has our ETF Edge today. Bob, I know you're here to do ETF Edge as our segment. If you have an opinion on what we're witnessing, since you are literally the person who is in the booth as these IPOs open for the very first time, I'm just curious your thoughts as you watch DoorDash open as high as it did when you are so attuned to how these things are priced.
Yeah, it's frustrating for me today, Scott, because I'm not on the floor standing next to the man who trades these stocks, which is a major part of the whole emotional involvement in this. So I feel a little bit deprived today and really missing the floor of the New York Stock Exchange and hope to get back there quickly. 3 things. First, up market. Most important thing, historic highs. Number 2, a known name, known to millions of people. As you said, you yourself, Scott, ordered from this recently. And number 3, strong retail pressure. And yes, I really do believe the increased retail presence we've seen is a factor here in a lot of trading that we've seen recently. So those 3 factors really adds to this. For DoorDash itself, I think the important thing is one person said to me, an analyst, he said, think of this company as a logistics company. They're trying to solve, the final mile with a very perishable product. And the question is, how do you do that? Grubhub, obviously, and others are involved in that, but it's an interesting question. Scott, let me move on here and talk to some people who know about ETF flows here. This is the ETF Edge portion of halftime, and some important big ETF flows going on. Our guest today, Harry Whitten from Old Mission, Todd Rosenbluth from CFRA Research. Harry, let me start with you. You watch ETF flows. We are seeing some very big inflows in some very big ETFs, including that IPO ETF, which is having an historic day of trading.
Yeah, hey, Bob. Thanks for having me on. Yeah, you're right. IPO is up over 100% year to date, seeing big inflows over the past week. The fund has grown to over $500 million this year. It's really exciting. I think everybody's tied on to the whole record of IPOs happening this year. I think there's going to be, by the end of December, over 400 new funds new issues launched in the IPO space.
Yeah, important thing too as well. We're also seeing some inflows into Kathy Wood's fund, ARKK. That's just been a monster this year, and it continues in December as well.
Yeah, ARK ETFs as a whole, as a family, have probably been one of the biggest stories this year. They brought in over $15 billion this year. They were a pretty small issuer and now become a major player in the space. They have funds that are up 140, 150, 160%, and they're not leveraged products, which is usually where you see those returns. It's just been a fantastic story, and it'll probably be ongoing just because they're really innovative in what they do. Another area I think you might have interest in is...
Oh, go ahead.
No, another area that's been active has been emerging markets, which have been outperforming since March lows. EEM is consistently a top 5 traded ETF, and WisdomTree has a product, SSOE, that has gone from 20 million shares outstanding to 80 million shares, and is really performed very, very well.
Yeah. Todd, GameStop, I see today down 16%, some disappointing commentary from them, but it's not impacting the gaming ETFs. You look at ESPO, Hero, GAMR, these things have had huge inflows all throughout the year. Investors love using these thematic tech ETFs, including gaming. These are all at new highs, all these gaming ETFs that are out there.
That's right. These video gaming-oriented ETFs have gathered about $1 billion of net inflows in 2020. The stay-at-home environment that we've talked about beforehand with working from home, this is playing from home. But these are global ETFs. So while you have exposure to Electronic Arts and Activision Blizzard, about 25% of Hero, H-E-R-O, is in the United States. You've got exposure to Nintendo. The VanEck product, ESPO, has Tencent as its largest holding that you showed on the screen. So you really have a global play for these ETFs, other ETFs like Nerd, and you're showing Gamer, G-A-M-R, on the screen as well. We think this trend is going to continue into 2021, regardless of more people are going back to home. They've gotten comfortable playing video games, and they're likely to do that in the future.
All right, Harry and Todd, thanks very much. Everybody, join us on Monday, 1 p.m. Eastern Time, when we talk about 2021 trends for ESG, environmental, social, and governance. That's etfedge.cnbc.com, 1 p.m. on Monday. Halftime is back in 30 seconds.
To the futures outlook now. Wild day for crude oil, jumping in and out. You see of what's happening there, as we said, all over the place. Bill Baruch with us, Blue Line Futures. Bill, where's it going?
Hey, I think it's going higher. You know, if I told you today, coming into the day, the S&P is down 0.5% and crude oil's holding ground with a 15 million barrel build, I don't think you would believe me, but that's exactly what we're seeing. That build was only a headline build because really what we saw was a big increase in imports and a big drop in exports overall. If you extrapolate that out over the week, that's an 18 million barrels added to the market right there. I think that we're going to see this thing draw down through the month of December. So I'm buying crude oil here, and I think buy at 45.25, get more aggressive in the February contract, risking a stop down to $42. I recommend using the mini crude oil, which is half the size of the regular one, per $25,000. That way your risk, if you get in right here about $1,700, ride this thing up to $50, and that way you're looking for about a $2,700 gain.
All right, good stuff. Thank you. Talk to you again soon. Come back. We'll do final trades. We'll get Pete's Unusual as well next. All right, let's do unusual. Pete, what do you got for us?
I'm going to give you Spirit Airlines, Scott. They bought 17,500 of the January 30 calls in there for about $1.40. Stock was trading about $26.70. So we got a little bit of time with this trade. They're going out to January. I'm going to give you Rocket Companies as well. About 13,000 of the December, this Friday, December 11th, the 22 strike calls for about 20 or 40 cents. Stock was trading around 21 and a quarter at the time. I love both these. I'm in both these names right now.
Quickly, give me a name for your final trade, please.
Facebook.
All right, good stuff. Thanks, Pete. We'll talk to you soon. Liz Young, final trade.
Emerging Asia on a weaker dollar and a pickup in global trade.
Okay. Joe Terranova.
Motorola Solutions, MSI.
And Farmer Jim.
Apple is breaking out after a 3-month consolidation.
Interesting on a day that Goldman reiterates their sell on shares of Apple. Good to see everybody. Thank you. Look ahead to Airbnb's IPO tomorrow. What will that bring after DoorDash today? That does it for us. The exchange begins right now.
Thank you, Scott. Hi, everybody. Welcome to The Exchange. I'm Kelly Evans. What a day. We are certainly putting the dash in DoorDash today. Huge demand for the company's IPO. The stock is surging at the open. It's up 78% right now at 182. The indicated range briefly touched 200, which would have been pretty much a doubling. What is it all telling us about the market today? We will have all the details. Plus, fresh warning signs for stocks, record high valuations by one metric, and sell signals close to being triggered. We'll have the latest. And a big day for Disney. Is Robinhood next to go public? And a 29-hour holiday work party. Let's start with DoorDash, though. Let's bring in Deirdre Bosa, Leslie Picker to kick things off for us. Deirdre, I don't know if we should even extrapolate anything about this company or if this is just telling us what kind of market and investor chase there is for Alpha right now.
It's pretty remarkable. I mean, this was a $16 billion company earlier this year. Now we're seeing it trade above $50 billion. But it really does, yes, the market may be looking a little frothy when you take a look at this IPO and the other IPO of the day. But I think really it comes back to the execution of the management, too. I mean, we knew from the S1 that this was a different kind of food delivery company than, say, a Grubhub or an Uber Eats. They'd been able to have a level of financial discipline, I think, at least from what we can see so far, that the others don't have. And that's really important. DoorDash has raised, what, $3 billion in its entire history before the IPO. Uber lost $5.8 billion this year alone. So what I think it might be showing us is that there can be some gig economy companies that don't just burn through billions of dollars, and the market is in part responding to that.
I suppose Bob Bassani is here as well, Bob. And I mean, at these levels, we're talking about a company worth something in the range of $75 billion, and it's not profitable yet.
Yeah, biggest IPO raise of the year, if you don't include the green shoe, as Leslie has mentioned. Market cap, north of 70 billion. So this will be the biggest one of the year. Snowflake was 42 billion. I don't have the numbers here, but that's my recollection. Was Snowflake was $42 billion market cap when it came public. So if you would have said in April that this would be the biggest year since 2014 for IPOs, and 2014, remember, was a big one, was Alibaba, I would have laughed at you. But the huge stimulus that we've had, the rather notable move up in the stock market, combined with the fact we've got a known name here in DoorDash, and we have very large retail presence, larger than we had a year ago, has really combined. Nothing beats an up market. So let me tell you, that's the most important thing that's going on here. But you've really got a remarkable confluence of events, guys, that really push this thing to the stratosphere.
Bob, I want to circle back. There's two separate things at play here. I mean, there's the first day pops for these IPOs, and then there's what happens after they get in everybody else's hands. And interestingly enough, that's been a pretty good performer this year. We've talked about the Renaissance IPO basket. It is crushing the S&P. Yep. Even names like Snowflake that went public at some eye-watering valuations have done well. Even if you go back to last summer and look at Beyond Meat, I mean, it hasn't been that much of a dog, even though it's well off of the highs. Leslie, I guess I say all of that to kick off the point I want you to elaborate on, which you have so well already this week, but how much of this is market professionals looking to close out the year with a couple, 10 extra percentage points of alpha that they can't find elsewhere. I mean, this is just a remarkable move. I was excited, and I say, excited. I was shocked when it priced at 102.
Yeah.
Even more shocked when the range was at 155. And look, we're up at 185 and change right now.
Yeah, so advisors I was speaking to around this deal priced at 102, expecting it to trade up to about 130, 140. I don't think anyone really foresaw 182 for the opening price here, especially since they really did try to kind of limit that first day pop. They introduced this hybrid auction system. It was previously used with Unity. They tried it again, and this time on a much bigger scale, since they raised $3.4 billion from this IPO in order to kind of assess some data, use an algorithm to take in orders and find what could help them maximize the price by which to set for this IPO so that they don't leave too much money on the table.
I mean, but Leslie, does that tell us whatever the fancy process was, they either left a ton of money on the table, or what I really think is going on here is it would have been impossible to raise this amount. The whole point was for the investors involved to get this pop, don't you think? I mean, I have a hard time thinking that this is really a flaw of the IPO process.
Well, there is kind of a fulfilling prophecy, as you mentioned earlier, with regard to the previous IPOs performing well. As long as the previous IPO is performing well, people will keep coming back to the well. So if you're an investor and you invested in Snowflake and you're sitting pretty for the year and you said, that deal worked and my banker is telling me that this deal is the next Snowflake, they're going to be willing to pay whatever it takes to get allocation because they see this demand. As we've talked about, it's coming toward the end of the year. People have just a few more weeks to really lock in their outperformance for the year. And so if you're hearing that there's a hot deal like DoorDash, you're kind of in this, I don't care what it takes, I'm going to pay whatever to get allocation. And then you have all of this retail demand coming on top of it in order to get into this deal. You see dynamics like this one where regardless of the amount of technology that you use to find a price, it's just going to go up.
You know,
ahead,
they
Bob.
have been trying to get this right, how to get the price right on the open for 100 years. Okay, so this is an interesting study in behavioral economics. How do you sort of game everybody else out in the future? So what has happened, with that said, the difference between 102 and 182, that's unusually wide.
Yeah.
And we all know that. So how does that happen? And I think what you want to see here is, I think the retail investor, the larger presence of the retail investor this year really is very important in this overall equation. And I'll tell you how I want to see this. Normally, on a good day, an IPO will trade 100% of the float that we're seeing here. So that would be considered a lot of trading. I'll bet you we will see as much as that. And we open at 1 o'clock. I mean, normally an IPO opens between 10 and 11 o'clock. We open 3 hours later, and I'll bet you'll see enormous. And that will be a sign, I believe, that the retail presence is much stronger than it has been this year, than it historically is on these kinds of events.
And Deirdre,
Kelly,
let's not forget C3PO, as I like to call it. C3AI is the other IPO that we had today. And lest anybody think this is just about DoorDash, C3 priced at 42, or IPO'd at 42, opened at 100, Deirdre. So this is not just about DoorDash.
Yeah, and we talked to the CEO earlier, and I think he was a little bit shocked at how high it had gone too. But let me talk about the opportunity a little bit. Aside from the first day pop, when it comes to a DoorDash and Airbnb, these are founder-led, founder-controlled tech companies. Look at sort of what retail investors, many of them have been looking at this year. Elon Musk at Tesla, Jeff Bezos at Amazon. These have been companies that just continue to get bigger and bigger and bigger and attract attention from the investment world. You have Chesky over at Airbnb and Tony Xu at DoorDash. These guys are seasoned operators because these unicorns have been in the private market so long. They have been tested. So perhaps some investors are looking at this as an opportunity to get into a founder-led company, particularly as some of their rivals, I'm thinking Uber, I'm thinking Expedia, Booking Holdings, are not led by their founders.
Real quickly, Bob, a final point here. Is there data on how well, let's call it kind of the retail, the general public has done on these IPOs relative, if you strip out that first day pop? I mean, it would seem like the performance has still been pretty strong, but this is where people can get burned.
Yes, you have to make a distinction between historical performance and what's happened this year. It's a little bit of an anomaly this year. Historically, on an IPO, certainly in the first year of trading, the big money is always made on the first day. If you get a first day pop there, those are the people that are bought in on the IPO initially. They got the initial allocation and sold on the first day. They're the ones who do really well historically. That's why a lot of IPO research companies separate trading after the first day when everybody's sort of cashing out who got the initial allocation, and then after that. The aftermarket performance of most IPOs has not been that great historically. This year is a bit of an anomaly. The aftermarket trading, by aftermarket I mean after the first day of trading, has been much stronger than normal. That's, again, a sign of an upmarket, a huge interest in tech and biotech, which is the historic ground or early stage tech and biotech companies for IPO. So again, it's a good sign. I don't know if it's going to last, though. This is a rather extraordinary year on many, many fronts.
And it's an important thing to point out as we look at DoorDash, up 73% right now. Thank you all, Leslie, Deirdre, and our Bob Pisani. Let's bring in some market pros now to react to this monster IPO. It does come on the same day that Bank of America is warning stocks are trading at record high valuations if you look at so-called EV to EBITDA. The firm's sentiment gauge also at its most stretched in 18 months and close to triggering a sell for the first time since the financial crisis. Joining me now is Michael Yoshikami. He is the CEO of Destination Wealth Management, and Chris Zaccarelli is CIO of the Independent Advisor Alliance. It's great to have you both here. Michael, you've seen, cycles. You went through 99. What do you make of today's trading activity with DoorDash?
It smells a little bit like 1999, Kelly. I mean, really, investors are not really so much focused on fundamentals, obviously, right? The IPO is priced at 102 because that is the maximum price that investors likely would pay on a fundamental basis. And now the stock's trading, I'm getting dizzy watching the stock bounce here at 175, 185, 180. So we really have a lot of speculation. I think what Bob Pisani said was really a fantastic point, which is look at the float. I think retail investors are making a huge move in this stock. The Robinhood world, I think, knows this name, uses this name, and that tends to drive, I think, sentiment. And I think what we're really talking about, this is not a fundamental stock right now, not when you've lost $500 million last year. It's instead basically a sentiment stock. So what kind of investor are you, sentiment or Buffett?
Fair enough. And so if your clients called, and asked and said, hey, did I miss the boat here? Do I need to be buying DoorDash? What would you tell them?
They have. And I've told them you probably will miss the boat, but you're also going to miss the other boat. You know what the other boat is? As again, Bob Pisani pointed out, the other boat is that most investors make their money on the first day, the IPO investors. What really matters is if you're investing for long-term, if this is retirement money, if this is money you can't afford to lose, you probably want to stay away from names that are highly speculative, buy cash flow names, boring as can be, but those are the kind of names that are going to be the foundation of long-term success. This is exciting. It's a nice, real quick pop, but excitement comes with danger. And I think most of the people we work with are not looking for lots of danger.
Sure, I understand that. Chris, what are your thoughts on this IPO today? Remember, it comes a day before we get Airbnb tomorrow. It caps a year of really, really strong IPO performance. And again, to emphasize what Bob said as well, I mean, it's been strong in the opening pops, obviously, but it's also been pretty strong for the names in that IPO basket. I mean, they've been, this emerging class of equities, more or less, is holding up there. All right, we'll fix that and get back to Chris in just a moment. So, Michael, you get the question on that. I mean, what's the distinction for you between a stock that is too hot and dangerous for most of your clients to touch right now, and the fact that most of these emerging equities, these new IPOs, they have actually done pretty well?
You're talking about price, right? Think about what you're talking about
over
here.
Time,
price.
over time, yeah.
So that's, well, what's time? We're talking months, right? So price and months is a definition, Kelly, of momentum, right? So fundamental investing essentially is going to say, let's look at historic cash flows. Let's look at cash flows not only during the pandemic. Let's look at cash flows that start to normalize when people are going out to eat, when people are not just ordering food constantly through DoorDash, which I'm a user of DoorDash, great service. Am I going to use it as much when I can actually go someplace and sit down and have a meal? Probably not. So that's what you just have to be aware of. So I think that it's important that you recognize that these are the kind of names someone can certainly chase. It's just a matter of whether or not this is really consistent with your investment philosophy as you invest your portfolio. And I think investors have to ask themselves that question.
And Chris, what were you saying?
What I was about to say was, I think a lot of these IPO companies that we've seen this year, they really fall into that COVID-resistant basket. So for those companies that are going to do really well when you're stay-at-home stocks, but will also do well in the future, that's why you've seen such good performance. But valuations are getting really high, and so we think that's a warning sign. We would be cautious at this point for the market as a whole. You can really see the risk-on sentiment that's pervasive within this IPO environment. But that is across the broader market as well. We definitely would look to this as a sign to hold a little bit of cash on the sidelines, watch for the upcoming catalysts that are coming down the road. We've got fiscal talks. We've got the Georgia elections in January, which will determine control of the entire U.S. Senate. So there's a lot of catalysts coming down the road. Valuations are high. The stock market over the next 12 months, if you look at the multiple, it's 22.1 times earnings for the S&P 500. Over the last 25 years, it's been about 16.5 times. So we're pretty elevated from history. We're not in the 1990s yet. Back then, it was over 27 times. So it's not that the market can't go higher. It's just that we would exercise caution at this point because we think valuations in general are quite a bit higher than average.
Chris, what about those who say, though, if we're looking at least on an earnings basis, that earnings next year could come in pretty strong? I mean, are we underestimating the earnings power in this market, as you guys have said, once things open back up, start to normalize?
Earnings could definitely be a lot higher next year, and we do expect that. Earnings were depressed artificially because of what happened with COVID and the lockdowns this year. But even if you're talking about 190 times earning, even if you're talking about $190 in S&P 500 earnings next year at a 20 multiple, you're looking at 3,600. So we're already right around. If you're at $180, you're at 3,600. Or if you're at $190, which would be high, then you're looking at 3,800. So the S&P is already pretty close to 20 times what's likely to be a stretch for next year's earnings. Doesn't mean that we can't have multiples expand. Doesn't mean that earnings can't surprise even above that. But as an investor who's trying to be somewhat cautious, I think it makes sense to pick your spots and to look for where the market has the best opportunities, not necessarily the ones where the valuations are highest.
Yeah, and it's amazing. I mentioned earlier C3 AI, which is the other IPO today, up priced at 42, opened at 100, and according to our data team, it's only the 9th best IPO open of the year. I mean, that is just emblematic of what this market has been doing. We'll leave it there.
If I could,
go ahead, real quickly, Michael.
Let me add something real quick. Even if earnings aren't as high as maybe some expect, you have to understand we're looking at year-over-year comparisons. That would really drive stock prices. So there's a difference between earnings and stock prices. That's why the stock market's gone up this year, is the expectation. So be aware that earnings, if they come in reasonably positive, they got great year-over-year comparisons, that could potentially be a catalyst for the market next year.
Yeah, you would think. Exactly. We'll see. I appreciate you both joining us today, talking about this DoorDash IPO and the rest of the whole market. Michael Yoshikami and Chris Zaccarelli. And a quick note, the S&P, which has climbed 14% in 2020 already, has just 4 names that are still in the red for the year. You can find them on cnbc.com/pro, so head on over there. Coming up, the DoorDash splash is setting the stage for Airbnb's IPO, which is next on the docket. But the company is facing one major issue that investors may be ignoring. We'll tell you about its problems in China. And Disney hits an all-time high as Investor Day looms. Will streaming be enough to keep investors interested as parks reclose and consumers stay away from theaters? We're back in a couple.
This is The Exchange on CNBC.
Welcome back. Even as we catch our breath from DoorDash, Airbnb is next on the IPO deck. It prices tonight and starts trading tomorrow. But the company is facing several challenges, especially when it comes to China. And that's where we find our Eunice Yoon, who's live in Beijing with this angle for us. Hi, Eunice.
Hi, Kelly. Well, despite U.S.-China tensions, regulatory issues, and fierce local competition, Airbnb sees China as important to its future growth. And we spoke to one business person who said that he's looking very much forward to the company's bigger push here.
Beijing architecture student Runjun Kun is excited about Airbnb's IPO. Not because he's an investor, he's a host, renting out rooms in this traditional courtyard home. If Airbnb gets more funding and invests in promoting home sharing in China, I can get more customers, he says. At $2.9 billion in 2019, China's home sharing industry is still a fraction of the size of the U.S.'s, but growing in the double digits every year. Airbnb has expanded fast, winning over Chinese with its flexible app and travel choices, especially overseas. But the U.S. home-sharing giant faces stiff competition here, with strong local backers. Tujia, the dominant player, partners with travel titan Trip.com. Xiaoju is backed by Jack Ma's Alibaba, Elong, Tencent. And Meituan B&B is pushed business by another major tech name, sister firm Meituan Dianping. Airbnb also faces scrutiny back home due to data privacy concerns doing business in China. Run isn't concerned. He's looking to refurbish and rent another 2 homes nearby. Beyond a place to sleep, young Chinese want a unique experience, a cultural touch, or advice from a local, he says. That's why I have faith in the future of homestays.
And Kelly, one thing that I found interesting about data privacy, Airbnb is getting a pushback in the U.S. about maybe not providing enough or providing too much information to the Chinese authorities. But here in China, its reputation is actually for having the best data privacy protection because it doesn't allow the landlords or the hosts to see the full contact information and the ID number of the tenant.
That's interesting. And Eunice, I guess with any of these companies, these American companies who are successful in China, I just can't help but wonder, is China really going to let them win? I mean, are they not ultimately going to back their own not state-sponsored, but their own homegrown version because they have the kind of system where they can simply just decide who the winners and losers are?
Yeah, that's right. I mean, that is a risk for Airbnb. I think for any U.S. or international company that wants to grow the business. It doesn't mean that the company can't have a good business, but it's definitely one of the risks. I actually asked that Airbnb host if he was concerned that at the end of the day, Airbnb might not be around. And he said that he really wasn't. And a lot of that is because Airbnb has been able to provide quite a good service. Most people here, if they're going to use a site, are using Airbnb. And for now, at least, they find that Airbnb provides the kind of highest quality service, the easiest, the most trustworthy service when it comes to people who will come to stay with them or for them to be able to use a service to go overseas or to another destination.
That's true. There's probably a lot of value in it being well known to the international traveler for whenever that business comes back. Eunice, thank you so much. We really appreciate it. Eunice Yoon in Beijing for us, and it'll be another exciting day with that IPO tomorrow. Coming up here, Bank of America's new survey shows consumers working from home plan to spend less in nearly every category but one. We've got the details and the stock impact. Plus, DoorDash open for trading, and what an open it is. Took till almost 1 p.m. It's up 82%, priced at 102. It's trading at 186 and change. We'll talk about what that will mean for Airbnb. And don't forget, you can watch us live on the go using the CNBC app anytime. We're back in a couple. Well, welcome back. Bank of America is out with its latest home work survey, revealing some insights on holiday spending, moving trends, and whether or not work from home fatigue is starting to set in. For more, I'm joined by retail analyst Liz Suzuki with Bank of America Securities, doing a little work from home herself probably. Liz, it's good to have you. And the headline here will be familiar to our audience. It's that people say their spending is going down on everything but on their pets. Is that right?
That's right. Yeah, really, the family pet is the winner this holiday season. Our survey showed that that consumers plan to spend less on most categories over the holidays, except for one, which was pet toys and accessories. So, even though people aren't taking their kids to Disney World, the pet is really getting the bulk of that spending back.
Yeah, and we've seen that with the performance of these names this year with I think it's PetSmart or Petco is now coming back to market for the third time. But you make an important distinction, which is there's a difference between what people say they're going to do on their spending and what they're actually doing. What have you found on the latter?
That's right. I mean, I think it is really important to differentiate between what our survey respondents said they plan to spend on and then what we've actually seen in the data itself. So our Bank of America credit card data continues to show very high levels of spending in categories like consumer electronics, home decor, and these were both categories that our survey had showed people plan to spend less on. So we're not seeing that happening in the actual spending.
Yeah, and that's actually held up relatively well. Let's talk about a couple of the stocks that you cover, Home Depot and Lowe's. There's some findings in here that are relevant for them, specifically on the home buying and the work from home side. Tell us about that.
Yeah, so our survey showed once again, and this is the third time we've run it. So we initially ran the survey in June, which was really like in the midst of COVID, and then we ran it again in September and now in early December. And what we've seen is that an increasing percentage of people plan to move to less population dense areas. So even though there's this positive vaccine news that's come out, the intention to move is still really strong. And so that's very favorable for home improvement retailers like Home Depot, Lowe's, Floor and Decor, where housing turnover is an important driver for renovation demand.
And so would you say the kind of takeaways from the investor are there can still be legs for Home Depot and Lowe's? A lot of people are worried about, even Stan Druckenmiller mentioned, are they going to have a hangover as people kind of go back to normal? And this has pulled forward a lot of demand. So Home Depot, Lowe's, maybe even a Tractor Supply. I mean, where are the names that these results leave you the most positive on?
Exactly. Yeah, we think that there are some COVID beneficiaries that continue to grow into 2021 and beyond, and especially those that have really sealed their dominant market share and are taking market share from smaller retailers in the category. So like you mentioned, Home Depot, Lowe's, Tractor Supply, these companies have now very, very strong cash balances. One of the things we saw from Lowe's today at their analyst day was that their outlook for next year, even in a worst case scenario, they still have their operating margin up and they plan to do $9 billion in share buybacks. So these companies have large cash hoards that they can then deploy towards growing shareholder value and also towards investments in deepening their competitive moat for the future. So, we really like those large, well-capitalized retailers that are dominant in their sectors.
All right. Liz, thanks again for joining us. We appreciate it today.
Thank you.
Liz Suzuki with Bank of America. The family pet wins Christmas, she says. Coming up, backdating claims and additional stimulus checks. Just a few ways states are working to help the unemployed as the country awaits congressional action. We have those details. But first, the Renaissance IPO ETF more than doubling this year, up 113%. We're going to dig into the biggest names in the fund and why one biotech stock that posted huge gains this year could soon get the boot out of it. That's next. Welcome back to the exchange. Let's get a check on these markets today. Remember, the S&P and the Nasdaq closed at record highs yesterday. We're over 3,700 on the S&P for the first time. Today, struggling to hold the open, which saw some gains. The Dow was up over 100 points at the highs, but we are at session lows right now. We're down 159. That's a 0.5% drop. We're down 0.8 on the Nasdaq and 1.7% on the Nasdaq. So a pretty ugly session there. As I mentioned, we opened higher and we actually hit another slew of records shortly after that. The Dow, the S&P, the Nasdaq, the Russell 2000s, and the transports all hit new highs before the pullback you can see here. Across the sectors, they're all in the red now. Real estate, technology, communication services, those are the biggest laggards. And let's get a quick check on DoorDash. Maybe people are selling everything else they own, buying this name, because the stock, which priced its IPO at 102, opened at 182. It is just below that level right now, 180 and change, up 76%. This makes it upwards of about a $80 billion market cap right now. We'll continue to follow the story. Over to Sue Herrera in the meantime for our CNBC News update. Hi, Sue.
Hello, Kelly. Good to see you. Hello, everybody. Here's what's happening at this hour. Big Ten athletic directors are expected to let undefeated Ohio State play in the conference's championship game. A vote is expected later today, which would remove the 6-game minimum that would have prevented Ohio State from playing. In Michigan, a belated recount has reversed the outcome of a county commissioner's race. Initially, the election was declared a tie and then decided by the candidates drawing pieces of paper to see who won. The recount shows the loser of that draw actually carried the election. In India, health experts have found traces of lead and nickel in blood samples from patients suffering an unknown illness. Nearly 600 people have been hospitalized. The vast majority have now been released. And in Guatemala, the Christmas season starts with a centuries-old tradition called Burning the Devil. It's been performed since Spanish conquistadors arrived in the 16th century. Kel, you are up to date. I will send it back to you.
Love it. Sue, thank you very much. Sue Herrera back at headquarters. As we talk about DoorDash and Airbnb, we wanted to take a closer look at the Renaissance IPO ETF today, ticker IPO. Now, it's outperformed the broader markets this year substantially. It's up 112%. Let's dig into it a little bit. What has been behind those gains? Here are the top performers in the ETF this year. Moderna leads the pack. It's up 737%. Remember, they're the second leading vaccine candidate. Zoom coming in second, up 476%. Cloudflare finally is up about 353%. So again, the top holdings right now in the ITF itself include Moderna, Zoom, also Uber and Pinterest. Of course, these stocks after some time are no longer considered IPOs. So what happens then? Companies are removed 2 years after their initial trading date when the stocks become what they call seasoned equities. Moderna will actually be removed when the IPO rebalances next week, and that will make room and cash for new companies like DoorDash and Airbnb. Speaking of Moderna, it's down 11% today. Robinhood's public plans, that's coming up next, along with Disney's fresh all-time high and its streaming pivot. And party like it's 2020. The Office holiday party goes virtual. It's all in rapid fire after this quick break. Don't go anywhere. Welcome back. Let's catch you up on a couple stories that should also be on your radar today. It is time for Rapid Fire. Here to break down the headlines are Leslie Picker, Julia Boorstin, and Michael Santoli. Welcome, one and all. First up, let's talk some Disney. Their Investor Day kicks off tomorrow. This has been nothing short of a tumultuous year for Disney, but against all odds, the stock has clawed its way back to an all-time high, thanks to the massive growth of Disney Plus. They face a lot of competition, though, as everyone goes all in on streaming. For good reason, more people are cutting the cord than ever. Last quarter was the first time paid TV operators lost more than 1 million subscribers. At the same time, TV streaming bundles, Julia, added just as many. What does Disney need to say and not say tomorrow in order to keep the positive investor sentiment flowing?
Well, what we're seeing, Kelly, is really that people are willing to pay for content. They're just paying for it in a different format. And I think whatever the concern is about cord cutting, there is optimism about people paying for these digital streaming bundles. And there's also a lot of optimism about Disney Plus. I think it's really notable that Disney's big investor day tomorrow, which is going to really be about the focus on the direct-to-consumer relationship and how they're going to navigate these weird waters going forward as we hopefully emerge from COVID next year and as people can start to get back to movie theaters. I think it's really important to note that it comes on the heels of Warner Media's big announcement that it's going to be putting its films in theaters the same time it puts them on HBO Max. And really this question of, is anything possible and how are you going to navigate this new world where people really want to be able to see stuff at home?
And speaking of which, Mike, did you see the Roku and what do we call this, an upgrade over at Citi? They moved their price target from $220 to $375. Yeah. That's the street high now. And they're talking, you can go through the reasons, but a lot of them, they're just talking about the value of each additional customer that Roku acquires and how big a number that is.
For sure. For a long time, Netflix was really the only way to purely play, internet TV streaming, whatever you want to call it. Roku is now of a scale where it's completely of that size as well, and it's growing very fast. So we're in a market right now that is valuing future dollars a whole lot more than today's dollars in terms of revenue. And as much as you want to pile on to the expectations for the future, the market is willing to bid for it, at least at this moment. When it comes to Disney, it's fascinating because it's at an all-time high. The valuation is beyond an all-time high because of all the debt. And yet, so much of their business is still, pretty much impaired based on the pandemic. So it's a combination of a shutdown play and a reopening play all at once. Got a lot of credit so far up front.
Yeah, no, I totally agree with you. There's Roku shares, which are fractionally lower today, but have more than doubled this year. Let's move on and talk about what could be the next IPO, and it's Robinhood. They may be tapping Goldman to lead the IPO, the platform experiencing meteoric growth during the pandemic, with retail traders becoming a major factor in the market this year. And Leslie, what are you hearing at this point about Robinhood and demand for it? In light of DoorDash and everything, there's no way this one would be before year end, right?
Oh, no, it can't come before year end. As far as I know, they haven't even filed with the SEC yet. Based on a couple of people who I was able to talk to about this deal, they have not officially hired bankers, signed all the paperwork and so forth. It's discussions that they're having with people, letting them know that they're likely hired, that kind of dance that they're doing. But it does sound like they are moving forward with an IPO 2021. It's funny because some reports out there have floated the target valuation as being $20 billion. If there's anything that this week's IPOs have shown us, it is that you cannot predict valuations for these IPOs, especially when you're looking at about 6 to 9 months in the future. Things can change dramatically, but this clearly is similar to DoorDash and Airbnb in that it is another company that's benefited from the pandemic.
Yeah, Mike, one of the great reads everyone should check out was Jason Zweig talking about his Robinhood experience in the Wall Street Journal over the weekend.
100%.
It was hilarious. Yeah, but the focus on their business model, if and when they IPO, is it more or less still a pay for order flow type of model? And how much scrutiny were they going to come under?
For the most part, yes. Payment for order flow. Margin lending, of course, is also a part of it. You would pay for that if you wanted to borrow money against your account. But right now, this will be marketed as a fintech company, not necessarily as, this is a comp to Interactive Brokers, which, by the way, is a $23 billion valuation. It has a couple of $100 or $300 billion in client assets in it. It's not really necessarily about that. We have the intense engagement of a cohort of investors, of young consumers who the rest of the industry can't really reach very easily. And yes, we've gamified the whole system, as Jason Zweig pointed out, and it makes you want to just kind of win your next trade, and it gives you all these claps on your smartphone when you do so. And you know, I guess this is the market we're in. I think take that as both a good thing for risk appetites and a warning sign for just kind of how, you know, credulous we are right now.
And I'm sure there's going to be a whole raft of stories about whether the IPO of Robinhood itself marks some kind of market peak if we don't see it already at that point. All right, we just brought up DoorDash. Let's talk about that for a moment. It was the first of two blockbuster IPOs this week, and the trading today has just been nothing short of astonishing. So it's ticker Dash. It opened just about an hour ago, and the open price was $182. Now, it priced at $102. It's up 77% right now. It's been pretty steady the past, 45 minutes. This comes as Airbnb is set to debut tomorrow. And Leslie, is it as goes DoorDash, so goes Airbnb, or are people kind of separating and looking at them very differently?
We have seen similar patterns, at least procedurally, as this IPO process for the two deals have kind of coincided with one another. They both priced or set a certain range. They raised that range. DoorDash priced above that range. It's sounding like Airbnb will look to do the same, although could still price kind of at the high end of that range is the chatter that I'm hearing, either above or at the high end of that boosted range. And so, they're both using this hybrid auction method that we've talked about that's supposed to try and limit that first day pop. They may be looking at this one and the better than expected demand on the first day of trading and maybe price a bit higher, be a little bit more aggressive than they otherwise would have if they, didn't see today's trading. But it's clear that there's a dynamic here. Investors are clamoring for these deals because it is toward the end of the year. If they sense something is hot, and as you know, a lot of this has to do with psychology. A lot of it has to do with kind of the chatter, not on the trading floors anymore, but at least in the internet ether, in the chat rooms and so forth, about whether this deal is hot and whether people should be buying in. And that limits price sensitivity.
Yeah.
And so that's kind of why you're seeing moves like this today. Airbnb may try and limit that with more aggressive pricing tonight. But we'll see. They may see something similar because sometimes this stuff is out of their hands.
Julia, what would you add?
Well, I just think it's interesting here. It's not just DoorDash that's having this massive first day pop. I mean, DoorDash up 75%. It's also C3 AI, this artificial intelligence company. That stock up over 100%. There really is this built-in expectation that there's going to be a big first day pop. I think there's a lot of speculative trading because of that. So I think it'll be really interesting to see if the following IPOs try to make sure they're not leaving that money on the table.
We just got to get a closing word from Michael Santoli here. Mike, what do your spidey senses tell you about what's going on here today?
I mean, there's such an appetite for something that is both a recognizable brand name that everybody uses, and that basically it's not based on this year's numbers or next year's numbers. It's really about the overall market. You can kind of draw that as large as you want. So it all makes sense. And I would just modify only one thing that Leslie says is that it's not mostly about psychology. It's almost entirely about psychology in the first and second day. And so I do think that maybe the NASDAQ being down a couple % today is going to take a little bit of the steam out of it. But otherwise, I think you're still going to they're going to try to gun these every time until one fails.
Yep. And we'll see how tomorrow goes on that note. Before we go, this story made us all chuckle. What the lengths that some companies are going to this year for the holiday office party, why not just get rid of it? All right, here's some examples. This is according to Axios. PayPal is hosting a 29-hour virtual event that includes cooking classes, circus performers, and a dance-off. Leslie, who needs an office holiday party? Do we want one? I mean, how does it even? I can't. What do you think?
Well, I don't have any other plans, so that sounds good to me these days. No, it's funny how 2020 makes you kind of reflect and miss things like holiday parties where, any other year you'd be like, oh gosh, I have another holiday party to go to. I just want to go sit on my couch and watch some streaming television. As we talked about earlier, this year, you kind of miss that stuff. It's the stuff that you take for granted. I applaud those HR departments that are trying to be creative and get people together. I don't know if it replaces the same thing, but perhaps people can get in a little less trouble if it is virtual.
I know. I feel bad. I mean, Julia, you can imagine like these companies that put on these huge events every year. I'm talking about the ones that are putting on the party. I mean, how they are making, I don't even want to know how bad their financial situation is. And in the meantime, for the kind of holiday office party, how do we make the most of it?
Well, I think there is this fundamental challenge if you're trying to have a party in these times. Number one is that everyone is Zoomed out. People are on Zoom all day long. They don't really want to do another Zoom at 7:30 at night, even if it's supposed to be festive. And then there's also the challenge of how to make anything feel different when we're all sitting in the same chair in our home all day long. But one thing that I think really is interesting, Kelly, is that some of these companies have adapted. I went to a holiday event where there were cocktails, like a cocktail kit delivered to my house. I've heard of others where they're doing wine tasting with little mini tasters of wine. So the people who are Zooming together are actually doing something tangible together, such as drinking a fancy cocktail. So I think there's been some innovation there, and there's a lot of experimentation, but it's still hard.
Does Santoli boycott the holiday Zoom
I was just going to
office
say,
party?
I thought I was the only one who was kind of old and boring enough to say I would never want to go to the holiday party. But apparently it's a general sentiment here with this group.
Yeah, it's
intergenerational.
But this year I would be there with bells on. I agree. In other circumstances, Leslie, Julia, and Mike, thank you all today. We appreciate it. That does it for Rapid Fire. Still ahead as lawmakers on both sides of the aisle continue to tussle over a stimulus bill. States are finding creative ways to get cash to the unemployed. We're going to look at some of those solutions and their costs next. And be sure to tune into CNBC tomorrow, 8 p.m. Eastern Time. It's the path forward for race and opportunity in America. A closer look at the economics of the Latino community, including representation in corporate America, education, and entrepreneurship. Stay with us. Welcome back. Without additional stimulus, states are stepping in and coming up with some creative ways to get money in the hands of the unemployed. Rahel Solomon joins me now with a closer look at just how they're doing so. Rahel?
Hi, Kelly. Well, more than 20 million people are still receiving unemployment of some sort, But money is drying up. Nearly every program created to help those who have lost their jobs has either ended months ago or will soon end. So local governments, as you said, are trying to do what they can. The mayor of D.C., for example, announced this week that it's issuing a $1,200 payment to D.C. residents who are on pandemic unemployment assistance. That's coming from its CARES Act funding. Connecticut's governor announced an executive order to help nearly 40,000 residents qualify for lost wages assistance. New Jersey also expanded its LWA program. And Pennsylvania is speeding up the process of backdating claims to make up for those long delays when people initially filed. But Kelly, the question is, are these measures just a Band-Aid fix? Well, Elizabeth Pancati is a policy advisor at Employ America. That's a left-leaning think tank. She tells us these are more like stitches, absolutely necessary and very helpful, but it doesn't get at the root problem of the initial giant gash, adding that while the effort from states is applaudable, it's really the federal government that has to step up and extend and fund these programs. And Kelly, if there is not action in Washington soon, the Brookings Institution projects that by the end of this month, about 10 million people will lose benefits.
Is it dependent, Rahel, on the states having the financial wherewithal to do this, or are some just more creative than others?
We wondered the same thing, not exactly, because the states that we mentioned have all had to borrow from the federal trust fund, so they're not exactly in the greatest financial shape. I think it just more so depends on the financial need in those places. I think they're just stepping up, seeing that the need is so dire.
Fair enough. Yeah, that would explain, especially like you said, in some of the states like New Jersey. Rahel, thank you. Rahel Solomon following the story for us. That does it for us on The Exchange today. Up next on Power Lunch, we'll check in on shares of FireEye, which are falling after the company said it was the victim of what appears to be a state-sponsored cyber attack. We'll talk to a former National Security Agency hacker about it. I'll join Tyler Matheson after this break.
Welcome, everybody. Good afternoon. This is Power Lunch along with Kelly Evans. I'm Tyler Mathis. And stocks are near the lows of the session, as you see right there. Red numbers for a change. After hitting record highs, J.P. Morgan has a warning out about some of the biggest winners this year, and that is certainly contributing to the numbers you see right there. Dashing higher, Dasher, Prancer, DoorDasher, nearly doubling on its public debut right now, trading at $177 a share. We will have more on that and the big year for IPOs coming up. And we are watching shares of FireEye, the cybersecurity firm that companies turn to for protection, becoming victims of a state-sponsored hack. We've got those details as Power Lunch starts right now.
Thank you, Tyler, and welcome to Power Lunch, everybody. Today is all about the IPOs. A huge end to a huge year. Bob Pisani has those details for us. Leslie Picker is looking inside DoorDash and ahead to Airbnb tomorrow. And while SoftBank is profiting from the DoorDash deal, it may be taking itself private. Deirdre Bosa is on that story. Bob, let's start with you.
Well, I think the important thing, by the way, just on the markets, we're sort of losing steam ever since DoorDash went public, actually, here. And market leaders like semiconductors have been weak. We'll keep an eye on that and let you know what's going on. Been an amazing day there's the S&P sitting at the lows for the day. Been an amazing day just overall for IPOs and overall for the markets here. I wanted to show you DoorDash, of course, went priced at 102, went public at 182, just below that. Right now, an hour and 15 minutes into trading, 33 million shares they floated. Right now, there's almost 20 million, about 19 million shares traded. In an hour and 15 minutes, 19 million shares compared to the 33 million float. That is a lot of trading and a testimony to how much retail interest I think there is here. Same with C3.ai, by the way. They floated 15.5 million shares, and already almost 20 million has traded, believe it or not. Now, they opened a lot earlier, remember, but still, this is an enormous amount of churn in a day. And again, interest from the retail investor, in my opinion. This has been a huge year for IPOs, a big, big close to the year. We've had 202 deals so far. That does not include Airbnb. It's raised $73 billion. This is the best year since 2014 for total raises. And remember, 2014 was the record because we had Alibaba. We raised $85 billion. We're going to get close to a record year, believe it or not, amidst all of this craziness here. IPOs in 2021, you got a lot to look forward to. You've heard us talking about Robinhood potentially coming, but there's also SpaceX, there's Stripe, there's Waymo, which is Alphabet's autonomous driving unit. There's Instacart as well, which is one of the DoorDash competitors as well out there. And remember, SPACs have had a big year too. We haven't finished yet, but SPACs have raised almost the same amount of money. 200 SPACs essentially have raised $64 billion. And in 2021, heavens, we've got 200 others that are already out there that are looking for acquisitions. The bottom line, guys, is it's going to be a very busy year, at least for the start, in 2021 for IPOs and SPACs. Back to you.
And Robert, clearly, as you point out, a lot of retail interest there, as indicated by the amount of churn we're seeing today. Bob Pisani, thanks. Billionaire Tillman Fertitta told us yesterday about the strength and the pull of the public markets right now. Listen in.
The IPOs are so hot right now, and the size of my business and the restaurant industry and the gaming industry is something that people would want to own. And so I've listened to bankers, and they've said some very intriguing things. There's also going to be, disappointingly, there's going to be great opportunity coming out of this pandemic.
Hint, 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 Leslie Picker. Let's go to you and check out a little bit more about the IPO market.
I like that. Away. Bankers do tend to say intriguing things, especially when there are dollar signs involved, which there clearly are today. I just want to put some things in context. DoorDash going public with an opening trade that values that company at $69 billion on a fully diluted basis. That's over 4 times the company's valuation from a private financing round in June. That's less than 6 months ago. These types of moves are rare. In recent years, the public markets have actually been more conservative than the private markets, but This is what we call a story stock, meaning it plays into some of the big investing themes of 2020. There's no denying that food delivery has become a bigger part of Americans' lives during the pandemic-induced restrictions on restaurants, and DoorDash has disproportionately benefited, reaching #1 market share in online food delivery. Look no further for their benefit than DoorDash's top line, which nearly quadrupled in the third quarter, along with glimmers of profitability over the spring. And then another 2020 story stock, Airbnb. The home rentals platform is pricing its shares tonight. I'm told, like DoorDash, this time yesterday. It's expected to come in at the high end or above a boosted range. That could value Airbnb upwards of $42 billion on a fully diluted basis. But we'll see tomorrow what the trading entails on that one.
When you look at DoorDash, Leslie, how many billions have they added today in value?
They have, it depends on the time frame, from the $16 billion valuation. Oh gosh, that's what, 60, 50, $55 billion in valuation that they've been able to add. When you look at where they priced their IPO at last night, they were valued, oh gosh, off the top of my head, I'm trying to remember what it was. Let's just put it this way. They have added a ton of money to their valuation in an incredibly short period of time, which is remarkable, especially when you consider that this is a pandemic year. This is a year where we've seen a tremendous amount of restaurants go out of business. We've seen people struggling. And then when you look at kind of the dichotomy that you see in the public markets with companies that, were valued at $16 billion just 6 months ago, now we're valued at close to $70 billion. It's just a remarkable achievement of wealth in a short amount of time in a very wild year.
Sorry to put you on the spot there, but
No,
whatever
okay.
we can say is many.
It's not
Oh
so strong.
my God! It's many billions.
Many
and this is the
billions.
case of a company who was in the right place at a bad time, the right place
Correct.
at the right time for them. Leslie, thanks. Our next guest says he would avoid DoorDash, but investors can rest well with Airbnb. David Traynor is CEO and founder of New Constructs, a market research firm. He is also a former analyst at Credit Suisse. David, welcome. Good to have you with us. Is this company DoorDash a dash in the pan?
You know, I couldn't hear what you're saying.
The answer
We're having a technical difficulty, but let me just say, DoorDash is the WeWork of food delivery. The valuation here is absolutely astronomical. When we call this the most ridiculous IPO of 2020, and by the way, WeWork was the most ridiculous IPO of 2019, the valuation around $30 billion implied around 50% market share ownership for DoorDash. At the current $180 stock price, we're talking about more like over 120% of market share ownership for DoorDash to justify the current stock price. So, look, this is a business we don't think will ever make money. There's too much competition. Look, at one point, Grubhub had 50% market share and positive margins, but as soon as DoorDash and a bunch of other firms entered the market, their margins went highly negative, their market share went way down. That's a cycle that will continue no matter who's at the top or whoever can burn the most money. And we think investors need to stay away from this. This is a big shift of risk away from Silicon Valley to individual investors and a shift of wealth away from public investors back to SoftBank and the other big private equity firms.
So, David, are you able to hear me now, or are you still sort of radio silence? Do you hear me? I guess
Yeah,
David
I still
doesn't
can't
hear
what
me.
you're
So what we're
saying,
going to do? Okay, what we're going to do is we're going to come back to David Traynor and get some final thoughts there. But meantime, over to Kelly and Deirdre Bosa. Kelly?
Tyler, thank you. SoftBank could stand to make $10 billion from DoorDash's IPO. At the same time, reports say SoftBank itself is thinking about going private. Let's go to Deirdre Bosa, who's got more for us. Deirdre?
Well, Kelly, at $10 billion, DoorDash could be the Vision Fund's biggest win in terms of return. And that's more ammunition for Masa-san to lament the underappreciation of SoftBank by public market investors, something he has said many times in the past. But back in 2018, when SoftBank first got in, DoorDash was far behind Uber Eats and Grubhub. Your last guest just alluded to this. It was also worth less than $1 billion. Masa-san saw something that other investors did not, and in this case, it worked out. Now, going private could give him more leeway to make these big, sometimes questionable, less understood bets. The issue is that SoftBank has a current market cap of about $130 billion, so taking it private would, of course, require a lot of financing. But this time, Bloomberg is reporting that Masasan himself is debating gradually buying back outstanding shares until he has a big enough stake to squeeze out the remaining investors. Just last month at the DealBook conference, Masasan told Andrew Ross Sorkin that he is a believer in the company, and if the share price drops, he would be a buyer. Shares, however, have continued their rise this year, trading near 20-year highs. And I'm told by a source close to SoftBank that this doesn't appear to be under serious consideration. But Kelly and Tyler, this is Masasan, and he has been known to surprise us, so I wouldn't entirely rule it out. Back to you.
Still, Deirdre, like you said, $130 billion valuation. He can't possibly do it on his own, can he? Or what kind of partners or leverage strategies would they have to come up with to pull this off?
Well, as we know, SoftBank has been selling a ton of its assets, winding down stakes in companies like Alibaba. It was supposed to raise a ton of money through Ant Financial, Ant Group. So it has raised a significant amount of money this year to the tune of, I believe, some $80 billion. So that would help. But that's why this reported strategy would be different. He would quietly buy back shares so that he had something like 66% to squeeze out the other investors. It is a little bit of a long shot, but like I said, it's Masasan. He's been known to do some, unusual things. And, on nearly every earnings call, I listened to the quarterly call, and he says the company is undervalued. So, it sounds like he's frustrated that he doesn't think the public markets are valuing the company where he thinks it should be, and he may take that into his own hands.
Like you said, he loves the moonshot. This would certainly be one. And the shares are up about 5.5% today. Deirdre, thank you so much. Our Deirdre Bosa following that report. Tyler, over to you.
All right, thanks, Kel. Let's go back to David Traynor for some more thoughts there. We've repaired our connection to him. And David, you said a lot of provocative things, even though I didn't even get a question in your ear. You said that this is the WeWork of 2021. You said we've lost him again. Let's just leave it at this. Mr. Traynor does not like DoorDash's IPO and thinks if you are a retail investor and you've bought it today, or you're thinking of buying it now in light of a 75% gain today, you will regret it down the road. On the other hand, he has a more sanguine look at Airbnb. We'll try and have him back with us on another occasion. Still ahead, we'll have more. Yes, more on the DoorDash IPO throughout the hour as we get ready for Airbnb to price its IPO after the bell. And there you see real-time reaction, potentially, to what David Traynor just said about it. Stock very volatile. Plus, despite all the euphoria, JP Morgan out with a stark message to the markets. Some of the hottest stocks this year could be about to cool off. We'll tell you what it means and why, what it means for that record rally when Power Lunch returns. Welcome back to Power Lunch, everybody. The markets are lower today across the board and sinking this afternoon. The NASDAQ leading the declines, down nearly 2%. Tesla, one of the biggest decliners in the NASDAQ 100. Some of the big winners are pulling back today, and JP Morgan with a warning today about some of this year's hottest stocks, downgrading some of those high flyers, including Zoom, CrowdStrike, DocuSign. For Zoom, the brokerage says the upside potential is already priced in. And for more on that downgrade, go to cnbc.com, Kelly/pro.
Will do. And if those high-flying growth stocks that help lead the markets higher all year long start to lose steam, what does that mean for the record rally? Let's bring in Dan Suzuki. He's the Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, it's good to see you again. So I've been thinking a lot about the early September example when you also had a market that seemed overstretched, when we have big cap tech names that are still kind of sideways, if not lower since then, and wondering, could a reset right now be one that happens beneath the surface as opposed to one that has the whole market down 10%?
Yeah, Kelly, I think you're right. I think that's a big risk for the markets here. I think, if you look at we look at profits, liquidity, and sentiment at RBA, and the profit story in the near term, clearly there's a lot of risk. But if you look 6 to 12 months out, that story is looking better. Liquidity is looking very good. Policymakers over the next couple of weeks are likely to provide even more, reason for optimism in terms of support. So then the real issue here, the big risk for the markets, is that clearly, sentiment and valuation have run a bit very quickly over the last few months. But if you're worried about sentiment and valuation, to your point, then you can look at a clear part of the market where those elevated valuations and popularity and crowding exists, and it's not in the widespread market. So I think that you can have an opportunity to invest in a lot of these unfavored names and still do very well. I mean, if you think about 2000, 2001, not that this is 2000, 2001, but actually small cap value stocks were up like 40%. Over that period. So you can have gains in some of these areas while there's an overall rotation happening.
How long, so Dan, let's say, because I know you guys are on the side of saying, maybe now's the time to take profits in your growth stocks and rotate into some of these other names. I mean, how long can that narrative run? I've seen some like Andrew Wellington yesterday who said, this could be an 8.5-year kind of value cycle. Others seem to be thinking about this more as maybe a couple months repositioning. What are you thinking?
I think there's a cyclical story here, and there's a secular story. And I think the cyclical story is that really this is nothing that's very specific to this cycle. This is true in most profit cycles, is that when the profit cycle's looking like it's going to recover, you want to own the beneficiaries of that recovery. So tech, to their credit, has done very well this year, and it's been rewarded for that outperformance in terms of profits. But as you look for the next 12 to 18 months, that story is going to reverse, and a lot of that room to see profits boom over the next 12 to 18 months, that's in sort of these value cyclical areas of the market. That's the cyclical story. But if you think about over the next 10 years, then the number one driver of that is probably going to be current positioning, current sentiment, and current valuations. And if you look at any of those three, they're clearly supporting, those value names, particularly not just in the U.S., but outside the U.S. and particularly in small caps as well.
So let's talk as well about some of the areas that you would be looking at. Said increased exposure to cyclical areas like transports and energy and materials. Also, kind of quality and diversification, healthcare, staples, and gold. Any kind of strong preferences in there in particular?
Well, I think what you're sort of referencing right now in terms of our positioning is the bit of a barbell that we have, given you have this near-term risk and uncertainty around COVID. But I think that once we can sort of get past this, clearly the focus in the portfolio should really be about that cyclical value, long-term opportunity there. And so that's sort of the cyclical side that I mentioned. Just take a look at some of the most out of favor areas in the market, not just over the last month, but over the last 10 years, right? And then it points to a lot of that stuff that we hold in our portfolios, whether it's, small caps, value, energy, materials, international, all that stuff has the potential to see their profits not just accelerate, more than you're going to see the big mega cap tech stocks accelerate, but actually boom over the next couple of years. And I think that's a tremendous opportunity for investors.
All right. Dan, thanks for joining us. Good to get your thoughts.
Thanks, Kelly.
Dan Suzuki with Rich Bernstein Advisors. Ty?
Thanks, Kelly. Still ahead, cybersecurity firm FireEye suffering a black eye, an unprecedented hack. What does it mean for the companies they protect? Former NSA hacker David Kennedy will be here. Plus, Starbucks near record highs despite pressure from the pandemic, and the barista is high as the company's investor day kicks off in the next hour. More power coming right at you.
Welcome back to Power Lunch. I'm Seema Modi. We are watching Starbucks with its investor day kicking off in less than an hour. The coffee chain likely to share how it's navigating the pandemic, including how it's adapting to new restrictions. The Trading Nation team today is Mark Newton of Newton Advisors, Steve Cheverone of Federated Hermes. Steve, does it make sense to you that Starbucks is trading in record high territory where you're starting to see same-store sales fall in the fourth quarter and even the prior quarter?
Well, I mean, without getting too much into details on Starbucks, I mean, we're big fans of the consumer, and we think that the consumer is going to surprise to the upside next year. I mean, disposable income is 5% higher than it was a year ago. The savings rates hit multi-decade highs, and consumers are sitting on roughly $1.5 trillion of excess savings. And we think that the vaccine is kind of a GI's returning home from World War II type moment, where we're all going to want to go places we can't go today, do things we can't do today, and we're not going to be overly concerned about how much it's going to cost. And some of those things we're going to want to do is go out to eat and visit family that we can't see over the holidays. And so consumer services is an area that we're overweight. Hotels, casinos, cruise ships, and yes, restaurants. And so as a broad category, we think restaurants, quick service, places that aren't eating at home are going to take share over the course of the next year. And we think Starbucks stock, like many other restaurants, are starting to price that in.
Yeah, it's definitely part of the reopening trade, Mark, and the stock trading at $100 a share. Where do you see it go from here, Mark?
Hi, Seema. So, the stock does have a lot of near-term momentum. That is certainly a good thing. However, when looking out 3 to 6 months or longer, I don't view the stock as really all that attractive of a risk reward at this level. The stock has doubled off the lows, but yet momentum is really not able to catch up. And so there are two charts to put this into perspective. One is just a near-term daily chart. It does show the stock having broken out above the highs that it made back in July of 2019. So it's had a decent breakout of late. The problem is it is getting overbought. And when you look on a monthly basis, momentum, after having doubled off the lows 9 months ago, we only see RSI at about in the high 60s. It's not really able to catch up with what the stock has done, and that's a problem. It doesn't mean necessarily that it has further to go. It means that the stock has already had a huge run-up, but yet momentum is really starting to diverge from price. So for me, that means that, while, near-term investors, could potentially still be long for a move up to 110. I just don't like the longer-term risk reward, and if anything, it's really right to use strength to sell into by year-end, in my view.
Good points on both sides. Mark and Steve, thank you. And for more Trading Nation, head to our website. Follow us on Twitter. Kelly, back to you.
All right, Seema, thank you very much. Tomorrow, Starbucks CEO Kevin Johnson will be joining Squawk Box at 8:30 a.m. Eastern Time. Very much looking forward to that. Still ahead here on Power Lunch, top cybersecurity firm FireEye hacked in a state-sponsored cyber attack. We're going to get some reaction from a former NSA hacker with FireEye shares down 13%. And DoorDash sharply higher on its public debut, trading around $175 right now, priced at $102. That's a 72% pop. More Power Lunch right after this.
And now, the latest from TradingNation.CNBC.com and a word from our sponsor.
Some people refer to the VIX as the market's fear gauge, but I like to refer to the VIX as a gauge of uncertainty. Because while an elevated VIX may imply that the market's headed for big moves, those moves could either be to the downside or to the upside. I'm Randy Frederick, and Schwab is the better place for traders.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC COVID update at this hour. In the last few minutes, Pennsylvania's governor has announced that he has tested positive for COVID and is in isolation at home. The Pentagon is prepared to give the Pfizer COVID vaccine to some military first responders and healthcare workers as soon as it's approved, with an initial batch of 44,000 doses expected to arrive as early as next week. Since the first approval will be an emergency authorization, officials say vaccinations will be strictly voluntary. But
we're recommending that everyone take the vaccine when it becomes available to protect yourselves, your families, your shipmates, your wingmen, your battle buddies, and your communities.
in Alabama, that state's 76-year-old governor is acknowledging a nickname some on social media are using to criticize her stay-at-home order and mask mandate. But it isn't stopping her.
Wear your masks, wash your hands, and sanitize your personal spaces as much as possible. Y'all, I'm not trying to be Governor Meemaw, as some on social media have called me. I'm simply trying to urge you to use the common sense the good Lord gave each of us to be smart and considerate of others.
And for anyone not familiar with the term Meemaw, the Urban Dictionary's top definition is, quote, the best grandmother you can ever have, end quote. Ty, I'll send it back to you.
She plays the role very nicely, doesn't she?
Does.
It does suit her, you would have to say.
Absolutely. She's stuck to her guns.
Very nice. All right, Meemaw. All right, thanks, Sue.
You got it.
Markets, let's take a look right now. Highs, all-time highs earlier in the day, but not so much now. The industrial's off about 106 points, or about 1/3%. S&P down about 29 or 0.8%. NASDAQ is off more, almost 2% there as technology shares take a little breather, and the Russell also down for the day. The oil market closing. Eric Chemi has the numbers. Eric.
Tyler, that's right. Brent finishing flat and WTI settling slightly lower today, though off its worst levels of the session, which had hit on the heels of EIA data that showed a massive increase in U.S. supply. Overall, U.S. inventory rose by 15 million barrels last week, which was the biggest increase since April. And as exports plunged, U.S. imports of crude rose by their most on record at 2.7 million barrels. Inventory levels will continue to be in focus amid ongoing demand concerns, especially as COVID cases continue to rise worldwide. Kelly, I'll send it to you.
Eric, thank you very much. New York Attorney General Letitia James is holding a virtual press conference on Facebook right now. Let's listen in.
By using its vast troves of data and money, Facebook has squashed or hindered what the company perceived as potential threats. They've reduced choices for consumers. They stifled innovation, and they degraded privacy protections for millions of Americans. In an effort to maintain its market dominance in social networking, Facebook has employed a buy or bury strategy to impede competing services. First, Facebook used vast amounts of money to acquire smaller rivals and potential rivals before they could threaten the company's dominance. And I'll say billions were thrown at smaller companies in an effort to get them to sell. The two most glaring examples of this unlawful scheme were Instagram and WhatsApp. Facebook bought Instagram for $1 billion in 2012, when the company did not even have a cent in revenue. And in 2014, Facebook paid the extravagant amount of $19 billion for WhatsApp, which was far more than industry experts and even Facebook itself valued the company. The second, and just as harmful anti-competitive strategy Facebook utilized was suffocating and squashing third-party developers that were invited to utilize Facebook's platform. Facebook would try to squeeze every bit of oxygen out of the room for smaller companies that refused to be bought. Facebook used an open first, close later strategy to stop competitive threats, where it would first open its platform to apps created by third-party developers. This increased functionality on the site and subsequently increased the number of users on Facebook. And then Facebook abruptly cut off apps it viewed as a competitive threat. Some of these companies experienced almost overnight drop-off in user engagement and downloads, and their growth stalled. They also sent a clear message to the industry. Don't step on Facebook's turf, or as one industry executive put it, you will face the wrath of Mark, referring to Facebook founder, CEO, chairman, and controlling shareholder, Mark Zuckerberg. This combination has allowed Facebook to maintain its monopoly over the social networking market and make billions from advertising. And today, more than half of all American adults log on to Facebook every day. New Yorkers throughout our state and consumers across this nation use Facebook to stay in touch with friends and family. They share content and have conversations. They post pictures and videos. And with the ongoing pandemic, many use Facebook as a critical place for social engagement. But while consumers have been spending their time keeping in touch on Facebook, Facebook has been spending its time surveilling users' personal information and profiting from it. No company should have this much unchecked power over our personal information and our social interactions. And that's why we are taking action today and standing up for the millions of consumers and many small businesses that have been harmed by Facebook's illegal behavior. And so we are asking the court to halt Facebook's anti-competitive conduct and block the company from continuing this behavior in the future, as well as provide any additional relief it determines is appropriate. By restoring competition, our lawsuit will help consumers have alternatives to Facebook and that they can vote with their feet when Facebook puts profits ahead of consumers' welfare and privacy. I'd like to thank the 47 other attorneys general that has joined this lawsuit, and almost every state in this nation has joined this bipartisan lawsuit because Facebook's efforts to dominate the market were as illegal as they were harmful. I'd also like to thank our colleagues and friends at the Federal Trade Commission for their collaboration. The FTC filed their own lawsuit against Facebook today as well, and we look forward to collaborating with them in the litigation process. As I've said before, we cannot let large corporations gain more and more power over our lives through anti-competitive practices that only serve their interest and undermine the competitive spirit of our nation and the spirit of our economy and cause harm to consumers. This action is part of a renewed focus by my office and other state attorney generals on antitrust enforcement and the harms caused to consumers and the economy when market power is unchecked and unregulated. Today, we are sending a clear and a strong message to Facebook and every other company that any efforts to stifle competition and hurt small businesses, reduce innovation and creativity, or cut privacy protections will be met with the full force of our offices. Again, I want to thank Chief Deputy Attorney General for Economic Justice Chris D'Angelo and Antitrust Bureau Chief Eleanor Hoffman, as well as Assistant Attorney General Johanna Skripzik and Assistant Attorney General Zach Bezons, who were the lead attorneys on this matter. They were joined by a dedicated team of attorneys and legal assistants and economists and analysts, and including Assistant Attorney General Beatrice Marquez, Assistant Attorney General James Yoon, Assistant Attorney General Amber West-Els-Yang, and Legal Assistant Arlene Leventhal, all of the Antitrust Bureau under Eleanor's supervision. as well as Assistant Attorney General Hannah Beck, Assistant Attorney General Nathania Koss-Lin, Legal Assistant Shirley Wong, and Internet and Technology Analyst Joe Graham.
That's New York Attorney General Letitia James, as there's this announcement about the states and the FTC jointly filing suit against Facebook. Shares are at session lows, down just about 3%, as you might expect. That has the NASDAQ at session lows as well. It's now down almost 2%. Elon Moy is here now with more details for us on this litigation. Elon?
Well, that's right, Kelly. Facebook is also under fire from federal regulators as well, as the Federal Trade Commission has now filed an antitrust suit against Facebook, accusing the social media giant of trying to choke up competition by gobbling up smaller companies, namely WhatsApp and Instagram, as you heard the New York Attorney General discuss as well, and then using its power to block third-party developers from creating and developing new competitors. Now, the complaint says that Facebook's attempts to eliminate threats was part of a systemic strategy, and maintaining its monopoly leaves consumers with few choices for personal social networking and deprives advertisers of the benefits of competition. Now, the remedies that the FTC is seeking could include divesting of assets, including both WhatsApp and Instagram, prohibiting Facebook from imposing anti-competitive conditions on software developers, and also requiring Facebook to seek prior notice and approval for future M&A. Now, Facebook has been in the FTC's crosshairs for years. If you remember last year, the FTC did impose a $5 billion record fine as part of a settlement with Facebook over privacy concerns. They also forced Facebook to restructure some of its operations as well. So we will see where all of this goes. But now the FTC as well filing suit against Facebook over antitrust concerns. Tyler.
Elon, thank you very much. Elon Moy. For more on what this may mean for Facebook and other properties in the social media space, along with us now is Verge Editor-in-Chief Nilay Patel and RCB Capital Markets Senior Analyst Mark Mahaney. Mark, let me begin with you. The stock has sold off rather markedly here, but it is not as though this is a huge surprise to investors in Facebook. That's question number one. And number two, what does the rise of TikTok say about Facebook's utter dominance of this space? Doesn't the presence of TikTok show you that there is room for other competitors here?
So we've had, rising regulatory risk on these major tech platforms, Apple, Google, Amazon, Facebook, for the better part of 3 or 4 years. And there's no question, these are extremely powerful platforms. There's a debate in my mind as to whether they got there through antitrust practices. I'm not a lawyer, so I won't, that's not my field. But I think some of these charges kind of underappreciate the level of innovation that have brought these companies to where they are now. And then your last point also begets something, which is that, these areas seem like lockdown monopolies until they aren't, until you see the rise of assets like TikTok. So there, in our point of view, is that there is room for really good, innovative companies to come in. Have these companies been very aggressive in building up their positions today? Yes. Do they provide values to consumer, a lot of value to consumer and merchants? I mean, absolutely. There are 10 million advertisers that use Facebook to reach markets. This is where small businesses, go. It's no longer Main Street. It's now Facebook Street. So anyway, I think that's the quick reaction. But yes, this is a rising risk for equity investors in Facebook. This is not going away anytime soon. You're going to have to deal with this for years.
Yeah, this is not going to go away quickly. You are still comfortable, I take it, with your $350 a share price target, Mark. Let me add that's question number one. And question number two is, could they realistically and profitably spin off Instagram and WhatsApp either together as a package or one at a time?
So no change in our view on the stock. This is one of our 3 favorite longs in the internet space. No change on our price target. The stock is largely, 90% going to be driven by fundamentals. Regulatory actions are going to move 10% of the rest of the stock. But if estimates go up and they can prove that they can show accelerating revenue growth, expanding margins into next year, the stock is almost certainly going to go up. These regulatory issues are an overhang, but they don't change the thesis and our point of view. Could they spin these assets off? It would be very tricky to do that. I think the more interesting one in terms of the spinoff would be WhatsApp, which has contributed almost nothing to Facebook's P&L to date. But that's a very intriguing long-term asset. I don't think Facebook has figured out how to monetize that, but if they can, boy, that's a really interesting asset. I think that'd be hard to argue that that should be spun out. But anyway, that's as a Facebook shareholder long-term, I think they would want to focus on the risk of them actually having to spin off and lose WhatsApp. A spinoff, though, could create more value for the shares depending on how it's structured. I mean, that's the irony of this situation. But yes, I think it'd be very hard to spin those off. As an investor, you'd be more worried about the kind of dislocation with WhatsApp, I believe.
Nilay, it's amazing to me that WhatsApp, which would seem to be really well positioned to do what Zoom has done or what Microsoft Teams have done, they haven't been able to do that. That's one thing I'd like to get you to react to. But the main question I have here is, in your view, was Facebook evil, or were they just merely very smart in making the acquisitions of the properties they did when they did?
Well, it's funny.
I think they were very, very smart.
I'm asking Nilay. Nilay.
Yeah.
Go ahead, Nilay.
Yeah, I think they were smart. I think there's no question that Mark Zuckerberg is a genius when it comes to seeing threats to his business and acting harshly to stamp those out. Back in July, The Verge reported on internal emails inside of Facebook during the Instagram acquisition, where Zuckerberg was telling his lieutenants, telling his CFO, the thing about competitors is we can always buy them. And he correctly identified that what enables a competitor to Facebook is not direct competition. It's a new user experience. So for Instagram, that was photo sharing. For TikTok, which you talked about, that's obviously vertical short videos that scroll up. It's that new mechanic that he's always seeking to buy. And I think he was smart to realize that early, that's what his competitors would look like. He was smart to act on it. I think what the government is getting into, and you are looking at 48 states plus the Federal Trade Commission. The Federal Trade Commission is specifically saying it wants to unwind Instagram and WhatsApp. They're saying you might be smart, but you still acted anti-competitively. You still broke the law. You identified a competitor and you aggressively moved to make sure they weren't a threat to you. You aggressively moved to stamp out their growth and to decimate the playing field around the spaces you wanted to be in. There's another level with Facebook where they collect data from their Onavo VPN to see what competitors are rising and decide to buy them or stamp them out early. That stuff, you can be very smart, you can be very aggressive. You can also cross the line. And I think the core question for Facebook in both of these lawsuits is showing that they didn't cross the line when the evidence really indicates they knew what they were doing and they moved aggressively in ways that they were potentially fearful that they had crossed the line.
Hard to say. If you're reporting, as I think I heard you say, if you're reporting shows that Zuckerberg was sending out emails saying, you know, if we've got people who are competitors or potential competitors, we can always buy them, that would fall into the category of emails I wish I hadn't sent. And that would certainly bolster, Nilay, the case that there was malintent here. There was knowledge of forethought here with respect to behavior toward competitors.
Well, I haven't been a lawyer in a long time. I wouldn't say I was the best lawyer in the world when I was actually practicing, but here in this case, I don't think the antitrust law requires that showing of malintent, requires that showing of you acted evilly. What you're really looking at is a realignment in this country of how we want to regulate big corporations, a sense that some of these corporations are too big, that their size and their power and their desire to make competition go away is bad for markets as a philosophy. And so I think to your question about, well, what happens if you spin out Instagram and WhatsApp? My prediction is that you will create an enormous amount of value for shareholders who currently are seeing innovation locked up inside of a company that's very big, instead of competing against an Instagram, creating more value for consumers, creating more jobs as both companies have to get bigger, and competing more ferociously for the consumer, their attention, and the dollars from marketers.
Nilay, thank you very much. Nilay Patel of The Verge, and always good to see you, Mark Mahaney of RBC. Thank you for your time today. Kelly.
Still ahead, an embarrassing day for FireEye. The cybersecurity firm got hacked itself, and it's issuing a warning about who did it. Those details are coming up next on Power Lunch, with the shares down 12.5%. Stay with us. Welcome back. Cybersecurity firm FireEye is down more than 12% today since announcing details of a major hack of its data and tools. In a press release, CEO Kevin Mandia writing, quote, "Recently, we were attacked by a highly sophisticated threat actor, one whose discipline, operational security, and techniques lead us to believe it was a state-sponsored attack." He says we are actively investigating in coordination with the Federal Bureau of Investigation and other key partners, including Microsoft. That's the end of the quote there. Joining me to discuss this recent cyber attack is David Kennedy. He's the founder and CEO of TrustedSec and a former NSA and Marine Corps hacker. David, it's good to have you. And I think that the most important thing to point out here is you actually commend FireEye for going public with this information because of its severity. The Washington Post is implying that it was Russia, but what do we know at this point?
We don't know a whole lot because FireEye right now is still in its investigation phase. What we know is that, the sophistication levels that we typically see from these types of organized groups often lead to what we call advanced persistent threats or nation states like Russia, China, et cetera. We don't know for sure, but Russia would make sense because FireEye has been actively going after Russia for a long period of time, both from exposing their intelligence operations, them infiltrating critical infrastructure here in the United States, as well as a number of different areas. So FireEye coming out with this and being very transparent about it has been a very good thing. In fact, they just recently released all the tools that were stolen. They stole a bunch of tools called red teaming tools, which are hacker tools that private companies use to simulate these types of attacks. They published ways of identifying them so that they don't do any harm to any other organization out there if Russia were to use them against the world.
Right. So the nature of this attack, it's not so much that FireEye had information that was stolen. They had tools, and those tools were kind of stolen. And these tools simulate serious attacks on major corporate websites and that kind of thing. So what does corporate America need to know right now about the vulnerabilities that now exist?
Yeah, when you look at these types of tools, they're designed to simulate what nation states would do. The sophistication levels and the advancements that these countries have. They have thousands of people, billions of dollars of resources trying to hack into the global economy, intelligence gaining purposes, intellectual property theft. And so for corporations to build defenses against this, private corporations build the same types of tools and techniques in order to simulate those types of hacks so that you can build defenses against it. And so, when you see these types of tools compromised, it means that Russia now has access to additional capabilities that they may have not had before. The good news is that FireEye has come out and said that the tools that were taken, there were no 0 days, which 0 days, if you remember a few years ago, the NSA had a major data breach from the Russian intelligence unit, the GRU, that compromised and actually caused a big issue where they shut down hospitals and things like that because of the exploits and the tools that were leaked from the NSA. This isn't anywhere near as severe as something like that, but it definitely enhances Russia's capabilities and allows them to understand what private companies are doing to try to build defenses against what Russia is doing, what China is doing, what North Korea and Iran are doing against countries that they're hostile to, like the United States and its allies. So this for corporations and countries, we really need to continue to bolster our security stances against these types of attacks.
Well, and this isn't the question for you, but obviously it makes me wonder about retaliation, what the U.S. response is to this kind of thing, what it might be in this case. Again, first, I guess we have to wait to confirm what we actually know about what happened. But to reiterate what you were just saying, it's not so much just whether this actor alone is going to have the information with these tools, but whether they kind of give that to other players like North Korea, like you said, or Iran. So does it just suggest that, this is a black eye for FireEye because they are the cybersecurity company. The fact that they themselves were exploited would render them vulnerable. But at the same time, the exploitation suggests all the more need for new and sophisticated and cutting edge cybersecurity to protect against these tools now being out there on kind of the dark web. So what's a customer to do? They have no choice but to use these firms, even if they're vulnerable to being hacked themselves.
I think you hit it on the head on the retaliation front that, cyber warfare, there's little to no rules when it comes to the games that are being played right now. Russia hacks into everybody and there's really little to no retaliation. And this looks like to be retaliation for what FireEye has been doing about exposing Russia's intelligence operations around the globe. When it comes to these types of tools and capabilities, they're absolutely necessary for us to have in order to help organizations. But when a leak like this occurs, FireEye is taking the right approach around releasing information around how you detect these tools. The problem you run into is that Russia has a very large and very growing population around sophisticated organized crime groups, also known as ransomware. And you might have seen in the news recently, Universal Health Systems that was hacked, Garmin that was hacked and had to pay ransom back. All these different organizations that are getting hacked are a large amount of them are originating out of Russia and sponsored by the government. They're making hundreds of millions of dollars, and we can't touch them from a extradition perspective because they're hostile to the United States. So you can absolutely expect to see those organized crime groups from a ransomware perspective gain some of these tools and to be used against us. And so my warning for companies is we're on notice now to build better defenses to try to withstand these types of attacks, and our security programs really need to be designed to thwart those types of attacks as they come along.
Yeah, well said. David, thanks for joining us to break it down. It's very important. We appreciate it. David Kennedy of Trusted Sec. Tyler.
All right, Kelly, well, it's a very interesting day for stocks. They began very much higher, but now are near or at the lows of the day. All three of the major indexes are in the red. The news of the hour, of course, Kelly, is that 48 states, led by New York, are suing Facebook for antitrust around acquisitions that they made years ago in the case of WhatsApp and Instagram, and also the treatment of certain app developers and how they acted with respect to them. The stock, as you see, they're down more than $5, almost $6 or 2%. Not a huge drop there, really, Kelly, but because I think a lot of people expected this to happen, and the FTC also filing a separate suit.
NASDAQ at session lows. We'll hand it off to Closing Bell. We'll see you tomorrow here on Power Lunch.
Thank you, Kelly and Tyler, and welcome everyone to Closing Bell. I'm Sarah Eisen here with Wilfred Frost. Stocks hitting records at the open, but have taken a big turn lower, especially the NASDAQ down nearly 2%. Let's look at what's driving the action in this final hour of trade. DoorDash surging in its debut as the market focuses on the next big IPO today. Is it a sign of froth in the market or the next high growth tech stock, or both? We're going to dig into that. Plus, the struggle for more stimulus. Senate Majority Leader Mitch McConnell saying Congress is still looking for a way forward, but talks have not produced any kind of deal so far. And if you're not named DoorDash, tech growth severely underperforming. Apple down 2%. The antitrust lawsuit against Facebook, 48 states and the FTC just unveiled. We're going to dig into that in just a moment. NASDAQ down 240 points, 59 minutes left of trade. Wilfred, Dow's down about 130.
S&P's down nearly 1%. Big show coming up on Closing Bell today. The CEO of Bank of America, Brian Moynihan. He will join us imminently on the state of the market and his expectations for the economy, but also on a new organization he's spearheading along with the Pope, Pope Francis, pushing for more inclusive capitalism. That exclusive interview in just a couple of minutes. And a big beat from Campbell's Soup as the pandemic changes how we eat. The CEO, Mark Klaus, will join us on the post-pandemic business and where Campbell's goes from here. But first, let's focus in on the big stories we're watching today. Mike Santoli's tracking the market as always, and Leslie Picker on that incredible first day of trade for DoorDash. Mike, first to you and the broader markets.
Yeah, well, the market had slowed down in the past few days. Now we're taking a step back. We had hovered around the highs. Just as DoorDash opened, as a matter of fact, is when the overall NASDAQ really had a sharp pullback. Almost it seemed as if it was this last little burst of short-term enthusiasm. What I've been pointing out here, remember, November 9th, the intraday high was actually 36.45, so less than 1% down from here. We actually touched that level going back a month at this point. So we're still hovering a little bit above that right now. It seems as if the market is still holding together just fine. We've been talking about it being stretched on a technical basis, a lot of kind of buildup of bullish sentiment, and maybe that NASDAQ move was one of a little bit of pent-up selling hitting the market. Let's look at what's been happening in terms of this reach for faster moving stocks and performance lately. The Russell 1000 has tremendous overlap in terms of market value with the S&P 500. And you can see they ride one another largely. This is a 2-year chart. Look at what happened more recently, though. Separation, Russell 1000 outperforming. Some of that is somewhat smaller stocks doing better than the S&P 500. Some of it is the very large market cap stocks that are not yet in the S&P 500. Zoom Video, Tesla, we know, is on the way in. You can look at Square. You can look at Shopify. They're all not in the S&P 500, and there's been this real reach for the stuff that's moving fastest and has, it seems, a high bang for your buck in the very short term. So again, another kind of signal out there that people were stretching for returns, and this is another one. So the Renaissance IPO ETF, we know about that. It's been an amazing performer for a while, for a couple of years, as a matter of fact. But just this quarter, you see the spin-off IPO, which has actually lagged quite badly for a while. This is companies that are just spun off of a larger company and they're put into this basket. They've actually performed really well. Again, it's stuff largely outside the index. People are looking for relative performance. So we have a little bit of a reset right now today. We haven't had a 1% down day in a while, guys. We'll see if we get one.
All right, Mike, we'll see you in just a bit. Another IPO, another unprofitable high-growth company, and another huge pop at the open. DoorDash surging in its debut today. Leslie Picker has more on the stock story, up 71%, Leslie.
Yeah, that's right, Sarah. There were all sorts of systems in place to avoid this day one pop. The company used a hybrid auction system to try and find the most efficient price for the buy side and the sell side for this deal. But as you can see from trading today, there's little price sensitivity around this deal. I spoke with a few bankers last night and this morning who expected this one to trade, to 130 or 140. I'm not sure many people expected it to open at 182. At least nobody that I spoke with did. Today's trading values DoorDash at $70 billion on a fully diluted basis. That's more than 4 times its valuation in a private funding round in June. In its IPO, I'm told investors were really drawn to DoorDash's growth at scale, a top line that quadrupled in the third quarter, plus glimmers of profitability over the spring. But with this deal and all IPOs, there are inherent risks. DoorDash notes in its S1 that it may not keep up with this pace of growth and that it has a history of losses. Additionally, the food delivery industry is fiercely competitive, and potential changes in regulation, particularly as it pertains to the classification of their dashers as well as caps on their commissions, could alter DoorDash's business model. Guys.
Leslie, thanks so much for that. More discussion to come in the show on that extraordinary first day pop for DoorDash. In fact, markets, of course, near highs, although pulling back today, and we're going to discuss that and, more importantly, outlook for the economy now with the chairman and CEO of Bank of America, Brian Moynihan. Always a pleasure, Brian. Thanks so much for joining us.
That's great to be here, Wolf. Good to see you again.
We wanted to start off on the macro, if that's all right. You always have a great set of insights on what the economy is doing with your live data, particularly on the consumer. I remember at earnings a couple of weeks back, you were surprised at how strong it had been. September had shown even a year-on-year growth in U.S. consumer spending based on your data. What's the latest on that front, and how's the holiday season shaping up?
Sure, Wolf. Let's back up. And our team at Bank of America Securities, Candace Browning Pratt, and the research team is one of the best in the world. They have this year finishing up about down 3.5% GDP growth, the fourth quarter being up again over the 30% plus in the third quarter. But when you look to the first quarter next year, they have it at 1%, and then it starts growing from then off for 21 to be up about 4.5%. So that's the backdrop, a negative 3.5 this year, positive 4.5 last year. But when you look inside what our consumers are doing, when you look at what they're spending year to date, they've spent more in 2020 than they did in 2019, and that is now across $2.7 trillion of money moved by our consumers. And so if you look at it by month, when I was back with you on, I think way back in May, I said you could see it already flattening out, you could see it starting to grow, and you looked at me a little quizzically. You know, the reality is now it's really grown every single month since then. And so the month of November is up about 4% over last November, and the month of December so far is up double digits. And that's a little bit because of the way people were shut down on Black Friday and Thanksgiving. It was a little bit different. And some of that activity, which usually went around the Thanksgiving weekend, pushed in the first week of December. And so we'll see how it plays out, but the consumers are spending relatively strongly.
Well, I don't mean to come back to you quizzically again, Brian, but I guess the question at the moment, with cases spiking, despite that optimistic outlook on the data front, is there a risk of a double-dip recession if we don't see, say, fiscal stimulus in the short term?
Well, let's sort out two different questions. One is fiscal stimulus is needed to ensure that the human aspects of this healthcare crisis don't take a toll that they shouldn't take. And so when you think about people wanting to come to work, you know, we may have people in our companies that want to come to work because they want to come to the office and normalize their life, but they're working every day. There are lots of Americans who can't come to work because their company is closed or they don't need as many people. And that's what we need another stimulus for the unemployment side, for those for those Americans and also for the businesses, another round of PPP to support them. That would lower the chances of having what we see in the first quarter next year, a slow growth economic quarter. It would increase the possibility that would be more positive, and you would hit the second half of the year growth rate as you have the convergence of that stimulus plus the convergence of a vaccine being in more people's arms. And so, yes, there's a possibility. There's always a possibility. But with rising cases, you're not seeing the shutdown orders and things having the same effect so far, even through the last few days. When you look at restaurants and stuff, yes, they're changing. But in the places like the Northeast and the central states where they hadn't really changed the outcome at all positively, i.e. opened up a lot more, it's being delayed. But underneath it, people spend money. They have to live. They have to eat. They're improving their homes, and things around the home are just going up very strong, and other things are down. Restaurants down 25% year over year in terms of spending by credit and debit card spending. That's down, but there's other things that make up for it.
In the absence of political deal and fiscal stimulus, should the Fed do more, or is the impact of their marginal dollar spent by the Fed or marginal action from the Fed now much reduced, such that they should wait and hope that the politicians act?
Well, I think Chair Powell has been clear in that in terms of the need for fiscal stimulus. The Fed has done a lot. And by the way, the work the Fed did and the administration did, Secretary Mnuchin and others around this crisis, was really going to be the textbook way to respond quickly, deeply, across the board, and move, and Congress backing up. And that enabled this whole pandemic crisis to be a lot less than people thought. The Fed's rates are near zero. They've got the market stabilized. We're talking about IPOs being open, and debt issuance strong, and the rate structure is low, and mortgage lending is strong. They've done a lot. There's lots of facilities out there. It really is a question of getting the last part of the American economy that is still effective in the heavily affected industries, generally those that require people to be close together to conduct the activity, going to a stadium, going to a theater, eating in a restaurant, flying on a plane. That needs to be helped. That is a fiscal question, I don't think a monetary question.
We've talked, Brian, about how some parts of the economy are hurting more than others. You're part of the Council on Inclusive Capitalism and met the Pope recently as part of that. And he embraced capitalism positively, I think for the first time, saying it was an economic system that is fair, trustworthy, and capable of addressing the most profound challenges facing humanity. What did you make of that comment from him and your meeting with him? And how much is there to be done to make sure that it is inclusive?
Well, I think that's the goal of this effort, and it's a goal of a lot of efforts, whether it's the stakeholder capitalism by the BRT, whether it's the long history of the World Economic Forum and Klaus Schwab, whether it's the metrics we're doing at the IBC, the International Business Council is part of that, and the Council for Inclusive Capitalism, the SMI with His Royal Highness Prince Charles. These are all efforts to really ensure that stakeholder capitalism, the capitalism is fair in the best form we have. And I think the Pope's engagement with us over the last year or so on this is really a testimony to the view that we need capitalism done right, and it needs to serve all society. And on that group, you'll find Sharon from the trade union organization. You'll find companies like ours. You'll find all kinds of people in that group saying capitalism can be done right. And on the format, the basis of Judeo-Christian ethics and treating people like to be treated yourself. These aren't foreign concepts, and they apply to all religions. And so it's not a religious exercise as much as it is how do we get capitalism right? And I think that Council for Inclusive Capitalism, among many, is doing it. And I think it's important that the Pope is endorsing that capitalism done right can do good things. I think that's an important statement.
Do you think, Brian, that means in the next 4 years, under a Biden and Yellen economic team, that taxes will go up? And which taxes do you think would derail growth the least if we saw them rise?
I think as administrations look at the tax policy, you have to really think about the things that were achieved before, which was to make the United States competitive so that people from around the world wanted to put manufacturing facilities and sell into the huge final demand we have in this country. And so the question is, you don't want to compete with your tax rate. That's not exactly what you want to do, but you don't want your tax rate to make you anti-competitive. And that's what happened in the last tax reform is we did a couple things. One was lower the rate, but we also, some of the work around the technicalities of how taxes are calculated was important. So even if rates go up, we've got to be mindful that they should only go up in a way that we keep jobs and businesses and people wanting to come to the United States to manufacture goods to sell in this huge final demand of this economy that doesn't exist anywhere else in the world, especially on the consumer side. I just told you the consumers are spending more this year in the middle of pandemic than they did last year. The world wants to get to that base. And so I think any tax policy has to recognize the balance in that equation. I'm sure that the new administration will be thinking that through, as every administration has had to do for years.
We expect the stress test results, the special extra stress test for this year, next Friday. You should fare well based on your capital position, which has only improved since the last round, which you already fared well on. Are you hopeful of being allowed to deploy buybacks once again early next year? And would you do so if permission is granted?
Oh, absolutely. As soon as we're allowed to do it, we're going to go in and buy the stock, because that's part of the core shareholder value proposition for our company. We run our company to help deliver for our shareholders, and one of the ways we do that is dividends. Another way we do that is by share repurchase after we earn good money for the shareholders. And so we have to get back in the stock repurchase because, frankly, we have enough capital to serve our clients. We have enough capital to do what we're supposed to do as a company. We just showed that through a crisis of the highest order, we were able to stand tall and receive $270 billion of deposits, make $70 billion of loans, go through PPP, bring 10,000 people to bear to make that happen, engage with distribution of benefits and things like that, all while we actually made money, put up reserves, and increased our capital. So the idea of when we're allowed to, we're going to go back and buy it as fast as we can, subject to what the board believes is the economic conditions we're facing.
So Brian, I get that, and I was looking at the numbers with a number of analysts today. You have about $35 billion of excess capital. It's 15% of your market cap. It's a huge amount. But you've just also spoken about the need for inclusive capitalism. This has been a terribly tough year for many people out there. Do you fear a PR backlash, even if the fundamentals are as you just outlined and as analysts and I understand? Do you fear a PR backlash if you go out and deploy billions of dollars on your own stock when you've also spent the back end of this year talking about inclusivity?
Well, let's think about what else went on during this year. During this year, we went to $20 an hour minimum starting wage, which was part of a program that we actually completed a year earlier. So we started a few years ago at 15, and we went to $20 an hour for everybody starting in our company. Starts at least $20 an hour plus full benefits. During that time, we kept our expenses flat. That was through the hard work our team did on operational excellence. So we increased minimum starting wage. When the pandemic hit, free mental health visits, free vaccines, free testing. On top of that, we also said people are going to have a hard time working at home who have kids and responsibilities. So we allowed them to hire child care help at our cost of $100 a day. And we've had 2.5 million days paid for by the company to support our teammates to do a great job for our clients. And so what has happened? Our teammate scores are highest they've ever been, but importantly, our customer scores increased all during this crisis, which is tremendous work by our team, but it came from investing in our team. So I think we can stand tall saying, look, the end of the day is we are a great place for people to work. We share access with the communities, including our $1 billion program, Racial Social Justice, including our regular charity and all the works we do, and we deliver for our shareholders. Part of that delivery mechanism is return capital. And I think that that's part of getting that capital back to the people who have it so they can invest it in something else if we don't need it to serve our customers. So I think it's a completely fair way to think about it. And I think if we were doing that and not paying our people, we were doing that and not having massive demands on our vendors to pay $15 an hour at least and things like that, you could criticize. I don't think we should be criticized.
No, fair enough, Brian. Fair enough. And my final question, I just wanted to bring it back to the markets. You heard us discussing DoorDash's extraordinary IPO, up 80% today. It was worth $16 billion in June. It's now worth over $60 billion. The NASDAQ is up, Brian. I know you're quite positive about the outlook for the economy next year. The NASDAQ is up 40% or so this year. Tesla's up 600+%. Do you feel there is a disconnect between the markets and the economy? And are there any aspects that make you think back to 2007 and 2000 itself, and that we're in bubble-type territory?
Now, the stock market's reflecting views of future growth and future optimism, the optimism about a vaccine for the virus, which is not a theoretical concept. Just last quarter, we'd have been talking about could they develop a vaccine. It's developed. It's going in people's arms. So I think it's reflecting that mood. in that elements in these companies that have created markets and done things. That's terrific. But remember what happened in 07. You had real estate lending that was overborrowed and overlent, and that created a problem. And that's just not true. The housing prices have maintained a good, solid loan-to-value ratio. Lending practices, the housing prices are up, but not up crazy. Yeah, you're sort of back on the long-term trends. Those mean a big parts of the society. Now, is there a human crisis still going on because of people unemployed and needing help to get through over the bridge, the last part of the river? Absolutely, that's why another stimulus is needed. But you just don't have this kind of widespread speculation on, frankly, one of the largest distributed assets, which is people's homes, that was going on, and things. It's just a different place. Consumers are in much better shape. The banking system is in much better shape, and we've been able to withstand the crisis. We still have a human crisis. We still have a healthcare crisis, and that's what we need to finish up on.
Brian Moynihan, thanks so much for joining us. Much appreciated.
Thank you, Will. Stay safe.
Chairman and CEO of Bank of America, Brian Moynihan there, Sarah.
Yeah, sounding pretty optimistic still on the state of the U.S. consumer, spending more this year than last year. Want to hit that breaking news we just got in the last hour or so on the antitrust lawsuits against Facebook from the FTC and from a number of states, 48 of them. Julia Boorstin getting a response from the company. Julia.
That's right. Facebook responding, saying we're reviewing the complaints and we'll have more to say soon. Years after the FTC cleared our acquisitions, the government now wants a do-over with no regard for the impact that precedent would have on the broader business community or the people who choose our products every day. Of course, there could be big implications here if Facebook is forced to sell off either WhatsApp or Instagram, which are the two big acquisitions which are in focus. Sarah, back over to you.
Julia Boorstin. Julia, thank you. Let's get to Ilan Moy now with more background on these antitrust lawsuits. Ilan, sounds like it was worse for Facebook than it was expected to be.
Well, Sarah, there are two lawsuits being filed against Facebook. They are coordinated, but they will be separate. But they both essentially accuse Facebook of the same thing, and that is of buying up its smaller rivals rather than competing with them and cutting off access to third-party developers that they view as a threat. Now, as a result, the states say that consumers get locked into the platform, and then the company is able to milk their data.
We will not allow any company to think that they are too big to fail. And that is why 46 attorney generals across this nation have filed this action. And we will continue to take action against any company that engages in these predatory actions.
Now, as Julia did allude to, some of the recourses that the states are seeking from the courts could include divesting assets such as WhatsApp and such as Instagram. They also want Facebook to get approval for any future mergers or acquisitions, and the states have set the threshold as low as $10 million. Now, 48 attorneys general, including some territories, have joined in this lawsuit from the states. Both parties are represented. The vote by the FTC to move forward was 3-2, guys. Interestingly, the two Democrats on the commission joined with the chairman to vote for suing Facebook. The two Republicans voted against it. Back over to you.
That it is an interesting breakdown. I was just going to ask as a follow, Ilan, how a new administration would affect all of this, especially the demands from prosecutors at the FTC to divest Instagram and WhatsApp, which is a huge deal. Two huge deals.
Well, this is going to eventually be right. This eventually would be decided by the courts. I mean, that's why they filed the lawsuits, and it would be up to the court to decide what exactly the remedy would be. There is a possibility that down the road the court could even combine these two cases into one case if they are similar enough, and if all parties agree to that, to sort of streamline the arguments going forward. But I think that what you're seeing is there is a broad agreement here that Facebook overstepped the boundaries. That's coming from regulators of both parties. And so I think a new administration coming in, we've seen bipartisan backlash against big tech in Washington. This is one more example of that today.
Ilan, thanks so much for that. Much appreciated. Up next, vaccine billionaires, the big money that's been created on Wall Street in the race for a COVID vaccine. We are down at the moment 2% on the NASDAQ. Back in a couple minutes. Welcome back. The race to develop coronavirus vaccines has helped drive up biotech stocks and mint new billionaires in the process. Robert Frank's got the details for us. Hey, Robert.
Wilf, BioNTech shares more than quadrupling this year, adding $4 billion to founder Uhar Shaheen's wealth, making him the 453rd richest person in the world with $5.4 billion. Now, BioNTech's founding investors have done even better. The German twins Thomas and Andreas Strungmann, they have added $7.8 billion to their wealth. Now, Moderna, which has created 3 new billionaires this year, that includes CEO Stéphane Bancel gaining $4.8 billion just this year. He is now worth $5.3 billion. Harvard professor Tim Springer, he was an early investor, is now worth $2 billion, saying he still bikes to work and plans to fund a new not-for-profit devoted to creating new antibodies. MIT professor Bob Langer, he was also an early investor in Moderna, now worth $1.5 billion. And speaking of new billionaires, Will, today's DoorDash IPO creating 3 new billionaires. So you've got CEO Tony Xu, Andy Fang, and Stanley Tang, all now worth over $2 billion. Again, highlighting this disconnect that, Wilf, you mentioned with Brian just earlier between the capital economy and what's happening in the real economy. Back to you.
Yeah, it just gets more stark every day. Robert, thank you, Robert Frank. Coming up on the show, Campbell Soup CEO Mark Klaus on whether the approval and rollout of coronavirus vaccines in the U.S. could hurt the company's sales just off of earnings today. And as we had to break, here's a quick check on bonds for you. Yields higher across the board today. The Dow's down 168 points, but we are seeing a slight tick up here in yields. So better mood in the bond markets, 0.93 on the 10-year. We'll be right back. Time now for our daily coronavirus tracker. More than 103,000 Americans right now are hospitalized with coronavirus, another record. Among the 17 states with record hospitalizations, Delaware, Massachusetts, and California seeing the biggest weekly increases. Many cities and towns in the U.S. are not equipped to handle the latest surge. The New York Times reporting that El Paso, Texas, down to just 13 ICU beds. Fargo has only 3, and in Albuquerque, there are currently no open ICU beds. In vaccine news, Roche said it is partnering with Moderna to include an antibody test in Moderna's ongoing vaccine trials. Roche's test will be used to help determine whether Moderna's vaccine is helping patients develop and maintain those all-important coronavirus antibodies.
Yeah, and we're just getting some news on another vaccine trial. This from J&J. Meg Terrell has the story for us. Hey, Meg.
Hey, well, Johnson & Johnson is confirming that it has reduced the number of trial participants in its major phase 3 trial for its COVID-19 vaccine to 40,000. They had planned to enroll up to 60,000 people in this phase 3 trial. And essentially in this statement, they're saying it's because of the high incidence of COVID-19 in the general population. So they say now that 40,000 participants will generate the data needed to determine the safety and efficacy of the vaccine. This was first mentioned by Moncef Slaoui from Operation Warp Speed today in the government's briefing, and Stat News had reported the reason behind that cut, that because COVID-19 is unfortunately so prevalent, they do expect they could get that data faster. Now, Johnson & Johnson saying in terms of the timing, they expect that the interim data will be available by the end of January. If the vaccine's safe and effective, an emergency use authorization application could be submitted in February. Moncef Slaoui had given a faster timeline today, guys. He had suggested the interim data could be coming in early January and an EUA potentially granted in late January or February. And guys, that would add a lot of supply to the U.S. COVID-19 vaccine supply chain. This is just a one-dose vaccine, so you get a lot farther with the supply of it, guys.
And Meg, so the J&J vaccine uses different technology, right? Something more established for a vaccine than the mRNA that we've seen with Pfizer and Moderna. How are the experts that you're talking to feeling in terms of how optimistic they are about efficacy rates? Could we see anything like the 90-95% rates that we were seeing from Pfizer and Moderna?
So Johnson & Johnson's technology is a little bit more tried, I guess, than the mRNA technology for vaccines, but it is still a pretty new technology. They're essentially using a harmless virus to ferry genetic material from the coronavirus to our body. So only, I believe, J&J's Ebola vaccine is approved based on this technology. So it's still fairly new. It's also one shot, and so we don't know how well one dose of this technology is going to work. Moncef Slaoui was saying today that the data from the Pfizer and BioNTech documents that were posted yesterday on protection after one dose are encouraging. That provided about 52% protection after one shot with the mRNA vaccine. And so, will we be seeing around 50%? Will we be seeing higher? It is a key question, and one, Sarah, that I am particularly excited to find out about, and hopefully we'll find out in early January.
Meg, thanks so much for that. J&J up about 1% or so, while the S&P is down 1%. Time for a CNBC News update. Sue Herrera has it for us. Hi, Sue.
Hello, Wilf. Good to see you. Hello, everyone. Here's what's happening at this hour. Johns Hopkins, the philanthropist who funded the school and the hospital that bears his name, owned slaves. University researchers say they found census records showing he owned one slave in 1840, 4 in 1850, but none in 1860. The findings are important because they challenge historical accounts that portray Hopkins as an early abolitionist. British Prime Minister Boris Johnson and European Commission President Ursula von der Leyen are meeting in hopes of breaking the logjam over a Brexit trade deal, which must be approved before Britain leaves the EU at the end of the month. And in Paris, soccer players taking a knee in protest against racism before they restarted a game that was halted yesterday by a walk-off protest when a referee was accused of making a racist comment at a black coach. France's sports minister says she is proud of the protest, but Turkish President Erdogan blamed the incident on France's, quote, racist stance, even though the referee is Romanian. You are up to date. Wilf, I'll send it back to you.
So as always, thanks so much. Up next, the CEO of iron ore miner and steel producer Cleveland-Cliffs on the outlook for trade policy under the incoming Biden administration. We are lower, near session lows, down 2.25% on the NASDAQ.
Welcome back. 22 minutes left of trade. Cleveland-Cliffs announcing today it closed its acquisition of ArcelorMittal USA. The combined company, now the largest flat-rolled steel producer in North America, with 2019 revenues of approximately $17 billion. It's the second acquisition for the company in 2020 after acquiring AK Steel back in March. Joining us now for an exclusive interview is Cleveland-Cliffs CEO Lourenco Goncalves. Good to have you back, Lourenco. Your stock has doubled since September. It's been on this epic run, along with prices of steel and iron ore. What's driving it?
The real economy. And by the way, very nice talking to you again, Sarah. It's great to be on with you and Wilf again. It has been a 2020 challenging year, but it's a great ride for us. We act when other people are frozen, and we tend to move ahead of the pack when the opportunities come in front of us, and we act. So we are very, very happy with what's going on.
You mentioned it's the real economy. Auto production in particular has been strong. Auto demand has been strong. How much does that have to do with it versus a broader sort of bet on the cyclical recovery that will come with the vaccine in China, which is huge, obviously, but also in the U.S.?
Yeah, in our case, it's a lot of what's going on is about automotive. We are by far the largest supplier of automotive in the country. Out of our legacy footprint at AK Steel, we produce around 3 million tons a year. And with the new assets, we will add another 3.5 to 4 million tons a year. That's half of what is consumed in steel for car manufacturing in this country. So the recovery in automotive, the change in consumer behavior that happened with automotive since the pandemic has been a huge boost for our results out of Cleveland-Cliffs.
I find it interesting that your stock has rallied during the election. President Trump was thought to be very friendly for the steel industry, put on those tariffs on steel. How do you expect a Biden administration and its policies to affect the outlook and be different for your industry and your company?
Look, I think the Biden administration will show that showtime for things that we have been advocating for a long time. And it was great to hear Brian Moynihan today talking about inclusive capitalism. Capitalism is not about creating billionaires and a bunch of people driving for Uber or Instacart. Capitalism is about sharing. It's about paying people, generating good paying middle-class jobs. Because these are the consumers. These are the ones that move the economy. And the steel business is in the foundation of capitalism. So I think that the Biden administration will be the breeding ground for an inclusive capitalism that will be environmentally friendly and will be very friendly to the people and to the middle class. It will be United States time.
Interesting answer. Lourenco, good to have you on. Thanks for joining us.
Very nice talking to you.
Up next, a big debut for DoorDash and rising risk for another highly anticipated IPO. When we take you inside the market zone next, with the S&P 500 down about 1% with just under 20 minutes left.
Anything above 3672.5.
We'll pull back off of
We're
that.
going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think Steel really pleased with how. We'll pull back off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think Steel really pleased with how.
Trying to do it. Let's see what the NQs are doing for you guys and gals.
Back off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think Steel really pleased with how.
Trying to do it. Let's see what the NQs are doing for you guys. You've got to push the NQs above 12,375.
Back off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think Steel really pleased with how.
Trying to do it. Let's see what the NQs are doing for you guys. You've got to push the NQs above 12,375.
Back off of that.
We're going to take a quick break. We're still waiting for DoorDash.
I like this name, Scott, and I think Nucor and U.S. Steel. I think Steel.
Now moving above that level that I said was the first strike. 3673. Trying to get
Won
there.
his own bare bones
Doesn't
proposal.
have enough momentum.
Steel.
Now positive 887 that I said was the first strike. Get 1 minute 3673. Trying to get
Won
there.
his own bare bones
Doesn't
proposal.
have enough momentum.
Steel.
Now positive 887 that I said was the first strike. Get 1 minute 3673. Trying to get
Won
there.
his own.
This rally is now over. I would not consider anything further to the upside for a push. Let's see what VIX is doing. Then I'll give you the internals. I'll bet the VIX stopped going down. Yep. 2209 we got to. So, gotta be hard slogging on the way back up for any more push to the upside. So at the 345 time frame, that means downtown Big Brown making that final turn into the home stretch. We've got Brent still negative on both sides, minus 1.23, nicely negative 2.06 on the NASDAQ. 80 lines did go positive, positive 41. That does hold some water or some weight. Tick distribution, now positive 20. But it was a positive 900. That's on the NASDAQ. Our 80 lines are minus 1,083, still negative, but better. And the ticks are positive 40. Not as high as they were before, but still positive. Core sector list hasn't changed, still all in the red. Industrials, utilities, materials, the least of the red. With real estate, communication, telecom, the reddest of the red. Our Fangman plus T, Apple is the least, down 2.36, and Microsoft's second, down 4, Facebook down 520, Nvidia down 16 and a quarter, Netflix down 19 and a half, Google down 38.5/8, Tesla's down 44 and a quarter, and Amazon pulling itself back up. It's only down 77 now. Well, I was wrong. Bulls are stronger than I thought. Ticks are now positive. Gas in the tank to push back up to prior day's low. That would put us inside of range from yesterday. Gas in the tank to push back up to prior day's low. That would put us inside of range way back up yesterday. just went to a red bar, a green bar. 80 lines still holding positive. Brent just went to a red bar, base, re-up the dip. 80 lines still holding
Let's see what's going on.
Brent just went to a red bar, base, re-up the dip. 80 lines still holding
Let's see what's going on.
Brent just went to a red bar, base, re-up the dip. 80 lines still holding
Let's see what's going on.
Brent just went to a red bar, base, re-up the dip. 80 lines still holding
Let's see what's going on.
Brent just went to a red bar, base, re-up